because Gamma intends to sell its entire stake in the Italian gaming operator. And we must watch Deutsche Telekom as well on the news that SoftBank's selling its T-Mobile stake to fund the AI push. Deutsche Telekom, of course, T-Mobile's biggest shareholder, so we watch for the European read across. Anna, take us to the open.
Yeah, absolutely. So some interesting individual sectors and individual stocks that could be on the move. But big picture, we're still very much focused on developments in the Middle East. The way that the G7 is trying to forge a path ahead on this subject. We saw them coming to an agreement, a joint statement, but some fallout between the US and France, very clear to see from some of the things we've heard from President Trump on Truth Social. So we watch all of those geopolitical developments. We watch the developments within the Middle East, and all of that has left markets a little bit nervous heading into the start of trade this morning. So the futures were negative, as you rightly pointed out, Critty. We're down 0.4% then at the start of trade on European equity markets. The FTSE 100 is down by around 0.4%. Oil prices had been resilient because, of course, of the geopolitical tensions in the Middle East. We saw that certainly on Friday, a little bit yesterday, and a little bit the early part of today, but actually just dropping in the most recent couple of hours. But still, the relative performance of oil majors might benefit the FTSE 100. The CAC 40 down by 0.7%. The IBEX under pressure as well. Critty, what catches your eye this morning in terms of the way that the session has started?
Absolutely. Well, I mean, your guess is 100% accurate here. And then when you're looking at the index contributions, it is a sea of red in terms of the risk-off sentiment. The gains, or I should say the losses, are broad. The gains are sparse, except for when you look at the oil sector. And Anna, you pointed this out rightly. Total, Shell, BP, and a lot of the renewable energy names that Lizzie mentioned as well. Those are your gainers this morning. But again, not by some marginal moves. Your biggest index contributor to the upside is Total, and it's only higher by 0.3%. I think that really indicates and underscores some of the risk-off sentiment you are seeing in this market, including the fact that your traditional defensive sectors, like healthcare, for example, or even technology, are not actually lifting this market. They're dragging it down.
Yeah, so you've got energy as the best performing sector, but not eking out any gains as a sector. And if you look at the oil price now, WTI crude down 0.3%, as is Brent. You mentioned some of those renewable names, Critty. You've got Ørsted down more than 2%. Same for Vestas. SSE down 0.8%. You know, so it's a miserable day off the back of what's happening on Capitol Hill. But let's get some analysis now. We're joined by Ian Harnett, who is Absolute Strategy Research co-founder and chief investment strategist. Good to have you back, Ian. It's a negative start this morning. Of course, we've got lots of headlines coming out of, well, it was Canada, but on Iran and Israel latest. How are you feeling about how to price in that geopolitical risk?
So I think actually the surprise to me is just how limited the response has been in these markets. You know, we haven't seen much more of a shift into those more defensive areas. You know, the scale of the moves that we've got both in the United States and in the European feed through this morning, but still I think, you know, probably underestimating some of the risks that you've got, particularly bearing in mind the global uncertainty from tariffs that are overlaying this. So when we look at things like our own measures of equity risk premia, we've hardly seen any move at all. And, you know, that I think is a very dangerous situation for these markets. Clearly, we're still being driven by momentum, by liquidity, and that is holding these markets up. Could go further, but you know, it's still a very risky environment.
I mean, when you look at the commodity tankers already rerouting around the Strait of Hormuz, does that give you particular cause for concern when it comes to inflation?
So I think that there are clearly inflationary pressures. I think we'd already seen some of those supply chain indicators coming through, some of the consensus expectations as well about inflation. And things like the Philly Fed and the NFIB inflation numbers also pointing to rising inflation. So our economics team definitely think that that inflation pressure will rise and inflation volatility will rise. And I think this is one of the reasons why you still need to be slightly nervous about these bond markets. And, I think that's the thing that strikes me, the talk about, well, we're not seeing bond yields coming down, we're not seeing the US as a safe haven asset. Well, would you expect to in a world where inflation risks are rising, oil price risks are rising, and we ought to therefore see bond yields go up?
Well, Ian, you mentioned those oil prices. As you were speaking, we're getting some headlines, this time coming out of CBS. It looks like Donald Trump has spoken to CBS saying that Iran is very close to having a nuclear weapon, also talking about working on helping Americans leave the Middle East. And this, of course, follows headlines that we saw earlier on in our show, talking about the fact that he is not only leaving the G7 early, but potentially doing it and monitoring the situations in the Middle East from the Situation Room. Naturally, the expectation is we're going to see some sort of bigger move in oil, and oil is doing nothing but dropping. And I think that's really interesting, Ian, because how do you position a portfolio on an expectation that oil may or may not come back up?
Well, I think what we've seen a lot of clients saying this year is that they wish they just sat there and done nothing. Because we've had this whipsaw effect since April with the tariff events. So I think we'll actually see a lot of resistance to doing hasty moves at this point, really, and that instead we'll see people waiting for the outcomes. Remember also the role of passive investors here, because once the market starts to move, it could get its own momentum driving on. So I think the interplay between active investors and passive investors could see things start to move very dramatically when we do get some outcomes. But at the moment, it's still conjecture, and on conjecture, markets haven't really been moving.
Well, in previous iterations of these kind of geopolitical risks in the Middle East, but I would argue in the war in Ukraine as well, the onset, oil was used and commodities broadly were used as a macro hedge by people who are not traditionally exposed to the commodity market. Do we see perhaps a re-entry into that era?
So I think so, and some of the analysis that we've published for clients, just this morning, just highlights that when you look at the 1 month move or the 12-month moves, it depends how much has been anticipated. You're absolutely right. Is it an oil effect? That tends to be the biggest driver of these changes. But then when you look further out, it actually comes back to the economics. It's the macro. And is this a large enough move to drive us towards recession, to drive us towards inflation, or create a stagflationary environment? That really has been the driver of what the outcome of these geopolitical events has tended to be. And so, I think this is one reason why we're still sitting here. Lots of uncertainty from economists, record levels of uncertainty from economists, actually, about what's going to happen in the next 12 months. And I think that's leaving investors, very much saying, right, we're going to stick to our knitting, stick to our growth strategies or our value strategies, and we're not going to make hasty moves at this point.
How resilient is the global economy then, Ian, do you think, at this point, or otherwise? Because we're sort of torn by the latest news headlines can lead you in one direction. On the other hand, we're reminded often about the corporate earnings story, the way that a fully developed financial system just sort of motors on anyway. I mean, how resilient are you looking at?
So I think we're looking at a global economy that's likely to slow, as we go to the end of the year. I think one of the things that's still lacking as a big driver is that Chinese story. Europe's recovering to some extent, but the US is lacking a certain degree of activism. And I think the question is there that the economics is waiting for that next stage of investment. We're being carried along in those hard data by the investment that was started prior to the tariff hiatus. What's going to happen next? Will it be that rebuilding America, or will it be, okay, we're going to hold off?
Yes, and with all of the uncertainty, a lot of business leaders talk about, okay, holding off perhaps on investment decisions. Do they also, are they increasingly tempted in that kind of environment with the uncertainty to invest more at home rather than overseas? Are we moving towards a world where finance is more balkanized, where investment and corporate activity is more balkanized? Yes,
this has been one of the themes that we've been emphasizing with our clients in recent months, which is the weaponization of trade will inevitably lead to the weaponization of capital. And so, this, I think, your point point there, Anna, is well made. It's not just the US. We're going to see it in Europe as well. We've already seen it in the BRICS group, where they've been running down their debt holdings of US treasuries. But I think the big surprise to people will be that rise in US exposure in the equity market, now almost 18%, has been going on uninterrupted, whereas the bond sell-off has been coming through since the GFC. So really, it's actually the equity exposure to that balkanization of capital that you said is the really critical issue here.
So there's more money, so there's more rest of world money in the US that will leave as a result.
Potentially. Yeah. And it's actually, not just a big share, but it's actually a larger quantum of cash as well. And remember, about 2% of the US equity market is owned by foreign sovereign wealth funds that have had the advantage of tax-free investing. It's not clear whether this Section 899 discussion is going to change all that. So lots of uncertainty still out there.
Exactly. On the weaponization of capital, I mean, you were writing about that in the context of tariffs before.
Yeah.
Someone dug out Section 899. Now we see Senate Republicans trying to scale that back, delay it somewhat. How much would they have to do that to prevent a rotation into Europe, a diversification of capital?
I think what we've been saying to clients, Lizzie, is we're now being forced to ask questions that we never thought we would have to ask about the trustworthiness of US assets. Stephen Myron's suggestion that they might, force China to put their US treasuries in escrow. These are the kind of things that really change perceptions. And, we do think that will drag down on the US dollar going, longer and further out. But remember, the offset to that in America is you will have this sovereign wealth fund coming through. And, we've been talking to clients about the fact that could be a much bigger issue if we see America start to fund itself via privatizations, replacing some of that international money.
We're already seeing a little bit of that happen in Europe as well, where private equity players are coming in to fill in the sovereign financing gap. Ian, you mentioned this exodus from the United States. Where do they go, if not the U.S.?
I don't think it's an exodus yet.
Potential exodus.
Potential exodus. And clearly people are looking towards Europe. But actually, we're talking more about the South-South trades. Emerging equities would tend to do well in a world where, the dollar tends to come down. But I think the challenge here is that for Europe, without its own common single credit market, credit union, then that balkanization of European capital will hinder the investment opportunities and the investment capabilities that we have. And that's one of the questions about how do you fund this defense spending? How do you fund this infrastructure spending here in Europe? But remember that historically, it's hard to break the US exceptionalism. You've needed stronger global growth. You've needed US earnings disappointment, so the Mag 7 will need to disappoint, and you've needed that weaker dollar. Those are three hard, challenges that the rest of the world has to confront to really break that US story.
Ian, thank you very much. Thanks for spending time with us this morning. Ian Harnett, Absolute Strategy Research co-founder and Chief Investment Strategist. Let's have a look at the core six then, some heavy-weighted European equity names, and see how they are performing this morning. It is a risk-off day. We are down by 0.8% on the Stock 600, actually down by more than perhaps we'd anticipated. US futures worsening just a touch. ASML is a decent faller. Novo Nordisk also falling at the start of trade. So the chip sector, the healthcare sector, both of those in focus. And elsewhere, we see some fairly well-distributed losses across European equity markets. Let's get more on the individual stocks in focus. Joe Easton has a briefing. Good morning, Joe.
Morning, Anna. So another piece of the market really in the red today is renewable energy stocks. This coming following news of this bill out of the Senate in the US yesterday. This bill proposing that tax credits for both wind and solar would actually end in 2 years' time, and that would be sooner than had been expected. There's been a back and forth on this for a few weeks. Seems to be changing all the time, but at the moment it does look worse than feared in terms of those tax credits actually being not available by 2028. So Vestas, Ørsted, Nordex, EDP, all of those significantly weaker today. Then we do have share placings everywhere you look. It's the busy day for all of those ECM bankers, those capital market bankers. We've got share sales. Universal Music, that was a decent sized one, but the biggest one over in Italy, Lottomatica, which is their gambling group, the big one over there, that's about $1 billion worth of stock being offloaded. One of their investors selling their entire stake in a placing last night. Amadeus in travel, and Allied Allied Irish Banking, as the Irish banking, or the Irish government, I should say, looks to actually exit it. So they're selling their entire stake, looking to exit AIB, the Irish bank. I'm not sure why they've done all these placings all in one go, but potentially it is because we saw that gain in stocks yesterday, so a good opportunity to sell out perhaps. Then, in terms of placing, but in another region, we had SoftBank selling a bit of a stake in T-Mobile in the US, Deutsche Telekom being the biggest owner of that company, as was mentioned on the show earlier. So we're seeing Deutsche Telekom coming down almost 2% in Germany today. So share placings pretty much everywhere at the moment. Then Ashtead, that one was a little bit higher than that when I stepped away, but it's come down a little bit. That is the equipment rental company. Most of their business done in the US, a pretty good indicator on the US construction market, and the numbers look pretty strong, released in line with expectations, and the stock a little bit higher in London, but not a huge move on that one today. Then finally, in the ratings, just to bring you, we have got a bunch of initiations from Bernstein on chips. They're actually pretty positive on the sector, saying that the auto chip sector looks better than expected, but looks like the broader market is weighing on the sector today. Infineon is an outperform, but actually the stock declining 1.2% this morning.
Joe Easton from our equities team, thank you so much. Walking us through some of those early movers, we certainly appreciate it. As the market starts to digest where we should go with the geopolitics. Coming up on that subject, we speak to Spain's foreign minister on the European efforts to end the Israel-Iran conflict and the role that they play. That conversation next. This is Bloomberg.
Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Welcome back to the opening trade. Headlines crossing the Bloomberg terminal, latest to weigh in when it comes to the conflict in the Middle East. China is now making comments saying that the abrupt crisis in the Middle East serves no one's interest, and emphasizes that those with influence over Israel should help de-escalate. They're also standing ready to help all de-escalate in those Middle East conflicts and expresses deep concern. This, of course, comes as we're also hearing CBS, Anna, report that there is a potential of some of Donald Trump's representatives to have direct conversations with Iran.
Yes, so we continue to monitor the fallout from the G7, the way that the US administration has left there and is now setting out its latest thoughts on what's going on in the Middle East. And at the same time, Europe trying to find a common voice, perhaps. The EU's foreign policy chief, Kaja Kallas, has called a video conference of foreign ministers for later today to discuss the military escalation in the Middle East. She says the meeting will provide an opportunity to exchange views and coordinate diplomatic efforts. Joining us now is the Foreign Minister of Spain, Jose Alvarez. Thank you very much, Foreign Minister, for joining us. So you'll be going into this meeting of foreign ministers across Europe, bringing all of your views on Israel and Iran. What message will Spain be bringing to that meeting?
That we need the de-escalation, that war will be of no help to anyone, and that diplomacy and negotiation are the real way. So we have right now to de-escalate this exchange of missiles and bombs from Israel and Iran, between Israel and Iran. We have to make sure that everything related to the nuclear program with Iran is well settled, and we get Iran out of the nuclear weapon through negotiations of diplomacy, and to have a broader picture on the Middle East, to make sure that the inhumane war on Gaza is over, that humanitarian assistance, especially food staff, gets unimpeded into the street, and that we move forward toward the two-state solution that we know that is the final solution to bring peace, stability, and security for everyone in the region, of course, including Israel. And we will also continue claiming for the immediate liberation of all hostages.
Jose, do you see any signs that de-escalation is in any way imminent? We've heard these calls from European leaders and from foreign ministers that de-escalation should be the focus, but both countries remain under attack. Iran says it has the right to develop its nuclear capabilities, and Israel says it faces an existential threat. Does this sound like de-escalation is going to happen?
No, unfortunately not. I agree with you. I don't see sign of escalation. But the voice of Europe is a very strong voice. 27 countries together. We have to be very clear. We are a region in the world that believe in peace and negotiation. Our own history shows that diplomacy and not war is what brings peace and prosperity for everyone. We understand the legitimate claims of security of everyone in the region, but it's not through waging war that they will be achieved. It's through peaceful coexistence. It's through having good neighboring relations. And that's what Europe must stand for relentlessly. We have our own weight in the region, politically, economically. I've been talking all the weekend with all my colleagues, all the ministers of foreign affairs of all the countries in the region, including I've been in contact with the ministers of foreign affairs of Iran and Israel with the same message. Let's stop the exchange of missiles. Let's de-escalate. Let's resume negotiation on the nuclear file, and let's diplomacy be the tool.
Minister, thank you so much for joining us this morning. It's Lizzie here in London. You just called Israel's war in Gaza inhumane. I wonder, how should the EU sanction Israel for its role in that war?
I call it inhumane because I don't see any military objective to this war, unless we want to make a huge graveyard of Gaza. I call it inhumane because Israel is preventing humanitarian assistance, food stuff to get to babies in Gaza. So for me, it's very clear. The time of declaration and war, it's over. We have to move to action. That's suspending the Association Council between Israel and the European Union, enlarging the list of people that are sanctioned. We cannot allow spoilers of the two-state solution, people that only want war to continue traveling to European Union with all normality. And we must impose an arms embargo of selling weapons to Israel. The Middle East, the last thing, as we are seeing these days, the last thing need is weapons. And of course, we have to continue talking about the immediate liberation and unconditional liberation of all hostages and the reality of trying to help to put in place a real and viable state of Palestine that living in good neighborhood with Israel will guarantee mutually, reciprocally, security, prosperity, peace, stability for the whole region.
Mr. Creedy in London, the view that you are putting forward at the moment comes into direct conflict with some of your peers in the European Union, notably the United States as well, which is very much, at least publicly, backing Israel in this conflict right now. Would you say that the EU even has a say in a situation where it feels like the international reaction is largely being driven by Donald Trump?
We should have a say. We are a region that has always upheld peace, multilateralism, human rights. Many millions of people around the world look to European Union because they know that all those flags, we are the last one, the only ones that can really raise it with credibility. Our own credibility as European is at stake. That's why today my voice will be very strong, asking European Union to move to make a step forward. We can be with a policy focusing on backing this or that country. Instead, I'd rather European Union and Spain does to be backing peace for everyone, dialogue, diplomacy. That's what we have to back.
Well, Minister, I hear you on that, and I hear you on the human rights component to this conversation as well. But internationally, you would argue, or a lot of folks would argue, watching this conversation, that those who are ultimately supplying the defense have the largest say. We know the United States, and arguably the UK as well, from that point of view, have a bigger say. So how, outside of the human rights that you were talking about, and the human rights violations that you were talking about, can the EU actively change the dialogue when it comes to what Israel is doing, either with Iran or in Gaza?
As I was saying to your colleague, we have this Council of Association, and in its Article 2, it's very clearly stated that the relationship between European Union and Israel is based on the respect of human rights. It couldn't be any other way. So I'm calling to suspend, precisely based on Article 2, that Council of Association. Then we have the possibility of establishing sanctions, individual sanctions or other one. We are the largest trade partner of Israel in the world, the European Union. And thirdly, we must impose from European partners an arms embargo not to sell weapons to Israel as long as this war continues. So we have already very powerful tools. Basically, what I'm asking is European Union to say the same things when it comes to Kiev that when it comes to Gaza, when it comes to Ukraine and Eastern Europe, that when it comes to the Middle East, for the same reason, for the same principles, to achieve the same objectives, the protections of civilians, peace and diplomacy.
Yes, Minister, I hear you. We thank you so much for your time. Jose Alvarez, Spain's foreign minister, joining us this morning on the conflict in the Middle East. Coming up, we're headed right back to the Paris Air Show. More interviews from our very own Guy Johnson. Stick with us. This is Bloomberg.
case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation. I'm not saying it's going to happen. I don't want the reader to say he's predicting this. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. You know, with all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years. And how long a period both is this uncertain environment and how long are the tariffs going to last? And the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
This is the opening trade. About 30 minutes into today's session, we are seeing the losses pile up when it comes to these equity markets. The Stock 600 down over 1%, and a lot of that concentrated specifically in the DAX as well. You would think that defense bid would show up. It hasn't yet when it comes to the DAX. In fact, double down on those losses. We'll continue to watch these markets and the reaction to the geopolitics around the world. But in the meantime, let's get back to our very own Guy Johnson standing by at the Paris Air Show. Guy.
Kriti, thank you very much indeed. You're talking about things that are going down. Let me talk about things that go up, and go up quite quickly. The European space story is one that a lot of people here at the Paris Air Show are monitoring carefully. It feels like we're at a kind of step change moment for European space right now. Obviously, we've been watching what's been happening over in the United States, the revolution that SpaceX and others have created. How replicable is that here in Europe? Joseph Aschbacher is the Director General of the ESA, the European Space Agency, and is sitting next to me. Good morning.
Good morning.
Just out of the corner of my eye, I see a couple of massive Ariane rockets which dominate the skyline here. Why doesn't Europe and its space industry dominate in the same way that we see in the United States? What is it that we're not doing here, not funding here, that we need to fund to be on par?
Yeah. I mean, I wouldn't say that Europe is not dominating. We have some of the programs that are the world's best programs. I take Earth observation. The Copernicus program is delivering the largest amounts of data of our planet. We say we take the pulse of our planet from space with our satellites. And we use this data for agriculture, for forestry, for civil protection, for all kinds of applications that actually create a real economic value. We have a multiplier. If €1 is invested in our Copernicus program, it brings back about €5 into the economy in terms of value added and new businesses created and new services that are being sold within Europe and outside Europe. So there's a very good example where Europe has really, I would say, leadership globally in terms of space technology.
If you had more money, but is it a money thing? Do we just underfund space here in Europe?
We do underfund space in Europe. Let me give you some figures. This is Bloomberg. You like
we like numbers.
You like economic figures. No, we have an investment globally of the space economy from the public side of about €100 billion today or last year. 60% of it is invested in the United States, mostly through NASA.
So 60%?
60, NASA and the Space Force in particular. Europe's share is 10%. So you already see 10% compared to 60%. There's a factor of 6 between the US and Europe in terms of public money put into space investments. And that, of course, is seen in public. You mentioned SpaceX. Why do we not have a SpaceX in Europe? Of course, if there's a huge investment on the public side, commercial companies can develop because there are contracts and opportunities given by the space agencies in order to really develop huge programs. And certainly then private money flows in and helps it accelerate. And this is exactly what happened in the US. Of course, we want to do the same in Europe, but with 1/6 of the budget on the public side, it's a bit difficult to have the same speed and the same acceleration.
You're coming up on a funding round, though, aren't you, in terms of what you're going to see from governments for the next 3 years? Does that number go up?
That's exactly my point. I'm talking to decision makers every single day here in Le Bourget, but every single day we need to step up. We have the excellence, we have the engineers, the scientists, the capacity to do it. We can run large projects. We know how to do it. But of course, we need to fund them. And this year in November, we have a big funding round. We have it every 3 years, where we are making a proposal. I'm putting one together right now. We're working on this since about a year already, to really make sure that Germany, France, Italy, but also medium, smaller countries are satisfied with what we put on the table. And this is quite a complicated exercise, as you can imagine, but absolutely fundamental to really make sure that Europe steps up. But I think the argumentation today is much easier than, say, half a year ago or a year ago. On one side, you have the economic argument, that it's an economic sector that grows very fast, about 10% per year, the space economy is growing. On the other side, you have now something that has become much stronger, which is the strategic argument of independence, security, also defense, which of course has to do with the geopolitical
So you're going to take
situation.
on a defense role? Is that the next step for
yeah,
the
I would not call it the defense role, but certainly role. we are proposing now, and I've been just last week requested by my member states to propose a program for European resilience from space, which is security and also meeting defense needs. That means we build up a constellation, or we are about to build up a constellation for security users.
Does that mean that you could focus there? Because what we have is the combination, the coming combination, we'll wait and see whether it happens later this year, between Airbus, Leonardo and Thales. Their space businesses are coming together in Europe. So we're seeing some consolidation in Europe within the space business. Do they do the telecom stuff and the technology? You've got Iris at the moment, but should we leave that side to the civil side and the ESA becomes effectively the security story? Do we need some segmentation?
I think we will always invest in all segments of space. When we do everything from space science, that means exploring the universe and really asking some the questions about the very existence of...
The big questions.
The big questions are, where are we? Where do we go? Is there life out there? All these big questions we are addressing, and we have satellites or telescopes looking at that. But then, of course, we focus on planet Earth, from climate to natural resources to the daily economy that we are supporting. We have navigation, telecom, but also, and this is a new dimension that's coming now, which is the security and defense part. It's new. It's not completely new, but certainly something that is expanding more. And yes, this is something where certainly also Europe in general, including European Space Agency, will be engaged further, always on request of our member states, because they need to invest in defense and security, and we are the vehicle in space to do that.
So you should be part of the defense budget. Is that something that we should look to include?
There are some, and this I'm expecting now, that at the funding round at the end of this year, in some countries, not in all, but in some countries, there may be defense budgets contributing to our ESA budget.
Within the NATO kind of 3, 5, whatever you want to call that number, we should include space.
Exactly, and this is, I think, the good part of it, or the good part in the sense of that the funding that comes from the ministers of defense into the ESA ministerial can be accounted against these thresholds of NATO, whether they are 2% or 3% or 3.5 is yet to be defined. But yes, this can account against the threshold, and I think this is a good way also for investing in R&D technologies, because defense and space go hand in hand. We have a European commissioner in Brussels in charge of defense and space, and this becomes more and more an activity also in Europe, and also ESA is getting more and more requests from our member states to invest and develop technology in this domain.
How big a difference will the Airbus, Leonardo, Thales merger make? How does that change the landscape? Consolidating European defence know-how, space know-how. How big a factor is that going to be?
Yeah, I mean, there's the discussion between Airbus, Thales, and Leonardo now to merge the space part of it. That's an ongoing process, so it's really up to them. It's not for me to do.
But I'm just wondering how it changes the landscape for you.
It does change the landscape because you will have one very large company in the future, or whatever the name will be, in the space sector. You still have other LSIs, so large system integrators. OHB is one of them. Others may emerge. So for me, as European Space Agency, of course, I'm on one side. Our job is to develop space industry in Europe, large and small. Of course, if we have one very large one, we need to make sure that the supply chains, the competition is manifested. And I'm in very good discussion here, really, with the three CEOs of these three companies to make sure that we find a good way, because ESA can help in this process while industry consolidates. We can help to make sure that we remain competitive and we build up a very competitive landscape. And that's my job, and that's what I'm doing all day in, all day out.
Ariane, we've had a couple of launches. You maybe get 4 or 5 this year. We'll see what the number finally looks like. But we need more launch capability in Europe. You're just closing in on a competition that's been run. How much more capability could we have in Europe in terms of launch?
Yeah, I mean, Ariane 6 was really designed to meet the launch requirements that we have in the heavy lift sector. We have a medium-sized rocket called Vega C, which also regularly launches. But there's something completely new, and this I have actually looked very much across the Atlantic to see how the US has been doing it. NASA had a program called the COTS program, where they have been not developing the launch anymore themselves, as we have been doing it also in Europe. But now we want to become an anchor customer of launch services. So we would like to encourage industry to come with the best technical solution with whatever partner they want to team up with, and we buy a launch service, as NASA is now buying a launch service from SpaceX. So we're doing more or less a similar model, of course, made in Europe and adapted to European conditions. But yes, this is exactly what we do. So we just closed this competition to companies to express their interest, make very concrete proposals how they plan to do it. We've got a very high response, much more than I expected. Now we're evaluating them right now, and we prepare them for funding in the November funding round.
So when do they become the SpaceX of the US model? When do we see some of these companies?
I hope sooner rather than later, but of course they will start as smaller rockets.
27, 28, 29.
I think it takes a bit longer to.
Okay, so
don't forget that also SpaceX, it took them, I would say, from the beginning until the reusability operationally, it took them 15 to 20 years. So it takes time, more than a decade, to really develop a heavy lift launcher of a new generation. So yes, these are new launchers that are coming on board. It will take quite a number of years. I think we learn a lot from the investments we have already. We can be faster than in the past, but yes, it will take a couple of years. But my expectation is that, of course, Ariane 6 is a really good rocket in terms of technology and performance, the same class as the Falcon 9 rocket, for example, in terms of payload into space. But I assume that in the mid of the next decade, this will be replaced by one of these new launchers that will grow by then into a large, that means a heavy lift rocket.
Just great to see you. Thanks for stopping by to see us. We'll look forward to hearing all the news that's going to be coming over the next few months. Joseph Aschbacher, the Director General of the European Space Agency. Thank you in the studio.
All right, Guy Johnson, we thank you joining us from the Paris Air Show. As we look at equities here in Europe, right across the screen, the Stoxx 600 weakened 0.9%. Particular underperformance for the DAX in Frankfurt. It's down 1.3%. As you look at the sectoral picture, every single sector is in negative territory, except energy, up 0.8%, as we see the oil price switching to the positive. Brent and WTI crude both up about 1.5%.
Coming up on the programme, then, Donald Trump cuts his trip to the G7 Leaders Summit short, but the US president denies an Iran-Israel ceasefire is the reason for that. He's gone back to Washington. We've had plenty more commentary from him and what he's watching from the Situation Room in Washington. We'll speak to Middle East watcher Jane Kinnemont. That conversation coming up shortly about what the conflict means for the US and its allies. This is Bloomberg.
We'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
President, any statement on why you're leaving the G7 early for Washington?
Well, I have to be back. Very important. I want to just thank our great host. Fantastic job. Thank you. In Canada. But you probably see what I see. And I have to be back as soon as I can. And have dinner with these wonderful leaders. And then I get on the plane. I have to be back early.
US President Donald Trump cutting his G7 summit trip short in Canada, but denying that it was to work on a ceasefire between Israel and Iran, saying his reason was, quote, much bigger than that. Let's get the latest with Bloomberg's Oliver Crook. Ollie, what do we know about why Trump is leaving the summit? Lots of conflicting reports here. Is it because the US is about to get involved in Israel's attacks on Iran?
Yeah, Lizzie, let's unpack a little bit of what we've had over the last couple of hours. So what you had first before the White House confirming that Donald Trump would be leaving the G7 early was this Truth Social post by the President of the United States that said that Iran should have signed the deal earlier and that basically Iran could never get a nuclear weapon. And then it ended by saying that everyone should immediately evacuate Tehran. That was the pronouncement from the President of the United States. And then we discovered that he would be leaving the G7 early in order to go back to Washington, D.C. to be more, be better apprised of the situation. Then Emmanuel Macron came out and said that he was going to leave to D.C. to basically negotiate a ceasefire, to which, you know, there was another Truth post in which Donald Trump said that, no, it has nothing to do with that. Actually, this is about something that is much, much bigger, has nothing to do with a ceasefire. And so it leaves everybody sort of guessing of what the Trump administration is really up to here. And we got a little bit more detail from one of the reporters on Air Force One that is currently on its way to Washington, D.C., from Jen Jacobs over at CBS, saying that he didn't want to look at a ceasefire. He wants basically a deal in which Iran will give up the nukes entirely. He says that he does not expect the Israelis to relent at all on their barrage over the next couple of days, and that they'll see what happens after that, and that he needs to be present at the White House in order to not basically be relying on telephones and to be briefed in person by a number of the people within the Pentagon and the White House. He also said that he was undecided about sending Steve Witkoff or J.D. Vance to negotiate with Iran. This is something that's on the table, but he has not made a decision yet. And he also critically here, and this is the big question, he declined to say if the chairman of the Joint Chiefs of Staffs and the Secretary of Defense had provided him with planning options should Iran attack the U.S. bases in the Middle East. He said he cannot tell you that. So these are the situations here where basically we go with the president who has left this meeting early in order to, one, potentially potentially tried to get a negotiating table with Iran, try to get a deal, a more comprehensive deal over the line? Or could it be that the United States wants to get involved and potentially could be take a more active role in this conflict between Israel and Tehran? I suspect part of the goal of the Trump administration at this stage is to have that strategic ambiguity, that all the cases are basically on the table. I think what it is fair to say at this point is, though Trump, we know, wants a deal with Iran, we are at the point of maximum sort of pressure in terms of the negotiations right now.
And so that's Trump's departure from the G7, Ollie. Did we get any agreement before he departed? There was a statement. They did all manage to coalesce to some degree on some thoughts around Israel and Iran.
Yeah, so interestingly, I'll just give you a quick summary of what they said in that statement. Basically, that they're committed to peace and stability in the region, but they also affirmed Israel has the right to defend itself, reiterated support for the security of Israel, and that Iran, I should say, is the principal source of regional instability and terror. And they've been consistently clear that there should never be a nuclear weapon available to Iran. This is after the United States got involved with the statement. We understand that they took out some of the language. They took out language talking about seeking restraint from both sides on international law. Also took out language on a diplomatic solution as being the ideal course for this conflict. So this is the influence from the United States. And we should say this is coming at a time when, again, this is distracting from a whole host of other issues that are going on across the world. The EU leaders really would have liked to have seen some more action against Russia. And as a consequence of what's going on in Iran and Israel, we're not even talking about, for example, the huge bombing campaign that the Russians have led over Ukraine. So this is just another one of the issues that are facing the G7. The leaders that still remain there, without the United States, it's going to be hard to see them making any progress.
Absolutely, a crucial conversation that feels like the Europeans not so much a part of. Bloomberg's Oliver Crook giving us the update from Berlin. We thank you so much. Let's bring in another expert. Jane Kinninamont, Middle East watcher and co-host of the Disorder podcast, joins us around the table. Jane, you're joining us on day 3, or I should say day 5 now, of the conflict, day 3 from a trading perspective. What comes next? What are the flashpoints here?
The million-dollar question is about whether the US is going to become more directly involved in this. And as everyone sits trying to parse the social media postings of the president, really conflicting messages have been given. On one hand, Donald Trump has been saying that he wants there to be peace, that his focus is on nuclear. On the other hand, he's been saying that everyone in Tehran should evacuate. So it's left everybody unclear. Most of the other G7 leaders have been largely out of the loop. Now, the Israelis will be asking the Americans to come in and help them to take out the underground Iranian nuclear facility at Fordow. That is what the speculation is currently focusing on. They will be saying to the US, we cannot properly defeat Iran's nuclear program unless we have US assistance to do this. The US has been moving more military assets into the region because of that. But this is obviously also very divisive inside Trump's base, because this is a president who campaigned on no more forever wars, etc. The other possibility, which may appeal more to Trump, is can he get Iran back to the negotiating table and get them to back down on their previous position on nuclear? But Iran also has national pride to think about, and the leaders don't necessarily want to be forced back to the table. They have said they would stop attacking Israel if Israel stopped attacking them.
When, as you say, this is so at odds with the foreign policy that Donald Trump ran on, why do you think he would potentially get involved actively supporting Israel here? Do you think that it's because there's a real threat to the Strait of Hormuz, or that Iran really would attack US bases in the Middle East?
Iran may be quite cautious about taking moves that would widen the war unless they think that the US is definitely going to get drawn in. I think at the moment they may still be hoping that they can keep the US out because the US is a much bigger threat to them. But at the same time, now that the war is underway, Trump faces a really difficult choice himself. You know, does he leave Israel's job essentially half finished? And he has many people in Washington also saying they are our ally, you have to defend them. So for once, a president who has tried to look extremely decisive actually looks like he's not certain what to do.
Jane, what is our experience of flare-ups and violence in the Middle East, and how quickly those things can be brought to an end? Because we keep hearing from Europeans in our conversations with the Spanish foreign minister earlier, and in all of the weekend narrative from various European governments, it was all about de-escalation, de-escalation. But what is needed to actually bring that about?
Well, Well, there is one question about ending the hot phase of the conflict or preventing it from widening. There's another question about getting to longer-term stability. And what we've seen in the past recent years from Israel is that the Israeli military and intelligence services are incredibly effective at going after their enemies. But there isn't a strategy from Israel to stabilize the region. And indeed, they don't really see that as their job. They are focused essentially on firefighting, decapitating enemies. But then if you look, for instance, at Syria, where one of Israel's traditional adversaries, Assad, was overthrown, there's then no plan to actually build a peaceful relationship with the new government. It ends up being military only with not much more stabilization. Now it seems that one of the lessons the US and others learned from Iraq was not to go into other countries and try to nation build, but instead there's a big risk of leaving a vacuum. And this is something Iranians are also worrying about. Many of them would like to see the back of the Islamic Republic, but what comes next, and is there a risk of chaos and disorder there?
Well, you make a key point, because domestically, this is exactly what Donald Trump is playing to. We saw this under Joe Biden and the withdrawal of troops from Kabul and Afghanistan, and that the U.S. shouldn't be, at least from a domestic point of view, getting involved in the Middle East. That being said, you talk about kind of the bombings in terms of targeting underground bunkers in Iran. Does that put perhaps the conversation of some of the early elements of the JCPOA back on the table when it comes to access, inspections? If Iran was to come to the negotiating table, does that help or hinder that case?
I would say it hindered, but that's because, up until the attack started, Iran was already negotiating. But it was negotiating unilaterally with the US. There were not other parties involved in that. Perhaps if it had been, it would have been more difficult to derail it. The issue now is, why would the Iran, this anti-Western country that has always said the US can't be trusted, why would they now think they can get a deal with the US that the US will abide by?
Just really briefly, Jane, to what extent does the higher oil price help Putin in Ukraine?
Well, it's a boon for Russia to get more income in, and you can also see that he's benefiting from distraction, that while the world is focused on the Middle East, there's less attention paid to what's happening in Ukraine, including strikes on residential buildings in Kiev today.
Well, it seems like everybody's round the table except for the EU at this point. You've got the Middle East on the table, the US, Russia and China. Really good to get your perspective. Jane Kinnimont, Middle East watcher and co-host of the Disorder podcast. Really good to get your insights. We thank you. Well, it's a busy day in markets, and we've seen already the European equity story red across the screen as things stand. Futures pointing lower stateside as well. Oil higher now, but we keep to digest these headlines coming out of Washington.
Yeah, a lot of nervousness, it would seem, being created then in futures. Certainly in the United States, Chrissy, those are weaker, partly as a result of what we're hearing from President Trump and the lack of certainty about the position there. Here in Europe, energy stocks, the only area where we see green. Some of those on the rise this morning.
Absolutely, and this, of course, comes as the European stocks are dropping as well. And you mentioned the energy piece of this. We're now at a 1% decline on the Euro Stoxx 50. It gets worse if you look at the likes of the DAX or even the IBEX. That's where you see the pain. And yet, oil in the, well, marginally in the green now, but briefly in the red. That does it for the opening trade. The pulse is up next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
President Trump makes an early exit from the G7 summit as tensions escalate in the Middle East, but says his departure has nothing to do with a potential ceasefire. The US president warns people in the Iranian capital to immediately evacuate amid fears of further escalation in the conflict. And in markets, US equity futures fall on Trump's comments. Investors also weigh the BOJ rate hold and look ahead to tomorrow's decision from the Fed. Let's check in on markets then. Pronounced downside coming through across European equities. Every single sector in negative territory now, apart from energy. US futures pointing lower on the S&P 500 by 0.4%. You did cross above 6,000 yesterday with gains of 1% by the end of the close. Today, a more risk-off sentiment filtering through the equity markets. The benchmark US 10-year currently at 4.43 as we look ahead to the Federal Reserve, of course. The Japanese yen in focus on that decision. Not unexpected, of course, by the BOJ to remain on pat with rates. 144 right now on the Japanese yen. Brent is the assets in focus for us this morning. $74 a barrel on Brent. The volatility is there again. Gains of 1.3% right now on the comments from Trump around the Iran-Israel conflict. Let's check in on the European map and see how things are breaking down across the region in terms of the downside that is becoming more pronounced right now. As I mentioned, the only sector in positive territory right now is energy. Here in the UK, the FTSE 100 is down 0.5. You're seeing losses of 0.8% over in France on the CAC 40, and heavier losses over in DAX, down 1.1%. We are, of course, focused on the here and now of the oil story, but longer term, here's the forecast coming through from the IEA. This is a redhead across your terminal right now. Breaking news, the IEA's latest report with a projection around 5 years. China's oil demand will peak earlier than expected. The International Energy Agency saying the oil demand growth will slow, and I'm quoting, to a trickle beyond 2026. Today, though, the focus is on the Middle East, geopolitical tensions, and whether or not Iran goes for the chokehold of the Straits of Hormuz, with Brent up 1.4%. The countdown to the pulse starts right now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. The US president has made an early exit from the G7 summit, but says his departure has, quote, nothing to do with a ceasefire between Israel and Iran. Donald Trump left the gathering in Canada, having earlier called for the Iranian capital to be evacuated, fueling speculation of greater US involvement in Israel's offensive. In a Truth Social post shortly after boarding Air Force One, President Trump took a swipe at the French president, saying, quote, he has no idea why I am now on my way to Washington, but it certainly has nothing to do with a ceasefire. Much bigger than that. Let's get more from Bloomberg's Oliver Crook, who has been following all the twists and turns of this G7 summit. Ollie, what do we know about why Trump left early? If it's not big enough, if a ceasefire and those conversations aren't big enough, what could be?
Yeah, that's the big question, Tom, and that's what everybody's trying to parse, trying to get through all the sound bites of what Trump said over the last couple of hours, going through all the truth posts that we've got over the last couple of hours. And again, just to get the sequencing down for people who have not been following this to the very last moment, basically we had this Truth Social post by the President of the United States calling for the evacuation of Iran, saying that they should have signed a deal basically when they had the opportunity. Then we got the confirmation from the White House that Trump would be leaving the G7 early. We then boarded Air Force One. He's currently on Air Force One on his way back to Washington, D.C. And from Air Force One is where we're now getting a little bit more information, most recently from Jen Jacobs over at CBS, that she just had a conversation with Donald Trump saying that basically he's not interested in looking for a ceasefire. He wants a, quote, real end with Iran giving up entirely on its nuclear ambitions. He says that the Israelis, he does not expect them to relent on the barrage of attacks over the next couple of days. He says, we don't know for sure, but he doesn't expect that to relent in the short term. He says that he needs to be present at the White House, not in Canada, so that he can be briefed by his team in person in terms of reacting to what to do next on the United States' part. And he also said that he was basically undecided about whether or not he would send Steve Witkoff and or J.D. Vance to negotiate with the Iranians. He was then asked about if he had been briefed on if any sort of military hardware of the United States gets struck by Iran, does the United States have a plan to respond, and in what way? He said that he cannot tell you that, and that he would not basically respond to it. So, of course, the speculation at this stage is which way is this going? Is this going into a direction where there's going to be a huge amount of pressure on Iran, and the sort of bigger than a ceasefire is a deal that's negotiated by the United States, or does the United States take a more active role in this conflict between Israel and Iran, potentially deploying some more, making more readily available to Israel bigger bombs, or potentially taking a direct hand in itself? We should say that if the United States were to get involved directly, that goes very strongly against, the principles of the Trump doctrine of foreign policy, which has really been to not get involved in foreign conflicts. But at this point, I think deliberately by the Trump administration, there is a lot of strategic ambiguity in terms of what Trump is going to do next. That is going to play into his hand, and ultimately he wants to have a deal, but I think it's fair to say we are in the maximum pressure part of the negotiation.
Okay, strategic ambiguity. Bloomberg's Oliver Crook, thank you very much indeed. Let's stay on this topic then. Israel and Iran continuing, of course, to exchange missile salvos, despite reports that Iran is seeking talks. Israel targeted Tehran, including the state television station. Let's get more with Bloomberg's Dan Williams, who is usually based in Jerusalem. So, Dan, Iran wants to de-escalate, but Israel is determined to push on with its goal, and it has framed them in two specific ways. What is Israel's ultimate strategy here?
I think we can know for sure that de-escalation, it's not a strategy that would be considered rather thin gruel as far as the Israelis are concerned, having committed themselves to a very well-planned and, according to them, very successful so far offensive. So their plans, as at the outset, their demands are for an end, whether through their military force or perhaps combined military force with the United States, time will tell if that will happen, or through a negotiated deal, an end to the Iranian nuclear program, an end to the missile program. Netanyahu has also added that he described an end to the Iranian reign of terror in the Middle East. He said this in an interview last night. That's a bit hard to pass right now, but it would suggest he wants to see a dismantling of its regional connections, especially with groups on Israel's borders, which Israel has been battling for the last 20 months. So Israel has no patience right now for talks for the sake of talks. If there are going to be talks, it wants a conclusive deal.
Okay, that's interesting context, given what we're hearing around potentially US officials getting involved in conversations with their Iranian counterparts. We have lines crossing from CNN right now saying that the US intelligence assessment is that Iran was years away from a nuclear weapon, that being reported by CNN. In terms of the domestic support for this conflict in Israel, where does that stand?
Domestic support is very strong. Bloomberg reported yesterday, had a first look at what I believe is the first poll issued. Keep in mind that this flare-up, it seems quite long in duration. It's only 4 days old. That poll found strong 70% support across Israelis for this. The one weak point of their support is on whether Israel can alone tackle, finally, Israel's nuclear programs without US support, be it diplomatic or military. Also, Israelis in the long run, should they suffer thousands of casualties, and there have been casualties, but it's not in the thousands, there would be a third of them that would, at that point, suggest it's not worth the cost.
Dan Williams, thank you very much indeed. Usually, of course, based out of Jerusalem for us. Now, joining us for a market look, at least a market reaction, an assessment as to the Middle East tensions, the geopolitics, but also looking ahead to the Federal Reserve and central banks tomorrow. Let's bring in Jim Reed, Head of Global Macro and Thematic Research at Deutsche Bank. Always putting out morning notes as well, that are a must-read for the team here at Bloomberg. So we appreciate that, Jim. Let's start with what's happening in the Middle East then, and how markets should be reacting, because up until this point, we've got negative picture in terms of the futures stateside, so it looks like there can be downside pressure on equities. You're certainly seeing that in the European equity space, but there would be an assessment from many that ultimately the equity markets have looked through this historic flare-up in terms of the conflict between Iran and Israel. Does that relatively benign take by the equity markets on this unprecedented conflict remain, do you think?
Well, I think the market is probably getting a little bit more used to geopolitical risk. So our equity strategists have got a table where they bring out on these sort of events, which shows that the normal kind of playbook is that the S&P falls around about 6% on average around about 3 weeks, and then makes that ground up over the coming few weeks. So normally geopolitical events have a short negative impact on the market, and then within a month or two you're back to where you are. So I suppose as geopolitical risk gets more prevalent, we get used to that, and therefore maybe you need a real bigger escalation to get a bigger impact on markets.
Would that be, for example, disruption, major disruption, or attempts by Iran to block the Straits of Hormuz? What kind of move would that be? How would the equity markets react to that, what is still seen as the worst case scenario for many looking at the conflict right now would be Iran's attempts to close the Straits of Hormuz, which so far they have not attempted to do?
Oh, if the Strait of Hormuz got closed, then our guys think oil will go to 120 or head to that direction, depending on how long the Strait was closed, etc. And that would be a negative, a big negative for the equity market. You would still think that it would be resolved at some point, and you would have the same kind of playbook of a sharp fall and then a sharp recovery, but it would probably be bigger and it would take longer. So that is the real escalation that would cause this event to be a big factor in the summer.
And you say as well in your latest note that dropped this morning that the bar for a more significant sell-off is higher this time. So you give us that historical context, which is really important and useful, but the bar is higher right now for more significant drawdowns. Why is that?
Well, I think on our analysis, I think the market is still a little bit short on US equities, so or underweight. So I think that probably means that you probably do need a bigger event. Not saying it's not going to happen, but I think the technicals are probably a little bit more supportive than they could be at this point.
I want to run through that scenario again. Worst case scenario, as seen by some, which should be the closure of the Straits of Hormuz, and the inflation impact. Brent at 120 per barrel in that scenario, according to you and the team. What would that do in terms of derailing the central bank's projections around inflation?
Yeah, I think it would cause another major complication in their kind of big formula of what they do with rates. So, I mean, the Fed have got so many conflicting forces at the moment. And, tomorrow I think the Fed are just going to stay put and not really give too much away. And the oil price would give them another reason just to sit and wait.
Do you think Powell sounds hawkish tomorrow?
No, I think he's relatively balanced, but I don't think he gives either side anything to really feed into. I think he wants to keep all his cards on the table, all his options available for when he knows how the tariff situation will evolve. And as I said, the oil situation just gives him another complication.
Do you think there's a mismatch in terms of market pricing for 48 basis points, so almost 2 cuts this year, versus what we have been hearing from Fed officials and the data?
Yeah, I mean, look, the Deutsche Bank's view for this year is that there's 1 cut, and that's in December. We don't think the Fed are going to have the luxury to cut earlier than that. Obviously, the futures contracts are swinging in both directions massively. So we would still say the futures contracts are probably a bit too dovish from here. The
BOJ drawing scrutiny again. Less about the decision, of course, to stand hold, which was fully expected at 0.5% for the base rate for the Bank of Japan, but more around the decision around the bond purchases and easing how they're thinking about that, essentially allowing a little bit more liquidity in the system. Because of the volatility at the back end, how much focus is there right now on the BOJ and the bond market there? Have they kind of capped that concern at the long end, do you think?
Yeah, look, after the kind of mini turmoil a month or so ago, I think the Bank of Japan have communicated with the market reasonably well, so that today's decision was pretty much expected by most people. So a kind of a non-event. I think that the real key here is kind of political and fiscal from Japan. So in late July, you've got the upper house election in Japan. Last year, in the lower house, the government lost their majority, and you have the coalition partners and you have the opposition calling for a cut in the consumption tax. And if we move in that direction, then you start to raise concerns about the fiscal again. So I think we've moved on now from monetary policy for a little while to what happens in politics and fiscal in Japan. So that will be the story, I think, in July and August.
Okay, very interesting in terms of what to think about in July and August for Japan. Do the bond vigilantes get a prod and a wake-up call again in the US, given the tax and spending bill that we've kind of temporarily taken an eye off, at least some of us have, and that continues to work its way through the Senate?
I think as a minimum, I would say that the US is on a totally unsustainable debt path, but I think everybody in the market doesn't know when that unsustainability kind of kicks in. But I think with events this year, it has definitely been brought forward. And therefore, I think we might be on the kind of last roll of the dice in terms of being able to just expand the fiscal without any constraint, if that makes sense.
And on the BOE, before we let you go, because that decision comes through this week, again, not expecting any move from the Bank of England, but the data has come through weaker. Do we expect a slightly more dovish commentary from the Bank of England? Is there a catch-up in terms of where the BOE was positioned last meeting versus what we expected to hear? Are they going to soften the markets maybe for further cuts?
I think at this stage, that's our kind of core view, that they soften the market up for an August cut. And then again, they kind of want a little bit of optionality, because there's a lot of moving parts here. But I think...
So 2 for the BOE this year, with the next one in August?
Yeah, I think that's probably where we sit. Yeah, okay. So we're not too far away from the street. I think we're a bit more hawkish on the Fed, so the Bank of England a little bit more aligned with the market.
Okay. Jim, thank you very much indeed. What to think about the BOJ come July, August in terms of potential fiscal stimulus there. And then, of course, December being the rate cuts for the Fed this year. That is the view, of course, of Deutsche Bank. Jim Reed, the team there. Global head of macro research at Deutsche Bank. Also, of course, weighing in on the BOE, expected to cut in August and potentially once again this year. So 2 more potentially coming for the Bank of England. Coming up, as the US President calls for the evacuation of Tehran, we break down the latest news coming out of the region. Of course, what we've been hearing from US President Donald Trump as well. We're also going to speak to Nicholas Hopton, the UK's former ambassador to Iran, someone with deep experience on the thinking in Tehran. Stay with us. That is next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stradwatts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Tech is integrated into every aspect of our lives, from finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Tom McKenzie in London. Watch the new Bloomberg Tech Europe. Premieres Friday, only on Bloomberg Television. Welcome back. US President Donald Trump has left the group of 7 leaders meeting in Canada early to deal with the Israel-Iran conflict, but played down the chances of a ceasefire. Israel has continued to bombard Iran in a bid to disable its nuclear program, and Iran has fired masses of missiles and launched drones at Israel in retaliation. Joining us now is Nicholas Hopton, Director General of the Middle East Association and former UK ambassador to Iran, so someone with deep experience of the region and of Iran specifically. Nicholas, thank you very much for taking the time. Are we getting closer to a point, do you think, where the US is drawn more directly into this conflict?
Thanks very much for having me on the programme. I think that the last 24 hours have seen some interesting developments on the American side. Clearly, President Trump left the G7 summit early, and there doesn't seem to be a total meeting of minds with his G7 colleagues. And I understand he's meeting with his National Security Council to work through the options for what the US should do next. Clearly, the US was slightly blindsided by Prime Minister Netanyahu's timing of launching these attacks on Israel last Thursday night. And maybe the White House is not particularly comfortable with a situation where there seems to be a lack of US control over developments. And if anything, Prime Minister Netanyahu and Israel seem to be calling the shots and dragging the US unwillingly into another Middle East conflict. So I think the next day or two will be very important to see how the American position evolves, and in particular whether Donald Trump can somehow square the circle of supporting Israel in their offensive and condemning Iran and its nuclear ambitions, at the same time as saying the US still wants to see a deal and pursuing negotiations.
And if the US was to be drawn in, for example, using their aircraft and the bunker buster bombs that they have, that apparently and seemingly, according to the reporting, the Prime Minister Netanyahu is lobbying for, what would the regional response to that be? Could you still have a relatively so-called contained conflict in that scenario, or would that really trigger a risk of a broader conflict in the region?
I think Israel has clearly taken a gamble in its timing and the magnitude of its attacks on Iran, and its ambitions seem to be at the higher end of expectation, and possibly very optimistic in hoping to completely eradicate Iran's nuclear facilities, their missile capability, and implicitly see some sort of regime change. I think if you saw the scenario you just outlined, Tom, where the US came in and there was attacks on Iran's nuclear facilities with a chance of actually doing the real damage that Israel alone is probably incapable of doing, at that point the escalation would ramp up considerably. You've already seen countries in the Gulf talking to the Americans and intervening in the hope of trying to de-escalate and get some kind of negotiations going. I think that would intensify. And of course, as your previous correspondents have said, Iran hasn't played all its cards yet. And the Straits of Hormuz, which would have impact on the global economy and oil supply, is something that Iran may choose at that point to try and close. And that would obviously further ramp up tensions and escalation.
Okay, so that could be the trigger, that could be the catalyst for Iran to look at trying to close the Straits of Hormuz with all of the implications of that. What is your assessment of how vulnerable Iran's regime is at this point?
It is in its most fragile situation probably for many decades. Your viewers will be aware of the protests that took place from 2022 onwards after the killing of Mahsa Amini, the lady who was beaten up by the authorities, thugs essentially, and died, and that led to widespread protests. That didn't produce any lasting change in the regime. However, the vulnerability of the regime is clear, particularly given its military inferiority to Israel at the moment. And I think that the risk, though, of that turning into popular protests at the moment seems relatively limited, because actually Iranians are much more concerned at the moment with their own security and safety in Tehran, and I'm hearing that many are leaving Tehran, the capital. Whether that turns into popular protests is quite a big step from here.
We often talk about reformists within the regime, at least the political apparatus of Iran and the hardliners. What is your sense of where the debate may be, if this regime survives, around the question of whether or not to formally pursue a route towards a nuclear weapon?
The Iranian regime is complex. It's often perhaps depicted too simplistically. It's not monolithic. There are many voices within it. There's a spectrum of opinion, and the top of the pyramid, the supreme leader, listens to the different voices and at different times takes different courses of action. He took one course of action last summer when he allowed and I use the word advisedly, allowed a relatively moderate regime insider to form a government in the hope of engaging with the West and pursuing negotiations, which of course happened with the US once Donald Trump came to power. I think at this point there will be many voices within the regime counselling that Iran should find a way to reconcile with the US and negotiate a deal, even if on unfavourable terms perhaps, but live to fight another day, because at the end of the day, regime survival is at the top of the list of priorities.
Do you expect them to reach out at any point, Iran, more directly to China and Russia in terms of material support or diplomatic support?
I imagine that's happening already. The relationship between Iran and Russia has developed a lot in recent years with mutual support since Russia's illegal invasion of Ukraine. And the relationship with China is important because, of course, Iran exports most of its oil to China. And so I think both of those countries will have a role to play, particularly in any settlement, as they were supportive of a deal, in fact, when the US was negotiating with Iran.
Nicholas Hopton, we appreciate your time. We've run short of time, but we appreciate your insights. Director General of the Middle East Association and former UK ambassador to Iran. There's plenty more coming up. Stay with us. This is Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates, How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jumana Bersachi in Doha, Qatar, and this is Bloomberg.
Good morning. Welcome to the Pulse. I'm Tom McKenzie in London. These are your top stories. President Trump makes an early exit from the G7 summit as tensions escalate in the Middle East, but says his departure has nothing to do with a potential ceasefire. The US president warns people in the Iranian capital to immediately evacuate amid fears of further escalation in the conflict. And in markets, US equity futures fall on Trump's comments. Investors also weigh the BOJ rate hold and look ahead to tomorrow's decision from the Fed. Let's get more on one of our top stories, of course, our top story of the day. The US president has made an early exit then from the G7 summit, but says his departure has, quote, nothing to do with a ceasefire between Israel and Iran. Donald Trump left the gathering in Canada, having earlier called for the Iranian capital to be evacuated, fueling speculation of greater US involvement in Israel's offensive. Let's get more with Bloomberg's Bill Ferries, who's been working through the details. Bill, what do we know about Trump's early departure? What may have triggered it?
Yeah, I mean, I think we could spend the afternoon trying to sift through the meaning of some of Trump's comments and tweets over the last several hours. He is still on Air Force One, traveling back to Washington, expected to land sometime in about the next hour. He's put out these statements saying that he's not returning because he wants to work or he thinks a ceasefire is urgent. He did say, however, to a reporter on the plane that he feels like he needs to be in Washington to better stay on top of events. So he has called for Iranians to evacuate Tehran, and he has continued to say that he thinks a nuclear deal is possible. So it's really kind of all over the board. He did say that he doesn't see either side, Israel or Iran, letting up in their barrage of missile attacks and bombings of the other country. So after more than 4 days now, it continues to be a very tense situation. And the world leaders obviously gathered at the G7 in Canada, concerned that this is a situation that could escalate.
And this conflict has clearly overshadowed the G7 summit and any conversations about trade. And yet there were those conversations. Was there anything else that came out of the G7, out of Canada, in terms of progress on the story and the conversations, the dialogue, the negotiations around trade, Bill?
Yeah, so there was this agreement between the UK and the US at the G7 meeting to really kind of follow through on that framework agreement they reached, I want to say, a little bit more than a month ago now. And that would include things like giving the UK civil aerospace industry duty-free access to the United States. It would allow the U.S. to export more agricultural products, including beef, to the UK, really kind of putting the flesh on the bones of that agreement, that framework agreement that was reached previously. Of course, the context of all this is that those so-called reciprocal tariffs are still paused, but that deadline for reaching deals, July 9th, is coming up very quickly. Japan in particular had hoped to make some progress with the Trump administration at the G7. They failed to do so far. I think a lot of other leaders would have also liked to have seen a bit more progress made, but as you mentioned, President Trump leaving those talks early. So one of the big questions on the trade side continues to be how firm of a deadline July 9th really will be. Will the U.S. consider extending that? Will the Trump administration just announce what tariff rates are for a whole range of countries? Or will there be some deals in this final, basically like 3.5 weeks or so before that deadline arrives?
Okay, Bloomberg's Bill Ferry's in Singapore as we count down to the trade deadline as well, July the 9th. Not a huge amount of progress, as he was saying, in terms of trade moves at the G7, apart from the UK and the US. Now, US President Donald Trump has signalled, meanwhile, that he is in no rush to impose tougher sanctions on Russia. Trump expressed concern that imposing sanctions would cost the US, quote, billions and billions of dollars. European leaders have pushed Trump on new sanctions, arguing that it's critical to forcing Russian President Vladimir Putin to negotiate in better faith to end his war in Ukraine. Airbus has dominated the Paris Air Show, meanwhile, with orders worth as much as $17 billion from Saudi customers. Let's take you live to the show now. Bloomberg's Guy Johnson has been there, of course, since yesterday and continues with key conversations. Guy.
Morning, Tom. It has been a relatively quiet show. Yes, Airbus has dominated. Airbus has dominated because Boeing's not here. I think it's probably the best way of putting that. Its CEO, Kelly Ortberg, has decided he's going to focus on what is happening with the investigation, the ongoing investigation into the crash that took place back end of last week in India. We're still waiting for news on what caused that crash. We understand that the second black box has now been found, so that will further progress that investigation. Let's talk about that. Let's talk about what's happening in the wider industry. Andy Cronin is the CEO of one of the world's biggest lessor companies, Avalon. Great to see you. Always a pleasure. Thank you for the time. You've got some 87s in your fleet. Are you hearing anything? Do you just wait for the FAA at this point in terms of what guidance you give?
Yeah, at this point, obviously, our condolences to everyone impacted by the tragic incident. At this point, we do have to just wait for the experts to determine what's happened and then the best course of action thereafter.
The Indians are making some checks, but it doesn't seem to be replicated elsewhere. Is that normal practice?
Yeah, I think any incident like that will involve a certain amount of second guessing or higher level of scrutiny to be sure, as we would say in Ireland. So I think that everyone, including Air India, will await the formal guidance and await the formal feedback from the regulators and from the investigators.
It's one of the factors that has made the show a little quieter than maybe we would have anticipated. I'm sure you've picked on that, up on that as well. But the underlying story is still one of really strong demand. This is an industry that is kind of struggling with a really strong demand picture and a really kind of tight supply picture. Is that still the takeaway? Did you see anything changing? Is anything kind of evolving on that front?
Yeah, absolutely. What we see from our customer base around the world is resilient short-term, medium-term and long-term demand. And we see conviction from airlines in their fleet plans looking out over multiple years. So the demand picture is there all around the world. And these long-term demographic-driven trends continue to drive the industry, continue to drive the growth of the industry. And then we also see quite an attractive investment proposition for the industry as well, up and down the value chain, because you touched on the supply chain constraints. And that's really going to limit the production aspirations of manufacturers and the availability of aircraft, we believe, for much of the next decade. You couple that with the stability of the technology, where we're still bedding in the latest technology platforms, and they will be around for at least the next 15 years before there's any viable large-scale contender. We think those ingredients come together to make quite an attractive value chain for the industry.
Actually, you bring up the next generation, you bring up the next sort of iteration this industry is going to see. Let's go down that rabbit hole for a moment. Airbus is talking about having a new narrow body by 2030. Does that feel early to you? They've got a backlog that's enormous. Why on earth would you want to build an aircraft that early when you've got so many aircraft on order?
Yeah, and I think they've been clear that for the larger narrow bodies, that's more like the end of the 2030s timeframe before that's actually in service. And so
but the process starts maybe it started now, but we could start to see aircraft at the beginning of next decade.
But I think that is one of the great advantages of the industry and one of the great disadvantages of the industry. We are in a multi-decade development cycle. It takes a long time to introduce these new technologies, but then bring them to production, produce in scale, and then, as we've seen on the existing platforms, ensure that they deliver the reliability, performance, and durability that's expected from the airline business models. So we think that overall this technology environment that we're in is the most stable that we've seen, with very little risk of leapfrogging technology right through in any kind of scale production right through towards 2040.
So you're seeing stability on production, you're seeing pretty strong demand, you've got a stability picture there. I'm just wondering where the instability therefore comes from. The bond yields, obviously a huge factor, particularly for a lessor. That is one of your huge costs. What is happening in terms of borrowing is one. What happens on exchange rate probably is another. Like I'm hearing 120, 130, 140 in terms of euro dollar. Could there be a financial disruption for this industry?
Yeah, and this industry has shown its resilience to multiple external shocks, be that financial crisis, be that COVID, be that oil crises in the past. Overall, what we're seeing is, you're right, that the production, supply, demand is all there. We've played that trend. We've got 457 aircraft in our committed fleet, the largest of our sector. In terms of resilience and ability to weather the shocks, we've just been upgraded to mid-BBB ratings. That's our biggest controllable factor in how we drive our cost of funds, is protecting and improving our credit rating for the business. In terms of overall financing conditions, they're quite benign at the moment. We see the current environment as...
Do you see that changing, though? Because credit spreads are super tight right now.
Yeah, credit spreads are. Long-term rates are probably in a mid-range. Long-term inflation is in a mid-range. So the industry and all industries are always vulnerable to exogenous shocks, which change things. The leasing model, and indeed the aviation model, has shown its ability to really withstand quite extraordinary shocks and deliver continued performance, continued growth. This comes back to it's a demographic-driven growth trend, which will continue for many decades to come.
Okay, so tell me where the growth's going to be, and the type of aircraft you need to buy in order to satisfy that growth. Where are you looking to expand, and what kind of aircraft are you looking to put into those kind of markets? What are you going to be buying from Airbus and Boeing?
Yeah, so Boeing and Airbus published their own 20-year forecasts last week, and within that they highlight about half of the growth is coming from Asia, is coming from India, is coming from emerging middle class. That's where the bulk of our portfolio is weighted, and that's where the bulk of our committed growth will deliver into. That growth is driven by just simply the rising middle class and the growth of affluence and wealth in those economies. The type of aircraft, the largest growing sector, is going to be that large narrow-body sector. So the A321, the MAX 10 type range of product, that is what airlines around the world are looking for as they seek operating efficiencies, deal with slot-constrained airports, and try to drive the best value for
Airbus need to ramp up even further. Boeing need to get beyond the cap. We need more of those kinds of aeroplanes. Do you see those aircraft coming?
Yeah, I think the manufacturers are constrained by what they can deliver, simply by the upstream production capacity, foundries, castings, engine supplies.
Yeah.
These take long investment cycles to actually build new capacity. And that's what makes us quite comfortable about that balance of supply and demand for the next decades.
The fight for available slots at Airbus and Boeing is going to carry on.
Absolutely. And that also, of course, drives up the reinvestment into older aircraft, the amount of maintenance revenues for engines, which might get that third investment and upgrade rather than just getting to two investments in terms of the maintenance refits of those engines.
Great to see you, Andy. Thanks very much indeed for stopping by to see us.
Thank you.
Andy Cronin, the CEO of Avalon. Tom, from the Paris Air Show, back to you.
Guy, another great conversation. Thank you very much indeed. Guy Johnson talking to Avalon's CEO, of course, Andy Cronin. And Guy will be speaking with Virginia Governor Glenn Youngkin from the Paris Air Show. That's around 10:15 a.m. London time. So stay tuned for that conversation. Oil fluctuating as traders react to comments from President Trump calling for the evacuation of Iran's capital. That's as Israel vowed more strikes on the country. Let's bring in Bloomberg Middle East energy reporter Anthony Di Paola from Dubai. And Anthony has been kept busy, along with the team, of course, on the volatility around oil. So that call, Anthony, from Trump to evacuate to Tehran, that really spooked the markets, and now we see prices higher.
Yeah, I mean, we're really reacting, Tom, to headlines here as we see the price bounce around, starting off early yesterday with up 5% and then down later in the day as there were reports that Iran was perhaps looking for talks. And then, again, Trump deciding last evening that he wanted to leave the G7, that pushed oil again in the comments today. So we're really reacting to comments as people look at the headlines and then look behind them and try to see what is actually going to happen here. So we've seen a lot of kind of false starts and then pullbacks in this, and I think that's the way things are going to continue. The fundamentals haven't changed. In the previous interview that Guy was doing, you heard that executive talking about demand in the airline sector, and that's one thing that traders have been pointing to underpinning the oil market, that demand has been high for jet fuel as people travel for gasoline. But we were expecting that to weaken going into the second half of the year. So that was the underlying fundamental picture. And we haven't really seen that threatened by the current hostilities in the Middle East yet. There's been no attacks on oil production facilities, the crude oil production facilities that are very important for supplying the global market. We haven't seen any strikes on any export facilities. We're watching very closely shipping. There is an incident that we were looking at that happened last evening where two ships collided just outside of the Strait of Hormuz during the night. We are looking at that. So far, the reports are that it's not involved, not linked to the current conflict, but that is, of course, something that we are watching because the Strait of Hormuz is a vital waterway for getting oil out. But right now, so far, exports are moving, and we haven't seen any impact on production yet, Tom.
And yet freight rates are moving higher as well. So we've got that fundamental story versus the headline impact as well on the oil markets, as you were saying. Meanwhile, a longer term view and the latest forecasts, Anthony, from the IEA this morning. What are they saying particularly about China and the demand from the world's second largest economy?
Yeah, they're bringing forward their estimate for when they think Chinese crude oil demand is going to peak. So they're saying oil demand peaking in China in about 2027. So that's earlier. And then in general, 2030, global crude oil demand peaking. And this has been a discussion in the oil market going back and forth because you'll have countries like those in OPEC, companies like Saudi Aramco, that are much more bullish on the future of demand. So they'll say that, China is not going to peak, that we're going to keep seeing increasing growth. Interestingly, we have been seeing record global oil demand for every consecutive year for the last few years. So every time oil demand does grow, that's a new record. Of course, we are seeing slower demand growth, and that's why we're seeing this kind of slack in the market so far going into this year. That's why OPEC Plus is still restricting production. Granted, they are bringing oil back, but they've got a lot of oil still kept off the market. So we're seeing this kind of longer-term view where oil demand is lessening, oil demand for transport fuels is lessening, and that's really what the IEA is talking about there, that key market of China, whether that is going to peak sooner than expected or later than expected. And that's a key question for a lot of the economies here in this region, Tom.
Yep, the longer-term view coming through from the IEA on peak oil in the here and now. Brent up 1.2% at $74 a barrel. Bloomberg Middle East energy reporter Anthony De Paola from Dubai. Thank you. Later, watch out for an interview with the son of the last Shah of Iran, Crown Prince of Iran, Reza Pahlavi. That conversation is at 12:30 p.m. UK time. Now, UK Chancellor Rachel Reeves is reported to be considering reversing a decision to charge inheritance tax on the overseas assets of so-called non-doms. According to the Financial Times, the Treasury is reviewing the decision to abolish the tax break for non-domiciled residents amid a wave of wealthy individuals departing and lobbying from the City of London. The plan to replace the regime for wealthy foreigners was drawn up by the previous Conservative government, but deciding to apply the UK's 40% top inheritance tax rate to worldwide assets has been a major recent change under the Labour government. Meanwhile, the wealthy in France are intensifying asset protection efforts. That's after the resurgence of tax the rich policies during last year's election raised fears they will be a target as the country seeks to bolster its finances. Wealth and property advisors say well-off residents are taking or considering taking bigger dividends from their companies. They're also diversifying stock portfolios and weighing the sale of high-end real estate in case of more drastic tax changes once President Emmanuel Macron departs in 2027. And Bloomberg has learned that Barclays has hired McKinsey to help simplify its investment bank and identify where hundreds of millions of dollars of savings can be made. The consultants are said to be examining the bank's front office, finance, risk and technology divisions and are looking for where tasks can be automated. Bloomberg has also learned that talks over a minority stake sale have valued hedge fund giant Millennium Management at roughly $14 billion. Millennium is one of the world's largest hedge funds, and its septuagenarian founder, Izzy Inglater, has been considering a stake sale for more than a decade. Coming up, signs of caution from the BOJ. As the Central Bank of Japan stands pat on interest rates, we will have the details next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Welcome back. The Bank of Japan has held interest rates and unveiled a new plan to step back from the bond markets at a slightly slower pace. It's the latest sign of caution from the central bank following heightened market volatility. Bloomberg's Valerie Teitel joins me now. What was announced then from the BOJ and how the market's interpreting this?
Yeah, so it was fairly in line with what the market was expecting, that they are beginning to slow their pace of tapering from fiscal year 2026, reducing the run rate of reductions from 400 billion yen to 200 billion yen. Now, this is important because there has been a lot of volatility going on in the long end of the bond market as they've been undergoing this tapering, and these small tweaks can really play a big part of the market. The Bank of Japan owns 50% of JGBs, so whenever they have a different tact, it can have a big impact on the market. So it seemed to be like the market really wasn't absorbing this pace of tapering before, and so they've gone and adjusted it to a slower pace. They've also announced some other small tweaks. They have increase the number of securities which they're willing to lend out to the market, increasing repo operations, just because the Bank of Japan owns so many bonds. If they're more willing to lend out and borrow these securities at an easier, on easier terms, it adds more liquidity to the market. And I think that really was their end goal today in this decision.
Yeah, it's interesting talking about liquidity. Jim Reed of Deutsche Bank saying earlier that he thinks we should look to July or August in Japan for potentially additional fiscal stimulus as they ramp up around elections and the political story in Japan as well. So that was interesting. On the trade front, and we talked about the volatility and the sensitivity, particularly at the long end of the JGB curve in Japan, but the comments from Governor Ueda about the uncertainty in the current environment at a time when we saw that failure of the US and Japan to strike a trade deal at the G7.
Yeah, Ueda had some pretty strong language, calling trade policy extremely uncertain, and a lot of that does hinge on whether Japan and the US do come to some trade agreement before the reciprocal tariff deadline earlier next month. A lot of the sticking points is assumed to be around auto tariffs. Auto tariffs are huge for Japan, making up around 10% of GDP, even employing around 8% of the nation in the auto industry. So perhaps why Ueda is stressing this extreme uncertainty, because whether they do get some deal on auto tariffs could really impact the economic outlook and the inflation outlook for the nation of Japan. But as you mentioned, Trump and Ishiba did have trade discussions yesterday on the sidelines of the G7. Didn't lead to any breakthroughs. If anything, it seemed a bit disappointing. The Prime Minister Ishiba saying to the media that the two sides are not on the same page, and this is the clock ticks down to July 9th.
Okay, that uncertainty remains in terms of the trading relationship between Japan and the US. 144 right now in the Japanese yen, largely unchanged versus the US dollar. Bloomberg's Valerie Teitel, thank you very much indeed. To tech right now, OpenAI has won a $200 million contract with the US Defense Department aimed at helping the agency determine how to use artificial intelligence for admin and security tasks. Charlie Wells is here with the details. Charlie, there's a broader significance to this, which is tech companies increasingly getting involved and getting closer with the Defense Department. What do we know about the specifics of this deal between OpenAI and the Defense Department?
So, right, we know this isn't a huge amount of money, but it does represent this kind of shift into defense. And, it's a one-year contract, and OpenAI is supposed to help the Department of Defense figure out how to use AI to do things like get health care to members of the military or prevent cyber attacks. And it's sort of along this idea of, soldiers win battles, logistics win wars. And this is kind of a use case for AI, right? I think one of the questions we hear from a lot of investors is, what can you really use AI for? Clearly, the American military is seeing on the logistical front a very specific use case here on those administrative tasks. But we've also seen a lot of other firms get into defense as well. So Meta just invested $4.3 billion in Scale AI. Scale AI also has a contract with the Department of Defense for planning and operations. Meta itself last year opened up its AI models to defense agencies and contractors. So we're seeing here demand from the likes of the Department of Defense and a willingness by these AI companies to meet that demand.
Yeah, and it's quite a shift, isn't it? Just in the last 6 months or so, that's been quite dramatic. We continue to see that relationship deepening. Meanwhile, on OpenAI, talking of OpenAI, there are reports that its key relationship with Microsoft is under pretty significant pressure right now.
This is a report in the Wall Street Journal that basically says executives there talked about a nuclear option of basically accusing Microsoft of anti-competitive behavior during their partnership. And this just speaks to a deteriorating relationship between OpenAI and Microsoft, which used to be a very supportive one, but it's become increasingly competitive over the years.
Charlie Wells, excellent. Thank you very much indeed. Summing up some of the big moves in terms of the tech sector, the deepening relationship, of course, with defense and tension, it seems, according to reports, between OpenAI and Microsoft. There's a lot more coming up. Bloomberg Brief is up next. Risk off across these equity markets. Oil prices are up. The eye and focus, of course, on the Middle East. Stay with us. This is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
For Trump to win, you're never too young to learn AI. That's why he's urging the government for school kids as young as 6 to be taught how to use it.
Within this system, from first grade, they all start with the AI. education. They play 4 years, just playing. And then from fifth grade, they start to develop AI by themselves. And STEM and robotics, I see very clearly how Vietnam should be in future. Vietnam just about 100 million people, young people, good education, and latest technology. That's the only way to go. Education not contribute much profit for FPT, but from the country point of view, that's most useful contribution what FPT should do. And today we're thinking about every kids, not in cities like Hanoi or Ho Chi Minh City, but kids in the countryside should got the good education. That's what we're going to do now.
So you're leapfrogging?
Yes, exactly.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Tuesday morning. President Trump cut short his G7 visit while calling for an immediate evacuation of Tehran. Those comments rattle markets, stocks dip, and oil jumps as the Israel-Iran tensions persist. And readying for a slog, Senate Republicans released their blueprint of the big, beautiful bill, deepening a rift with the House's version. It was risk on yesterday. It was a rally in stocks with no escalation in the Middle East. That changes from the words of President Trump denying that he is working on a ceasefire, saying that Tehran should evacuate. You see a slight dip this morning. Nothing too dramatic. We're down about 0.5% for both the S&P and NASDAQ futures. By the way, with yesterday's rally, we're still within 2% of the all-time highs. Oil, though, that takes a leg higher, basically the inverse of what we saw yesterday. So with that move, we are unchanged on the week for Brent crude. It's higher by 1.4%. And finally, a bid coming into bonds. This is something we hadn't seen throughout the conflict. I should be clear, the bid is very slight, basically unchanged on your 2-year yield to about a basis point lower. Same goes for your 10-year yield at 4.43 this morning. Let's get you some stocks to watch. What's moving underneath the surface? With that is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So we are seeing significant weakness in renewable energy stocks today. Take a look at some of these moves. Sunrun down 27%, Solar Edge 21%, Enphase 17%, First Solar down 9%. It's all to do with the big, beautiful bill, as Danny just mentioned there, and it is around the renewable tax credit. Set to end sooner than expected, potentially going to end as soon as 2028, according to that detail in the lines on that bill. So keep an eye on that sector today. Then over in telecoms, T-Mobile significantly weaker as SoftBank sells a lot of stock. Now they are looking to move out of some of their telecoms investments and put it into AI, much more of a sexy kind of space to be in for sure. But that stock down around 4% today. And then over in gene therapy, I had to Google this one. I understand it is related to DNA editing, but there is a report in the Financial Times that Eli Lilly is going to buy Verve Therapeutics, and that stock rallying almost 90% on that report in the FT. And as usual, check out on the Bloomberg terminal the Before the Bell opening wrap for a summary of all these news and more.
Joe, thank you so much, and we'll catch up with you later this hour. Also this hour, just moments, we'll be speaking to Mark Dowding of RBC Blue Bay on how to handle risk. Later in the hour, Torsten Slok of Apollo on how oil may change the inflationary outlook. We'll also catch up with Virginia Governor Glenn Youngkin. He'll be joining Guy Johnson live from the Paris Air Show. Back to our top story, President Trump has departed the G7 summit a day earlier than planned.
Why are you leaving the G7 early for Washington?
Well, I have to be back. Very important. You probably see what I see, and I have to be back as soon as I can.
French President Emmanuel Macron suggested that the move was to broker a ceasefire between Israel and Iran, but President Trump took to Truth Social, saying he was working on something, quote, much bigger than that. And just moments ago, the president speaking to reporters on Air Force One, saying that he is not too much in the mood to negotiate with Iran. Joining us now for more is Bloomberg's Susan Lynch. Suzanne, what do we know about why Trump departed early?
Well, we know that Donald Trump shot down Emmanuel Macron's suggestion that he was going back to Washington to broker a ceasefire deal. Donald Trump was very clear in his Truth Social post that that was not the case. He said something much bigger. So there are now obviously a lot of speculation about what might be happening in Washington. Would there be some kind of U.S. involvement? We did hear, though, from the U.S. Defense Secretary on a media interview, that they still want peace. But the world here in Europe are waking up to this development overnight. There is concern about what this means now for what's happening in the Middle East in this ongoing and escalating conflict between Israel and Iran.
Suzanne, there's been so much back and forth as to whether the U.S. is, in Trump's word, not too much in a mood to negotiate or negotiate. There was some reporting from Axios on a potential meeting between Steve Witkoff and the Iran foreign minister. Iran itself asking for de-escalation, at least sending those signals. Does it seem like there is a white flag? Will the U.S. listen? Are there underway, does it seem, any negotiations to get something like a ceasefire?
Well, there did indeed to be some signals from Tehran of some move towards or desire for de-escalation. Obviously, we saw those attacks in Tehran yesterday. This reporting from Axios does suggest that some kind of negotiations could be in the offing from the U.S. side. Donald Trump spoke about the need to not just talk over the phone, talk in person. So perhaps there is some kind of background maneuver on this. We know that Donald Trump says that he is the deal maker. He wants a deal. The big question now is he prepared to get involved at this kind of granular level in a deal between Israel and Iran? That's what everybody is asking now. But the very fact that he left the G7 summit in this nature is extremely significant. People were not expecting that. Now, in one way, I think the other partners around the G7 table will be relieved that he did sign up to the declaration calling for de-escalation. It wasn't like the last time we had a G7 summit in Canada, which ended in acrimony after Donald Trump left. This was different. There was a different reason, as he said, that he left. So from that point of view, I think the international allies of the United States will be relieved.
Yeah, the Deutsche Bank pointing out that the G7 leader statement this time was only 121 words. The last one was over 19,000 words, just confining their statement to Israel-Iran. Suzanne, thank you so much for that excellent coverage, Suzanne Lynch. Now, Mark Dowding of RBC Blue Bay stays cautious on risk around the Israel-Iran conflict, writing, quote, at a time of some market complacency, the Middle East and geopolitics more broadly is a source of risk which we cannot ignore. Joining us now is Mark Dowding, CIO Fixed Income of RBC Blue Bay Asset Management. Mark, just how fat is that dangerous tale of risks we might see as we head deeper into this conflict?
So I'd say here that in many respects, if you look at financial market movements on the back of the conflicts between Israel and Iran at this point, everything has really been relatively muted. I think that there would have been a point in the past when if you'd have told me that we'd see a war between these two nations, you'd be sort of half expecting oil to be up at a figure like $150, or you'd be expecting to see a big risk-off move across financial markets. We haven't seen that, of course. Oil prices remain very contained, and at the moment, it seems that the majority view is that things stay contained as they are. But in terms of the fat tail, that fat tail is something that you still need to ascribe a 10 to 20% probability towards, I'd suggest, and it could be that the markets get stung there if things do end up escalating in an unpleasant way.
Mark, should markets be prepared for that, though? Because as you say, they've been really sanguine. Is it a moment of complacency?
So I think that something we see more generally is that in a climate of great uncertainty, markets are really struggling to price in multiple scenarios. In a way, you end up with too many scenarios on trade, on geopolitics to effectively analyze all in one go. But I would say that if you sort of look at what is priced here in markets at the moment, with stocks close to their highs, you'd actually say that at the moment risk assets continue to climb the wall of worry, don't they? It's like buy every dip, everything keeps on going up for the time being. But in the here and now, I would say that it made more sense to me to favour a more cautious stance and then look to be in a position to add risk if markets do blow out, rather than be chasing price action and chasing the run up in risk assets at this moment in time. So from that point of view, we've been more inclined to actually de-risk portfolios. We've been inclined to actually put on portfolio hedges over the course of recent days.
Have those hedges including duration, Mark? Because the move has been anything but straightforward. In that initial gut punch reaction of risk off, we did see treasury yields move higher. How do you understand what's driving them and what your appetite is for them if you are looking at getting more defensive?
Yeah, so here I would suggest that there has been times in the past where using duration as a risk-off hedge has been a strategy that's worked. We're not so clear right here, right now, that using duration in that way is actually the best way to actually hedge some of those risk-off events, particularly because some of the scenarios that could actually take yields risk-off would actually be scenarios that could actually see long-dated debt yields moving up, not down. We actually think that a curve steepener is a better way to actually use fixed income assets to actually run a risk-off hedge. Most scenarios in our mind, as we would model them going forward from here, point very much towards a steeper US yield curve. And so in a portfolio context, we think that this is the thing that investors should really be bearing in mind.
All right, so it's a different regime. I'd also love to get your take, Mark, on a Christine Lagarde FT quote that we saw, not a quote, rather, a opinion piece in the FT. By the way, we are just seeing the president exit Air Force One as he leaves the G7 early. But Christine Lagarde writing that this is a moment for change, an opportunity for change for Europe. It is a global euro moment. To seize it and enhance the euro's role in international monetary system, we must act decisively as a united Europe, taking greater control of its own destiny. Mark, we have seen the US dollar continue to weaken. There have been calls as to what takes its place, if anything can take its place. Christine Lagarde actively campaigning for this to be the moment for the euro. How likely or unlikely is that?
Well, I'd say that they are big, beautiful words, aren't they, coming from Mrs. Lagarde, just as I look at the big, beautiful guy sitting in the back of his car there. But the problem for Europe is we need action, not words. Mario Draghi last year was calling for an agenda for change for the EU that I'd very much endorse. I think contained a lot of the right ideas. But investors want to see the substance behind these words. The problem with Europe is it can be a bit too much talk, not enough action. And now is the time, I'd suggest, to see action, substance more than words. So let's see European leaders get this done. Let's see them make sort of steps towards developing the single market sort of union and the financial union and all of these steps which are in their hands, rather than just trying to talk a good game all the time.
Well, Mark, we didn't even have time for the other big, beautiful thing, which is the big, beautiful bill. We'll have to get around to that next time. We're out of time. Thank you so much for joining us, Mark. Always great to get your comments. Mark Dowding of RBC Blue Bay Asset Management. Let's get you some other top stories that are trending on the terminal this morning. The U.S. and U.K. have reached an agreement to implement trading terms disclosed last month that would slash tariffs on British products and raise U.K. quotas on certain U.S. agricultural products. Duties on British exports will be down to 2% from 27.5%. The deal did fall short of an immediate cut to steel tariffs. And speaking of the big, beautiful bill, Senate Republicans have proposed to cut trillions of dollars in taxes for households and businesses in their version of President Trump's tax bill. It would preserve the 2017 tax cuts, but cut Medicaid benefits and add to the U.S. deficit. Notably absent from the bill, a deal on state and local tax deductions. Cantor Fitzgerald has hired about 15 investment bankers and traders in Germany. The bank, run for decades by Howard Lutnick, is looking to push deeper into European markets. Representatives for Cantor declined to comment. Coming up, we're live at the Paris Air Show with Virginia Governor Glenn Youngkin. That comes up next. This is Bloomberg.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It's your Bloomberg Brief. I'm Danny Berger in New York. Let's now head over to the Paris Air Show, where Bloomberg's Guy Johnson joins us live with the governor of Virginia. Good morning, Guy.
Glenn Youngkin is here. I nearly got that out in one go. Good morning.
Good morning. Thanks for having me.
We sit here at the Air Show, and I've talked to you about this over the last few years. This is a really integrated industry, okay? A lot of the companies that are here are headquartered in your state. A lot of Virginians are here. But it's a really integrated, this is a global industry. It's not a Virginia industry, it's not an American industry, it's a global industry, the aerospace industry. And a lot of people here are scratching their heads, wondering, therefore, what happens next in terms of trade? Can I continue to manufacture the aircraft that I manufacture with US parts in them and European parts in them? Do you think there should be some exception made for this incredibly complex, different industry that we see behind us here?
Well, there's historically been arrangements around the
79.
world. Yeah, big agreements. I think one of the challenges that we're working through is how much of the content is in what countries and who's buying. And so I think that the next step here is to understand the mapping of all those supply chains. And then second of all, to see that there can be an agreement that's reached. At the end of the day, I've been very supportive of the president's position that we need fair trade. And historically, across all the industries, the United States has really been in disadvantage around the world with trade really being imbalanced. And so he's rebalancing these trade agreements. The result of that we're seeing in the Commonwealth of Virginia, where so many companies now are coming to establish U.S. manufacturing. And the good thing is they're choosing Virginia to put it down. We've had $100 billion of commitments from companies to build and expand in Virginia. And we expect to continue to see that. So this long-term agreement that has existed in aerospace for a long time, I think will be something that will be addressed. But at the heart of it is rebalancing some of these trade agreements.
But this is a reasonably nuanced story here. It's this is an industry that is quite balanced. Boeing, headquartered in your state, exports a lot of airplanes around the world. You wouldn't want to see that put at a disadvantage, that company put at a disadvantage, Kelly put at a disadvantage when he tries to sell airplanes around the world, would you?
Well, again, it's a matter of balancing around the world. And if we have open trade agreements with our partners, much of this is done on a bilateral basis with the current administration, then it'll settle out. And if we have certain partners that aren't willing to do that, then it'll be more difficult.
Do you think it's reasonable? It appears at the moment that if you buy lots of Boeing, headquartered in Virginia, that you get a good trade deal.
Yes.
Is that a reasonable kind of thing to talk about?
Yeah, if as an American, yes. I mean, I think one of the real opportunities is for America to recognize, and this is exactly what President Trump is doing, is that access to the U.S. market is really important to companies around the world, and we're there of our counterparties. And to date, it has not been very fair, and so they're rebalancing that. And I think this is exactly what all the industries are seeing today, and we hear the same thing in the automotive industry and others, that it is complicated in supply chains. Well, over time, as things settle down and we can see President Trump reaching deals like he's reached with the UK, that we will see fair trade. And when that fair trade is set, then we'll see industries like the aerospace industry settle into it.
Let's talk a little bit more about Boeing, headquartered in Virginia. Makes a lot of aeroplanes in Seattle, though. And I'm wondering whether or not increasingly there is an argument that says Boeing should be headquartered in Seattle, in Washington, not in Virginia. Can you kind of see the logic of that?
Well, I also see the logic of their very, very large customer being the Pentagon, which happens to be in Virginia. And where they had a huge win just recently as the prime on the new F-47, which is the next generation fighter for the military. And so what I think what Boeing has recognized is that, one, they have the best workforce in the world in Virginia, and so they tap into that for all of their corporate functions. They have great access to their customer. And I know that the flights from Dulles to Seattle are busy as their senior executives move back and forth between Washington and Washington.
Yes. Yeah. Just confusing for the rest of us.
Yeah.
But isn't there an argument that says you need to be close to the shop floor? Yes, the customer is at the Pentagon, but the lesson we've learned is be close to the shop floor.
Yeah, well, so I spoke to Kelly when he came on as the new CEO, and we had this very candid discussion. And he said he was very comfortable with the headquarters being in Virginia, but he personally was going to spend an enormous amount of time with the commercial aerospace business as he set that right. And that's exactly what he's done. And yet their defense business has been growing, not to mention the fact, again, that this F-47 win is a big one for them.
Okay, you bring up defense, so let's just kind of talk about defense for just a second. Again, it comes back to the same argument. Should Europe be buying more U.S. defense in order to balance the books?
I think the U.S. defense industry would very much like for them to.
Sure, but is that a way to get over the trade disagreement that we have at the moment?
I think it's one of the tools in the toolkit, once again, to balance the trade. And when you have large trade imbalances, where we are in fact buying a lot more in the United States from countries than they're buying from us, it's one of the tools in the toolkit. And I do think that the defense military complex has the most advanced military capabilities in the world. And so I think that what we're seeing is the collaborations between U.S. companies and particularly European countries, I've had a lot of meetings in the last 2 days, has never been better right now. And in fact, what I think is happening is the European and international companies are really moving into the United States with breakneck speed. Because what they're hearing from the Pentagon is we want to do more, and we want to do it faster. And so we need more robust supply chains that can deliver what we need faster. And a lot of the international companies are starting to come into the United States either through a proxy arrangement or with partners in order to try to meet that demand.
Before I throw it back to Danny, you're term limited. A cabinet job maybe next year?
I'm going to finish strong in Virginia, and then we'll see what happens. I think one of the great things that I have realized is I don't need to worry about this every day. I'm focused on the Commonwealth. And Virginia's really roaring. We've just touched through $100 billion of capital commitments from companies. We have more people working than ever. We're running our 4th straight year of another big surplus, which is allow us to reduce tax burdens and make big investments. The state's doing extraordinarily well, and I've just loved the job I've had, and I can't wait to finish strong. And so I've got to do that over the next year.
Balanced budgets, they're amazing things. Glenn, great to see you. Governor, thank you very much indeed for joining us.
Great, thank you.
Governor Glenn Youngkin of Virginia. Danny, back to you.
Guy, thank you so much. A fantastic conversation. Also, just want to bring you some breaking lines from the president saying he has not reached out to Iran for peace talks. If Iran wants to talk, they know how to reach me, and it reiterated that they should have taken the deal on the table. We'll have more coming up on just that. You're watching Bloomberg Brief.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Let's take a look at the front pages this morning on the biggest outlets. First up, the FT, and indeed most papers leading with President Trump leaving the G7 early in Canada to manage America's response to Israel and Iran. On Air Force One, coming off of it, he said, "I've not reached out to Iran for peace talks. And if they want to talk, they know how to reach me." Next up, the Washington Post also has this on their front page: Russia launching a deadly attack on Kyiv. At least 15 people, including an American citizen, were killed and more than 100 injured. This is Bloomberg.
We're micro investors. So as micro investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services company. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself. But in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Tuesday morning. President Trump cut short his G7 visit while calling for an immediate evacuation of Tehran. Those comments rattle markets, stocks dip, and oil jumps as the Israel-Iran tensions persist. And readying for a slog, Senate Republicans released their blueprint of the big, beautiful bill, deepening a rift with the House's version. Without escalation yesterday, it was a climb in stocks just 2% away from all-time highs. That changed last night with Trump leaving the G7 early, convening the National Security Council. We are lower by more than 0.5%. Trump on Air Force One this morning saying that he is in no mood to negotiate with Iran. So those de-escalation hopes quickly getting squashed in markets. That's also translating to higher oil prices this morning, higher by more than 1%. That move almost exactly mirroring the drop we saw yesterday, leaving oil unchanged on the week. But we are finally getting a bid into bonds. 2-year yields lower by 1.6 basis points. Your 10-year yield lower by about 2. We had a solid auction yesterday on the 20-year. Let's get some stocks that are moving in the pre-market. With that is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So solar energy stocks really hit hard this morning, and it is that update on the big, beautiful bill coming out of the Senate last night. We're seeing Sunrun, Solar Edge, Enphase, First Solar, all down double digits this morning. Sunrun down 27%. The bill from the Senate Republicans set to end tax credits sooner than expected. Potentially, they're going to end by 2028, really spurring some fear in the market for solar stocks today. Then over in telecoms, we got T-Mobile weaker as SoftBank looks to offload potentially a big stake in that company. They're looking to move some of those funds into AI, much more on trend than the telecom space. That stock down almost 4% for T-Mobile today. Then over in pharma, gene therapeutics, something that I'm not afraid to admit I don't know a lot about. It is DNA editing, and according to the Financial Times, Eli Lilly looking to get into this space via a takeover of Verve Therapeutics. Now this is worth around $1 billion or so more in terms of the deal size. That stock soaring 80%. Will probably struggle to see a bigger gainer than that today. Verve Therapeutics soaring on that report of an Eli Lilly takeover. Danny.
A big move this morning, Joe. Thank you so much. Now back to our top story. Apollo's Torsten Slok pointing out that the Fed's own model shows that a $10 jump in oil prices feed through to a 0.4% drag on GDP and a 0.35% increase in inflation. He writes, in short, higher oil prices exacerbate the ongoing stagflation shock stemming from tariffs and immigration restrictions. I'm pleased to say that Torsten joins us now. So Torsten, just another added risk to that tension you're talking about. How close are we to a Fed that is going to have to choose between its dual mandates?
Yeah, this is a really important debate for tomorrow, Danny, because at the moment the Fed is stuck with a dual mandate that's really torn. On the one hand, the upside pressure on inflation from tariffs, from oil prices, from restrictions on immigration. That's saying that inflation will be going up, and that's their forecast. That's also the consensus forecast. And if inflation is going up, the Fed should be hiking. But at the same time, those shocks also will be pointing in the direction of growth slowing down. And if growth is slowing down, then Fed should be cutting. So which one is it? Is the Fed putting weight on inflation going up? Or are they tomorrow putting weight on growth slowing down? So that's why the combination of the things that are hitting markets at the moment, with, in particular, of course, now oil prices also going up, but coming on the back of that, also, of course, tariffs higher and also restrictions on immigration. It does put the Fed in a very difficult spot going into the meeting tomorrow.
The Fed, of course, though, can only react to the data that's coming in, Torsten. So how much does sequencing matter here in terms of what really starts to hit the economy first, inflation or growth slowdown?
Yeah, that's really exactly the point, namely that it all, from their perspective, is about let's see which one moves first. So yes, the forecast that they have says higher inflation and lower growth. The forecasted consensus says higher inflation, lower growth, but we don't know which of these will appear first. So far, inflation has been reasonably well behaved. Growth has also been okay. There's been some signs of jobless claims ticking higher. And there's also been a little bit more worrying signs of continuing claims moving higher. Continuing claims moving higher is particularly worrying because it suggests that corporate America is frozen, that corporate America, they're not hiring, they're not firing. And as a result of that, we should see the stock of people that are unemployed continue to edge higher. And that's what we've seen in the last few weeks. And combining that with today retail sales, will also be telling us something about is the consumer also in the process of slowing down. And we have the weekly data from Redbook, same-store sales has been slowing down in the last few weeks. So the fear here is that growth starts slowing down, and at the same time inflation goes up, and that makes it difficult for the Fed then to figure out at this point which of these things are exactly going to move first.
Torsten, you spent a lot of time thinking about what could go wrong. That is slowdown, consumers pulling back, inflation ticking up. What could go right this year? Could things go right for the Fed and get the good kind of cuts because inflation is slowing even with growth holding up?
Well, and let's add also to the list of things that could go wrong that we, of course, also have issues around treasury auctions, worries about fiscal issuance. We also have worries around who the next Fed chair will be. So in that sense, there's a number of things, of course, that are the list of things that markets are monitoring and that we spend a lot of time on here at Apollo. But the short answer to your question is, what could go right is, of course, if we do have oil prices beginning to go down, if we do have a lowering of tariffs, and if we do have that rates are no longer going up as much because of the fiscal situation. So it's almost a negative sign, if you will, on all the things that we worry about, that those risks, if they begin to move in the right direction, then I do think there would be some relief. But let's wait and see, especially with retail sales out here in a few hours. It becomes very important what the consumer is doing. The consumer is still 70% of the economy. And if the consumer is still doing well, then, of course, that would also be, at least for now, a relief for markets.
Yeah, last month was, let's say, uninspiring at best. Torsten, you mentioned fiscal. When it comes to the big, beautiful bill making its way through Washington, how do you interpret what is reckless spending and therefore an issue versus stimulative to the economy?
Yeah, so as Jay Powell says, every time he talks about this, fiscal policy is unsustainable. And of course, when fiscal policy is unsustainable, the ultimate fear is that long rates will go up and the term premium will go up and the curve will steepen. And therefore, it becomes more difficult for the Fed to control the economy in the front end because the long run is no longer measured only running only by what's happening with inflation, but now the long end is also driven by what's happening to the fiscal issues. So in that sense, more debt means higher rates. At the same time, as you're saying, well, if there is more fiscal expansion, we will, of course, see some boost to GDP. So on the one hand, higher rates is dragging GDP down. On the other hand, the fiscal boost to GDP, which will only probably be 3 or 0.4% over the next 2 years, but that is, of course, something that would be helpful. So in that sense, we will likely get a boost to the economy from the fiscal bill here in the short run, but it remains, of course, the case in the back end of the curve that there is still a lot of questions being asked about what is the impact of the fiscal situation over the coming months ahead as a result of debt levels growing so much.
Torsten, I just want to end where we started. And we're in this environment where there's been a tariff blitz. Oil prices have been jumping. We see freight rates continue to be high. Is this an environment and an economy that cost shocks are back, that we are sensitive to it?
That's exactly right. And that's why the best description of what's going on is that the economy is hit by stagflation, because stagflation is coming because of higher prices, because of tariffs. And when prices go up in companies, of course, then sales will go down. Higher prices coming because of oil. And when oil prices go up, of course, we buy less oil. And finally, also higher prices going up because of restrictions on immigration. Wage inflation in the last employment report was going up. And ultimately, if wage inflation go up, of course, it also runs the risk of lowering employment. So stagflation hitting the economy is what makes it so difficult for the Fed in the meeting tomorrow, because the Fed has this risk that if they put too much weight on inflation, and the dot plot to some degree reveals that the next move in their view will be a cut. So therefore, let's say that they do begin to cut, and especially if they begin to cut more meaningfully, then the risk is, of course, that inflation might begin to move higher, and that's when the dual mandate here torn in different directions is really complicating the thinking for markets and for the Fed at the moment.
Certainly be interested to see how he threads that needle tomorrow. Torsten, so great to hear from you this morning. Torsten Slok of Apollo Global Management. By the way, I quickly want to bring you the Global Investor Survey from Bank of America is out. Investors are net 31% underweight the U.S. dollar, That is the most in 20 years. Let's get you some other top stories now that are trending on the terminal this morning. The U.S. and U.K. have reached an agreement to implement trading terms disclosed last month that would slash tariffs on British products and raise U.K. quotas on certain U.S. agricultural products. Duties on British exports will be down to 10% from 27.5%. The deal fell short of an immediate cut, though, to steel tariffs. Barclays has hired McKinsey to simplify its investment bank and identify hundreds of millions of dollars in potential savings. Bloomberg sources say the consultants are looking into the front office, finance, risk, and technology divisions and opportunities for automation. Elsewhere in banking, Cantor Fitzgerald has hired about 15 investment bankers and traders in Germany. The bank, run for decades by Howard Lutnick, is looking to push deeper into European markets. Representatives for Cantor declined to comment. Coming up, President Trump says that he has not reached out to Iran for peace talks after cutting his G7 trip short. We're going to have more on that next on your Bloomberg Brief.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
I've been negotiating. I told them to do the deal. They should have done the deal. The cities have been blown to pieces. We've lost a lot of people. They should have done the deal. I told them do the deal. So I don't know. I'm not too much in a mood to negotiate now.
President Trump speaking on Air Force One moments ago after he left the G7 summit early. The president also took to Truth Social, reiterating that he hasn't reached out to Iran for peace talks after he earlier denied that suggestion from the French President Emmanuel Macron. There was also some reporting from Axios this morning that Steve Witkoff would be meeting potentially with the Iranian foreign minister. So Trump potentially reacting to that too. Joining us for more is Bloomberg's Horizons Middle East and Africa host, Jomana Bersecci. Jomana, what do we know about why Trump left the G7 early and what it means in this ongoing conflict?
That's right. So we woke up to a flurry of headlines, the main one being the fact that President Trump decided to leave that G7 summit early. Later, the rationale given behind it was that he wanted to focus on the latest developments in the Middle East. But he then downplayed the prospect of reaching a ceasefire there in response to some comments that the French President Macron had made that there could be a possibility of a truce. Trump went on to say that they're working on something much bigger than that. And as we were just showing, the Air Force One just landed back in the U.S. and he said that if Iran wants to talk, they know how to reach me. They reiterate that Iran should have taken the deal that was on the table. And so this really is a critical moment because the whole world is waiting to see what sort of involvement the U.S. is going to have in the events that are unfolding. On Sunday, President Trump said that quote, let them fight it out and see how things play out, i.e. more of a spectator role. Today, he's raising the possibility again of a potential to restart those nuclear discussions. Remember, the round 6 of those discussions were supposed to take place in Oman on Sunday. They were canceled, but now he's talking about the possibility of re-engaging diplomatically. And then, of course, the third option would be for the U.S. to get militarily involved and to join Israel in those airstrikes on some of those key strategic locations, the ones that we've been talking about, both those nuclear sites and the military sites as well, with Israel and the Israeli army saying militarily the last 24 hours, they feel like they are in a very dominant position. Now, the situation is very tense on the ground, and we also need to dovetail all of the headlines that I was just giving you now versus the other posts that President Trump put up overnight warning Tehran residents, and by the way, there are 10 million residents in Tehran, to evacuate their homes. The airspaces are closed. They're going to be closed until 2 a.m. morning, another extension. There's nowhere for these residents to go. Traffic's miles long. People are trying to flee up to the mountains. So a very precarious and tense situation right now in the Middle East as the whole world waits to see what the U.S. are exactly thinking here.
Joanna, thank you for your excellent coverage all this week and last. Joanna Bercecci there. Over in Washington, President Trump's tax and spend bill still in the Senate. For their version, Republicans are proposing to cut trillions of dollars in taxes for households and businesses at the expense of health coverage and at risk of expanding the deficit with no deal on SALT. Joining us for more is Bloomberg's Suzanne Lynch. Suzanne, great to see you again. Just how much daylight is there between the Senate and House versions of the big, beautiful bill?
Quite a bit, and this really matters because it does have to get through both houses before it gets to the desk of Donald Trump under that self-imposed deadline of July 4th. So the Senate has made a number of changes, including those deeper cuts to Medicaid, and already we've seen some Republican senators, like Josh Hawley, for example, who are not happy with that. So there is still some gaps to be filled. The other issue is, of course, how it's going to add to the deficit. We're now looking at around $5 trillion, so that's a huge amount. What we didn't have is a big change to SALT, those local tax provision with the credit still at $10,000 in the Senate version. That's kind of a placeholder. It could change. But yes, there is quite a bit of daylight between those two versions as they stand.
Suzanne, what does it mean in terms of where things go from here? Just how much of a slog it could be to pass this bill?
Well, I think the House Speaker made it very clear that this was a very tight vote in the House and urged Senate Republicans not to go too far, not to change it too much. You know, the Senate, it's going to come down to around 3 votes. The House passed its version by just 1 vote. So this is going to be very tight. And this really does matter for Donald Trump, for his presidency. We've been hearing and discussing, of course, about these big international challenges. But domestically, this is the big signature move by Donald Trump. Will those 2017 tax cuts, will they be extended as is hoped by Donald Trump and Republicans when they're set to expire by the end of the year? So a lot riding on this.
Suzanne, thank you so much for that this morning. That is Bloomberg's Susan Lynch. Let's now get you a Bloomberg exclusive. Sonali Basak sat down with the Citadel founder and CEO Ken Griffin for a wide-ranging interview. Here's what he said on political support.
One of the big pushes that we made over recent years was to substantially increase the number of people who ran for office in the Republican Party who were women, who were veterans, and who were people of color. Because I believe the Republican Party needs to do a better job of representing all of America. So that's been a big push for us over the recent years, has been bringing people with those backgrounds into public service. You know, I was an adamant supporter, for example, of David McCormick, really strong businessman, really great experience in serving our country. That's the kind of person that I want to see in Washington representing the interests of all of us who live in our great country.
More on that interview on Bloomberg Originals Bullish with Sonali Basak. And I'm so pleased to say Sonali joins us here ahead of the premiere tonight. Sonali, really fantastic interview. I know you have so many more fantastic ones to bring us. Really wide-ranging with Ken. What were some of your takeaways?
The political takeaways I thought were the most interesting, because when I asked him how he wants to leave his mark on the Republican Party, he made pretty clear that he's not just a Republican donor. Now, that could most be seen in the way he supported the South Florida area. For example, the Miami-Dade mayor. In addition to the Miami mayor, there's a Democrat and a Republican. But also the idea of shaping the Republican Party with more diversity, frankly, with more women, with more veterans, with more people of color. He gave a nice little shout out to David McCormick to kind of show what he thinks the future of the Republican Party is. Now, also interesting here, if you read very much to the bottom, you can hear more about his investing advice also, as well as his stress relief techniques, which are somewhat surprising for Ken Griffin, but I'm not going to give it away. I'm going to let
I was going to say, I need to know. That's a good tease. That's a good tease, Sonali. Speaking of teases, I know you're speaking with Nassim Taleb later today, too, who also appears on Bullish. What are you going to talk to him about? What does he talk about in the show?
Listen, when we spoke to a lot of these large investors for the course of creating Bullish, we were looking for the intersection of money, politics, culture. So we went to South Florida and Universa Investments, where Nassim Taleb is a scientific advisor, is based there. He talked a lot about the shift away from the banking system into the non-bank system, the kind of risk but also opportunity it poses. The last time we spoke to him also for this series, which airs at 6 p.m. tonight, he talked a lot about that DeepSeek moment, and he said that it wasn't over. So we will revisit that with him today at 10 o'clock.
Again, you spoke with so many banking luminaries. Was there any big takeaway in terms of this moment? We've seen volatility, shock after shock for this economy. How are they adapting to this very different time we find ourselves in?
Some of them are pulling out the old playbooks. For example, episode 2, a little bit of teaser for the series as well. Next week, we'll have Boaz Weinstein. And we taped with him, I believe, the week of Liberation Day. So to hear more a little bit about how these luminaries are investing through volatility, you might remember Ken Griffin said he wished he held cash. But like Boaz, Nassim also works very closely with the tail risk fund. And so my big question is, how long will kind of the old techniques work for? Something they're all still watching out for. I'll use Ken Griffin's words on the tariffs in particular. It's not just whether this is going to become a regressive tax on the larger American society, but what it means for the midterms. A lot of people are already looking ahead to see how much the politics will change near term if you can look past the shorter horizon on the tariff negotiations.
I know we're really all excited for the debut. 6 p.m. tonight, Bullish, and now we have to watch because we need to know what Ken Griffin's relaxation tips are. Just another reason to watch. You already should be anyway. Sonali, thank you so much. Again, the premiere of Bullish with Sonali Basak airs tonight, Bloomberg TV at 6 p.m. New York time, and streams on Bloomberg Originals at 8 p.m., a show you do not want to miss. Coming up, we're going to get you set up for your trading day, some economic data on deck with retail sales. We'll have your trading diary next. This is your Bloomberg Brief.
Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Tuesday. We're going to get U.S. retail sales. That comes at 8:30 a.m. Eastern. That will be followed by the NAHB Housing Market Index. That comes at 10 a.m. It's also day 2 of the G7 summit in Canada. Of course, day 2 will take place without President Trump. Some individual movers for you this morning, moving in the pre-market session. T-Mobile, those shares falling more than 4%. There was a report that SoftBank raised close to $5 billion through a sale of T-Mobile shares. The idea of that sale pushing for AI for SoftBank. Enphase Energy, along with other solar stocks tumbling, this one down 16%. The Senate bill blueprint showed an earlier end to the tax credit for the clean energies, and Verve Therapeutics soaring 81% or almost 82% this morning. There's a report of a $1.3 billion Eli Lilly deal. Let me quickly show you what oil is doing, because we've done a round trip. We are unchanged nearly on the week, because yesterday we saw this big decline in oil. This morning we are undoing it, with Trump leaving the G7 early, saying he is in no mood to negotiate with Iran. There had been hopes of something of de-escalation, of a ceasefire. At least that was the word from the Wall Street Journal, reporting that Iran had been bidding for that, appealing to its allies, saying to the U.S., we will have nuclear discussions if you help us with a ceasefire. We'll have more of that coming up. Surveillance up ahead. That's it for your brief.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about over-regulation, frankly. And so as you look, what's happened is because the interpretations of AML, Anti-Money Laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
This is a year to adapt, and forecasts have been less relevant.
Let's not be too defensive. There's a real opportunity cost to being under risk.
You don't want to be short, but you do want to get a bit more defensive.
The pain trade overall still could be higher.
It's going to be potentially quite a volatile next year and a half.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance with all eyes still on the Middle East. President Trump leaving the G7 meetings in Canada a day early as fighting continues to escalate between Israel and Iran. Meanwhile, Fed officials beginning their two-day meeting in Washington, D.C. with U.S. retail sales data on deck later this morning. Where do you look? Markets right now are looking nowhere. They are quiet as they assess all of the potential risks. You have a little bit of a risk-off feel, especially given the fact that President Trump is heading back to D.C. S&P futures giving up some of the gains from yesterday, down 0.6%. What we are seeing, though, across asset is, yes, you are seeing some sort of decline, some sort of pullback in U.S. equities, although yesterday the rally was truly led by big tech. But you are seeing a bit into treasuries. 10-year treasury yields lower just a bit. You are seeing Brent crude higher as people assess the risk of some sort of escalation in the Middle East. Coming up, we are going to be speaking with Chris Verone of Strategas as a risk-off mood returns to markets. Stephen Cook of CFR as the White House looks to set up ceasefire talks with Iran this year, potentially this week. And Krishna Guha of Evercore ISI on a wait-and-see Fed. We begin this story with our top story. Israel and Iran entering a fifth day of conflict. This as President Trump leaves the G7 earlier. Joining us now from Canada is Anne-Marie Hordern from the G7. Anne-Marie, what do we know about exactly what triggered President Trump's departure a day early from the G7 meetings?
Well, it clearly has to do with what is going on in the Middle East and obviously the continued bombardment of Iran from Israel. The president, though, is keeping it very vague in terms of what he plans to do as he just arrived about an hour or so back in Washington, D.C. We do know that he is convening the National Security Council and he plans to spend the day in the Situation Room. He told that to reporters on Air Force One as he was heading from Alberta back to Washington, D.C. And the president has maintained a continued posture here at the G7, continuously saying that Iran can never have a nuclear weapon. Obviously, there's been a ton of speculation about what the president may or may not do, especially since yesterday, Lisa, he put out a Truth Social post that actually also moved financial markets, saying that everyone should leave Tehran immediately, evacuate Tehran immediately. So while he's kept it vague, we should also note he did say that he is not leaving to go back to D.C. to work on a ceasefire. Emmanuel Macron, the president of France, had suggested this, and he said that that's wrong. I'm not going back to work on a ceasefire between Israel and Iran. Quote, wrong. Macron has no idea why I'm now on my way to Washington, but it certainly has nothing to do with the ceasefire. Much bigger than that, whether purposely or not, Emmanuel always gets it wrong. So it doesn't sound like at this moment the president, and he also told reporters he's not in a mood to negotiate. So then the question, the speculation becomes, what is the United States doing? Right now, the U.S. has remained a defensive posture. We should look at the tea leaves. The president says Iran cannot have a nuclear weapon. We know Israel wants to get rid of sites like Natanz and Fordow. Experts have long said that that cannot be done without the help of the United States. A week ago, Lisa, the president convened his top national security military experts for a day of talks regarding Iran at Camp David. All of this is leading people to speculate potentially the U.S. could get involved at this moment in a defensive posture, not just defensively.
Yeah, and Anne-Marie, less than an hour ago, President Trump put out a post on Truth Social saying, I have not reached out to Iran for peace talks in any way, shape, or form, doubling down on what he put out there yesterday. This is just more highly fabricated fake news. Anne-Marie, aside from what's been going on with the Iran-Israel conflict and the U.S.'s potential role, what else has transpired in G7? I understand that it was really dominated by it, but this is the second time for G7 that President Trump has left early, in particular from Canada, at a time when there's a lot of question around how much the U.S. is truly looking to establish ties with traditional allies.
Well, what marks this G7 different than the one in 2018 when he left is that he left saying this was a successful meeting. I did everything I had to do. And he also left his Treasury Secretary, Scott Bessent, behind to continue having these talks with other world leaders. Clearly, trade was on top of agenda for other leaders that were coming here, trying to get a moment of his time. He did sign this trade agreement. Nothing really changed than what they announced a few weeks ago with the United Kingdom. And he presented that to the press alongside UK Prime Minister Keir Starmer. He did meet on the sidelines with the Japanese Prime Minister. And what's interesting here is that on the way back to Washington, he told reporters that Japan is difficult to negotiate with. And then on Canada, he thinks there could be some deal. He says that he has a tariff concept. Mark Carney has a different concept. But also coming into the talks when it comes to Canada, what was discussed also, Elisa, when you talk about geopolitics, the potential for some of U.S. and its allies, adversaries in the futures like Iran, when you have the Defense Department talking about how many intercontinental ballistic missiles they could potentially work on in the next decade, he said that Canada would be a part of the U.S. Iron Dome and they would pay up billions to be part of that project.
Bloomberg's Anne-Marie Hardern, thank you so much for all of the excellent reporting from Banff. Right now, let's get the view from Wall Street this morning. Joining us now is Chris Verone of Strategas, a Baird company. Chris, wonderful to have you. Thank you so much
for being
here.
Thank you.
Let's just start with this idea that stocks don't know what to do with all of this. Typically, geopolitical risk has been something you fade. You buy that dip because ultimately it doesn't usually have staying power. Does this time feel different?
Well, I think we're going to have to let the market be the judge of that. You know, this conversation began with you saying that the U.S. is in defensive posture. Well, is the market in defensive posture here? I think is the bigger question for when you look at the world through the lens of price action. And I think it's inconclusive. We have not seen the real overt rush to treasuries. We just talked about kind of a very modest or benign response from U.S. 10-year yields. Gold is well below the highs from not only mid-April, but from where it was just on Friday morning. Dollar has bounced, but only modestly. So I think it's difficult to embrace this view that there's some pervasive risk-off message streaking through markets. And then when you look through some of the leadership, the cyclicals have generally held in there. The Asian markets in particular are acting very, very well here. So I'm going to kind of lean towards the market's interpretation thus far, which is this is probably something you want to fade.
Well, there's this question of what does it mean to be defensive at a time where you've got different tail risks. You've got the potential for some sort of weakening in the economy, and then you have the potential for some sort of resurgence in inflation that really challenges maybe bond valuations, but isn't that pernicious for the stock market. Which is the biggest sort of risk that you see people defending against?
I think when you go back to early April, all the attention was on what the inflation risk would be kind of on the other side of tariffs. We just never saw it. When you look at the market's messaging, it was not very pro-inflationary messaging. Our concern was always that there was a bigger risk to the growth side of the equation. And that's why I think you got to be a little careful what you wish for here on bond yields. I know it seems comforting if you saw bond yields lower here. I'm not sure that would be the best message on economic growth. If nominal growth is running somewhere around 5, you probably don't want 10-year yields much below 4. So they're hanging out here in this 440, 450 neighborhood. The market is largely acting okay. Cyclicals are largely outperforming. I think we want to maintain that very status quo as much as we can here.
So at a certain point, you have to wonder, when do bond yields become a problem for equity valuations? We've been asking that a lot. You're making the argument that at this level, not only are they not problematic, but they're actually conducive to more gains because it actually suggests this positive outlook for the U.S. economy. Is this the sweet spot? Are we kind of in Goldilocks when it comes to the yield space?
I'm skeptical of the word Goldilocks when gold is also up, right? So I got to be a little careful with that. But I do think the real trouble often emerges when you have bond yields higher with defensives outperforming. So we have bond yields roughly where they've been for much of the year, but defensives are not working here. I mean, if you look at the staples, they're back on the relative lows. This morning in our own work, we wrote about the food and beverage stocks on their lows. So you're not seeing that traditional defensive messaging. On the other side, industrials have continued to hold their own. Financials globally are largely still okay. So I'm not seeing the disruptive message in leadership yet to suggest bond yields are a problem here. What frankly, again, what I would be more worried about is bond yields moving lower with defensives taking grip of this market, because it would run totally counter to the narrative that, hey, cyclicals need lower yields to really work. I would be a little bit skeptical of that view here.
And basically what you're indicating is this sense of sell America and how much this is a sell America trade and sell U.S. rates trade versus just simply something that makes sense based on the backdrop in the economy. What we saw today from the Bank of America Global Fund Manager Survey for June was that investors are the most underweight U.S. dollar going back 20 years. Does this mean it's a buying opportunity if you're a contrarian, or do you think that this is something that does have legs?
You know, you got to always be a little careful with the soft and anecdotal data and the sentiment work, and certainly that survey falls into that camp. But I'll add a little fuel to the fire. I was in London a few weeks ago, and I have never seen in 20 plus years of going there such emotional bearishness on both U.S. dollar and U.S. assets, where you do begin to wonder, is there some contrarian opportunity here? I think in particular where we're seeing sentiment maybe most one-sided is actually on Japanese yen. And I say that as someone who's been a Japanese yen bull, and I just want to be a little bit careful that almost everyone I talk to is also a Japanese yen bull. So just want to be a little bit careful that the kind of one-sided thinking on USD hasn't gotten so far extreme where you want to actually think about some contrarian opportunity. Now, that said, here we are in the middle of a conflict, and dollar really hasn't done anything of great note over the last 4 or 5 days. So it does speak to this idea that perhaps, to your point, Lisa, that we're in some evolving macro order where dollar or treasuries are perhaps not as defensive or don't serve that same role that they have for so many decades.
And part of this is because people don't understand what the main risk is, right? And we've been talking about this. Is it the downside risk to growth, or is it something that has more to do with the upside to inflation, which is a reason why I think a lot of people are looking at the pain point for oil. At what point oil prices rise to a big enough level where they affect CPI to potentially push off the Fed from cutting rates at a time when it could ultimately, longer term, be deflationary or certainly stagflationary at best?
Well, it's funny. This is why we have the core, right, on CPI. I think the irony of this moment is, or really all year, the appropriate word we thought all year, and you got to be so careful saying this word, is actually transitory. Everyone's afraid to say it because of what happened in 21 and 22, but when you think about tariffs, one-time price adjustment, or the move in crude, these seem like transitory events, not strategic or long-lasting events, but there's a reluctance, for good reason, for anyone to embrace that word. I think when you look at what the move in crude here is telling us, just remember one thing. We're entering a very weak seasonal period for oil. Basically, July through October, oil historically tends to be under pressure. So I would be careful chasing crude here. This was, frankly, bottoming and improving in our work the last 4, 5, 6 weeks. We've now had the move. We're into major resistance, call it 80, 82 on Brent, maybe 78 to 80 on WTI. I'm more inclined to fade it. I'm more inclined to go back to what the leaders in the energy space are, which are power and natural gas. What are the stocks in energy yesterday making the new relative highs? It's stocks like EQT and LNG and Range Resources. It's the gas-related names, not the oil-related ones.
You said the T word. That's pretty bold.
I know.
Chris Ferrone, you're going to be sticking with us.
I might regret that.
Even if you say the T word again, you're sticking with us for the hour, which we're very happy about. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. We start with the latest out of the Middle East. The Israeli military says it has killed one of Iran's most senior commanders. General Ali Shadmani had only recently assumed the role of chief of staff following the death of his predecessor in a prior IDF airstrike. Iran has launched around 370 ballistic missiles at Israel, killing 24 people and injuring almost 600, while Iran says over 200 people have been killed by Israel strikes. Meanwhile, President Trump left the G7 summit in Canada a day early. He returned to Washington early this morning, just hours after calling for the evacuation of Tehran. In a Truth Social post, the president said his departure had nothing to do with the ceasefire between Israel and Iran and that it's, quote, much bigger than that. But before leaving the G7, President Trump and UK Prime Minister Keir Starmer agreed on a deal to implement their tariff-cutting agreement from last month. The deal will slash U.S. tariffs on key British exports and raise UK quotas on certain American agricultural products. Aerospace and steel exemptions are also in the deal, though a quota on UK steel tariffs will be decided at a later date. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, Trump focusing on Iran.
Remember, Iran cannot have nuclear weapons. Very simple. Not to go too deep into it. They just can't have a nuclear weapon.
Stephen Cook of CFR joins us next. This is Bloomberg Surveillance.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Good morning, welcome back. Stocks having a little bit of a risk-off tone after some commentary from President Trump as he left the G7 a day early, focusing on Iran, saying there was a lot to do and saying it wasn't because he wanted to have ceasefire talks. Right now, futures down about 0.6% on the NASDAQ and the S&P. Russell 2000 down about 0.8%, taking off some of the gains from yesterday when people were looking at big tech. Under surveillance this morning, very much Trump focusing on Iran. Here is the latest. President Donald Trump returning to Washington, leaving the G7 early, saying the reasoning was, quote, much bigger than a ceasefire between Israel and Iran. Joining us now, I'm so pleased to say, is Bloomberg's Tyler Kendall. Tyler, what do we know in terms of what the reaction is like in Washington, D.C., let alone what exactly prompted President Trump to depart Canada?
Yeah.
Oh, yeah. Hey, Lisa, good morning. Well, when it comes to the reaction, we've heard from congressional lawmakers, for example, who want to have a say instead of just having the White House make unilateral decisions when it comes to this. For example, we're expecting a bipartisan group of lawmakers today to introduce what's known as a War Powers Resolution that would essentially give Congress some sort of vote or debate before the U.S. takes any military action in the region. Though, of course, we should say up to this point, the U.S. has assumed that more defensive posture, and U.S. officials tell us that that has not changed, though the U.S. military has moved assets into the region in recent days. Perhaps we could get some more details later on today, as we are expecting President Trump to spend the majority of today inside the Situation Room. He suggested that this is going to be a more secure way for him to make these calls and advance what he would like to see as negotiations compared to the setup that he had at the G7. He did touch down at Joint Base Andrews just about an hour ago, and he told reporters on that flight, as you've been discussing, that he is looking for something much bigger than a ceasefire. He has made absolutely clear that he wants Iran to abandon its nuclear ambitions. He said that the country would be foolish, in his words, not to make a deal. He also, Lisa, suggested that perhaps discussions could take place in person. It does appear that the White House does still feel that there could be a diplomatic off-ramp here. He did suggest that he could dispatch Vice President J.D. Vance or Special Envoy Steve Witkoff if talks do progress.
Tyler Kendall, thank you so much for that. Right now, we're going to be joined by Stephen Cook of the Council on Foreign Relations. Stephen, thank you so much for being with us. I want to start with your interpretation of what exactly prompted President Trump to leave the G7 meetings early.
Yeah, it's actually quite curious, given the fact that the Israelis seem to have this situation fairly well in hand. Israeli military leaders believe that they have about a week left to go through their target set. And the Iranian rate of fire on Israel, although continuing to be lethal, is diminishing. My sense is that the president's, the mixed signals coming out of the White House is the president trying to keep the Iranians off balance. And there is going to be a demand from the United States that if there is a diplomatic initiative, that Iran dismantle its nuclear program before the Israelis destroy it. It seems unlikely that the Iranians will agree diplomatically to voluntarily dismantle their program, however.
Stephen, and I realize this is going into the realm of hypothetical, but there is this question around whether the United States would get involved with bombing Fordo, which is their deep underground nuclear site that Israel can't really reach with their equipment. They don't have the bunker busters that the United States does. What would be the consequences of doing that in terms of the international reception, what that does to the potential conflict or reduce the nuclear threat?
Yeah, I think certainly if the United States were to bomb Fordo, it would reduce the nuclear threat. While there might be certain international outcry, I think that privately people would be relieved that the Iranians would be disarmed. But I wouldn't assume that the Israelis don't have any options themselves with regards to Fordo. They have been looking at this problem for quite some time, and they may, in fact, have figured out a way to pick the lock. They suggest that they will complete their tasks within a week, and that includes Fordo. So it may not be necessary to have a B-2 with 30,000-pound bunker buster bombs aboard, but we'll just have to see.
Stephen, it's Chris. When you think about why this president, or one of the reasons this president was elected, it was on less foreign engagement. Do you think taking a more active role in the Iran conflict here kind of puts that at risk?
Oh, well, certainly the president's America First outlook means reducing America's footprint in certain areas around the world. The president ran for office 3 times, in part because he was opposed to getting the United States involved in foreign adventures, particularly in the Middle East. However, he's been fairly consistent with regard to Iran's nuclear program since becoming the president, and has said that there needs to be an end to this program. And he did say in response to critics the other day that he gets to determine what America First is, not commentators like Tucker Carlson and others.
Stephen, I think one of the risks whenever there's a geopolitical event is you get very caught up in the first order thinking. What is the second and third order thinking here that maybe the consensus is not focused on?
Well, I think that the folks are focused on the actual conflict, and that makes a lot of sense, whether the United States is going to be involved, what that does to the markets. I think there's a longer-term goal here on the part of the Israelis that has been kind of nodded at and winked at, which is to weaken the regime in a way that makes it possible for Iranians to rise up and engage in regime change themselves. That would be a paradigm shift in the international system, and particularly in the Middle East. A changed Iran, perhaps a more benign government, maybe not, though would necessarily mean a very, very changed Middle East.
Well, we've dealt with this quite a bit, and let's build on this, Stephen, this idea of regime change in the Middle East. We've seen this movie before in various iterations, time and again, and it often doesn't go as well or as smoothly as people thought. How much do you see an actual viable leadership, aside from just some sort of rebellion among the Iranian people, a viable leadership in the wings ready to take over should the current leadership be deposed?
Yeah, I mean, this is what's so risky about this. Now, the Israelis aren't saying that they're engaged in regime change. They're saying they're going after the nuclear program. But it seems clear, based on what they're targeting and the kinds of things that they're saying, that they wouldn't mind if the Iranians rose up and changed their government. The Iranian opposition is hopelessly and woefully divided among itself. We have seen the Shah's son, Reza Pahlavi, raise his profile in the course of the last couple of weeks or so. But it will be a struggle to build a new, decent government in Iran. I don't think anybody believes that this isn't anything but an incredibly risky strategy.
Stephen Cook of CFR, thank you so much for spending the time with us this morning as we try to understand what the ramifications could be and whether the United States would be looking to get involved. Chris, you did raise that point, this question of if this president ran on America First, how does this sort of change some of the calculus? If you take that a step further in terms of second order, what does this do to the one big beautiful bill that we hear going on in Washington, D.C., some of the trade agreements in terms of, as an investor, what you focus on and how much that gets delayed as this takes center stage?
Well, I think just to kind of go back for a moment, when you think about what were the three tenets of the campaign, it was immigration, it was tariffs, and it was less foreign engagement. And he's 2 for 3 so far, and I think this is the one that's out there that potentially goes against what he campaigned on. So I would still be surprised, kind of when I look at the market's message, I would still be surprised if we entered this in any big way. I think the market's still treating this fairly benign at the moment. I think the harder question, Lisa, as you ask, is what does this do for all the other priorities that are currently on the table, namely trade and taxes? The timeline is not particularly generous here. We do not have a lot of calendar left in the congressional cycle here before we get to a point where this tax bill has to get done. So again, I think the market's message will be a kind of a key guide in that regard.
Just quickly, Chris, what would markets do if the U.S. did get involved?
Well, I think we'd certainly see gold to new highs. I do think ultimately things like treasuries would come back as a traditional safe haven. I am skeptical of the view that these things are no longer the safe assets in the world. I think that is way overhyped and way overblown.
And right now we are seeing a bit of a bid into treasuries amid some of the risk-off yield that we're seeing in equities. Yields lower just a touch as the Federal Reserve begins their 2-day meeting. You do have the sell-off in futures, just a touch, taking off some of the heat from yesterday. Coming up in the next couple of minutes, we've got Krishna Guha of Evercore ISI on a wait-and-see Fed. They don't have the luxury of any kind of visibility like the rest of us. This is Bloomberg Surveillance.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appeared, immediately I asked whole corporations study how will you bring generative AI to their job.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince.
Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
A little bit of edginess this morning as people assess exactly why President Trump departed G7 meetings early to go back to Washington, D.C. to get into the Situation Room to really understand and navigate what's going on in the Middle East. You're seeing stock futures off about 0.6% on the S&P and NASDAQ, down 0.8% on the Russell 2000. 3 hours away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with solar stocks absolutely plunging after Senate Republicans unveiled a bill that would end tax credits for wind and solar by 2028. That's years earlier than for other energy sources like nuclear. So as a result, you are seeing Sunrun down 27%, while Solar Edge Technologies and Enphase Energy are also down. That's because analysts have already warned that ending these tax credits would decimate the solar industry, though I will add that the bill could still change. Next up, we have shares of T-Mobile. They are down 4.7% now after SoftBank unloaded 21.5 million shares of the wireless provider at a slight discount in one of the biggest U.S. stock sales this year. The nearly $5 billion haul will help fund CEO Masayoshi Son's massive push into AI, including a potential investment of $30 billion into OpenAI, but coming at the expense of this stock today. And take a look at shares of Verve Therapeutics. They are absolutely soaring, up 78% on an FT report that Eli Lilly is in advanced talks to buy the gene editing startup for up to $1.3 billion. That deal would double Verve's market value and give Lilly access to a promising cholesterol treatment at a time when it's trying to expand its pipeline beyond those blockbuster weight loss drugs. Lisa?
Thank you so much, Yahira. I guess it's Merger Tuesday as well as Merger Monday. On our radar this morning, President Trump leaving the G7 early as Israel and Iran enter a 5th day of attacks. Conflicting reports about why he left, leaving markets on edge. The president saying it's bigger than a ceasefire. Chris Verone still with us of Strategist. And Chris, I have to wonder, as the markets game out how this looks, is the biggest risk some sort of blocking of the Strait of Hormuz, the idea of free oil flow, or is it the United States getting involved with a lot of unpredictable ramifications?
I think it's more the latter as the bigger risk. I mean, I went to bed last night expecting to wake up this morning to see futures down meaningfully, to see treasuries very bid, to see oil through the highs, and none of that here has played out. And what we wrote to clients late last night and again this morning is very simply, pay attention to Friday's intraday highs when the news kind of first broke. VIX, I think, was 22. High yield CDX was 350. Crude was, 77, 78. I think those are important kind of near-term thresholds to get an understanding of whether the market sees a real risk starting to materialize from here.
And I think a lot of people are watching to see what transpires in the Situation Room and how much it distracts from some of the other agenda issues. And this is something we were talking about earlier. President Trump and UK Prime Minister Keir Starmer reached an agreement to implement some elements of the trade deal announced last month. The U.S. will slash tariffs on key British exports, and the U.K. will raise quotas on certain American agricultural products. An immediate cut on steel tariffs, which was a key British demand, was not included in the deal. Chris, how much are we learning about what the red lines are, about whether the United States will drop tariff rates below that 10% sort of floor, about how quickly we're getting some sort of resolution ahead of a deadline that's fast approaching?
It's a deadline that's fast approaching, which is unique for markets, the idea of a deadline, because you think of markets as discounting type where all the information is known or processed before the deadline approaches. So you kind of wonder how this deadline is going to play out. I think when you look at the UK deal, I think the issue that the UK here has is the currency is just too strong. And for an economy that's probably in a weaker spot than we are, where bond yields have gone up more in the UK, plus a strong currency, that's not the best recipe for some economic revival in the UK here.
So at a certain point, do you see this as being a sticking point increasingly for countries that are getting challenged by having a stronger currency at a time where the U.S. is arguing for more trade deals, but also getting benefited by the fact that the dollar has weakened so substantially this year?
Well, I think it highlights the risk we talked about at the beginning of the show, that sentiment on dollar is just so one-sided here, whether you look at the BAML Fund Flow Survey or whether you look at our own work. It's about as extreme as I've seen in 20-plus years of doing this. So I do think dollar shorts at least should be open to what new information could hurt them here. I think in particular, frankly, I think the most important kind of part of the trade agenda is what happens in Japan here. Because you have the BOJ in an interesting spot here. And they just finished a two-day meeting. Rates were pretty benign coming out of that. Yen was pretty benign coming out of that. But we have seen massive strengthening in the yen over the last year, from this time last summer, 160 to call it 140 and change right now. I think that is really the big elephant in the room.
Which is the reason why maybe you saw a bit of a dovish tone from the Bank of Japan overnight. The three prongs of the stool, as we're talking about trade, we're talking about the bill in Washington, D.C., and of course, we're talking just in general about how we get sort of GDP up in some sort of substantial way. Senate Republicans plan to cut trillions of dollars in taxes in their version of the president's big, beautiful bill to offset the cost. Senators are looking to repeal some clean energy tax credits and scale back Medicaid benefits even further than the version passed in the House. How much, Chris, can we actually take a look at this and game anything out in terms of deficit, in terms of spending cuts for states, versus just sort of discount this as a negotiating tool for now, ignore, focus on other things until this gets into a more baked form?
You know, I still think for the market, this is probably the biggest game in town here. Just frankly, the timeline is short. Now, remember, this will have to go back to the House when all is said and done here. I do think if we're trying to arrest the potential of some economic slowdown, the bill has to be kind of most important on the list of things going on right now. And, you know, one of the reasons we think we have seen this kind of renewed life in cyclicality in some of the cyclical groups is anticipation that this gets done. So, you know, very important for our view and for our call that, hey, the economy is okay here, that this bill gets done sooner than later.
And something that the Fed is going to have to take into consideration as they begin their two-day meeting, which is kicking off today. The FOMC widely expected to hold rates steady, but it does plan on updating its economic forecast. Krishna Guha of Evercore ISI joins us now. Krishna, are we expecting to hear absolutely anything other than we are in a dark room with a blindfold, bumping into chairs just like the rest of you?
So I'm afraid you probably are going to get a lot more wait and see, a lot more to learn. You know, it's that sort of guidance from Fed Chair Powell, consistent with the idea that unless something radical changes, not only is nothing happening at this month's meeting, but nothing's going to happen in July either. And then really in September, we have that decision point for the Fed. Has it seen enough to want to cut rates at that point or not? I think what the market will be focused on at this meeting is really the extent of the updates in the Fed's forecast, and in particular, whether policymakers are already shifting towards just a one-cut baseline rather than two cuts for this year.
Krishna, how much does it really matter? Because right now the Fed seems highly uncertain, very much on the fence. Their sort of strategic analysis is shape-shifting depending on the day. And we're seeing data that hints at something of a labor market softening that's caused a lot of people to be a little bit concerned. I'm talking about continuing claims. We're going to get retail sales in just under 2 hours' time. How much is that almost more important than the rhetoric that we hear out of the Fed right now?
So I think you're certainly right. But first of all, The real action here is on the Trump economic agenda, above all trade, but also immigration, fiscal, you mentioned, regulatory, other policies. And the Fed, to a large extent, is responding to those shocks and learning from the economic data how they are impacting economic activity. So, yes, the Fed is going to take its cue from, first, the path of policies like trade policy. Secondly, how this is filtering through the macro data, the market data. But it does matter what reaction function the Fed is sketching out that it will apply in these different economic circumstances. There's a relatively easy case where the labor market doesn't weaken at all. Well, why are you cutting in a period when inflation is going to move up under these tariffs? Conversely, if the wheels come off the bus in the labor market, for sure we know they're going to be cutting, even though there's going to be elevated inflation, provided the expectations remain well behaved as they are right now. The question is, in this middle zone, in this gray zone, how are they thinking about, what would constitute a materially enough weakening of the labor market to want to cut, to lean against that getting any worse? And also, what do they think they're learning from the most recent data, which certainly is imperfect in the way you describe, but I'd say for May, overall, top tier, employment report and inflation, both a little more benign than might have been expected.
Hey, Krishna, it's Chris. Can you talk just for a moment about kind of this divergence between the market rate and the policy rate? We've always joked in our work that who needs Fed speakers when you have the two-year yield? Is there a level on the two-year yield down where you'd say, okay, the Fed is now behind the curve and kind of needs to get back in the easing cycle maybe faster than you thought?
Yeah, so that's a very good and important distinction to draw, right? The Fed obviously sets the overnight funds rate, but it's the 2-year, 5, 10, and so on rates that are much more important for the economy as a whole. And of course, those will also embed information as to how market participants are thinking about the outlook. What I would say is that the Fed doesn't try to micromanage, the 2-year yield. It couldn't, even if it wanted to. And so I don't think that it's so wildly out of whack right now with what Fed officials might be thinking on a probability-weighted basis. Because remember, the market isn't just pricing the baseline case, but they're pricing a range of risks, including the risk that we do, after all, end up falling into a recession. The Fed has to cut a lot. So right now, I think the Fed will be comfortable to let the market operate as a little bit of an automatic stabilizer. Rates going down in the market when the news is weaker, rates moving up when the news is stronger or there's signs of some more inflation pressure. They're not yet at the point where they would feel the need to make a call on rates themselves in terms of the Fed funds setting.
Krista, do you think kind of in the spirit of the Fed might not make the same mistake, they might make new mistakes, that 2021, 2022 is coloring their thinking too much on this idea of kind of the inflation risk? Maybe in a lot of respects, the appropriate word to use today, and we talked about this earlier, is actually transitory, given that tariffs are a one-time price hike or oil, yet they're so reluctant to do that because of the recent experience.
So look, at some level, I think you're right? Everyone fights the last war, and the Fed can be guilty of that too. There's no question that the fact that the Fed went out with a transitory story and lived to regret it last time is, I think, coloring their thinking some this time too. But there are two important sort of objective considerations there that do weigh a bit in this direction. The first is that these tariffs are not simply on end products, they're also on intermediate goods, inputs into U.S. production. And it's those tariffs on intermediate goods that the economic research tells us can have more persistent effects on inflation, not just a one and done sort of, if you like, tax increase effect. The other thing is that the Fed does have reason to wonder whether inflation expectations, wage bargaining, price setting behaviors are quite as well locked down now after several years of elevated inflation as they were previously. And these starting conditions, economists will use the term initial conditions, do matter in terms of your risk management judgment.
Krishna, just real quickly here, if I were cynical, I would think the Fed would just err on the side of being more hawkish in order to keep some of the inflation expectations restrained. Why isn't that the case, that we can basically expect them to say something that is going to be hawkish whether they think it or not?
So I think they are are mildly hawkish. I mean, after all, they're telling us that they judge that the current setting of policy is moderately restrictive, modestly restrictive. The individual officials use different terms, but restrictive. Why is it restrictive? Well, it's restrictive precisely because, as you say, they want to try to lock down inflation expectations into the initial sticker shock from the tariff price increases when that comes. And as I said, it hasn't really shown up in May. We do expect it to show up more over the next few months. Near term, that's certainly hawkish, but I think it's also important to understand that the Fed recognizes that a precondition for being able to cut rates in response to labor market weakness at a time when spot inflation will be high because of the tariffs is that you have to make sure that you've locked down the inflation expectations first. So yes, it's moving in order of priorities, lock down the expectations first, then look at business cycle management. But if they get the first right, they will have the flexibility to do the second if it's needed.
Krishna Guha of Evercore ISI, thank you so much. Really insightful.
Thank you.
As always. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. The Bank of Japan held interest rates steady at 0.5% and unveiled a plan to slow bond buying. The decision follows recent sharp moves in JGBs that rippled across global debt markets. BOJ Governor Kazuo Ueda saying that tapering bond purchases too quickly could have a negative impact on the economy due to abnormal volatility in yields. Meanwhile, Russia has carried out one of its deadliest attacks on Ukraine's capital this year. At least 14 people were killed in Kyiv and another 44 injured as Russia unleashed hundreds of drones and dozens of missiles across the country. It's the deadliest attack on Ukraine since at least April. And Copenhagen dethroned Vienna as the world's most livable city in The Economist's Global Livability Index for 2025. And here's another reason you'll want to check out Denmark. It dominated Scandinavia's culinary scene last year with 38 of the region's 96 Michelin-starred restaurants. That kind of felt like an ad. That's your Bloomberg Brief. Lisa?
Well, Yahaira, if that was an ad, I will say that was the topic of conversation last night at the dinner table in Casa Abramowitz. Up next, a shock to oil.
It really all does depend on oil. If oil prices change their trend from being in a downtrend over the course of the last 3 years to start to trend higher, this is when this turns from being a contained geopolitical risk to being something that will have a more lasting impact on markets.
Joining us next, Nitin Kumar of Mizuho. This is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
It's the world world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Futures selling off just a touch ahead of the open here. Less than 2 hours away, we are seeing stocks down about 0.7% on the S&P and NASDAQ. Under surveillance this morning, something we're very focused on, a shock to oil.
It really all does depend on oil. If oil prices change their trend from being in a downtrend over the course of the last 3 years to start to trend higher, this is when this turns from being a contained geopolitical risk to being something that will have a more lasting impact on markets. Because we're dealing with exogenous shocks, this is a big issue for inflation readings. It hamstrings the Fed, and it causes pressure on the consumer.
Here's the latest. Crude prices gaining yet again as fears escalate that the Israel-Iran conflict may disrupt oil flows. Nitin Kumar of Mizuho writing, while it is too early to change our cautious outlook for global oil prices from oversupplied markets, the move has increased the short-term risk premium in oil prices. Nitin joins us now. Thank you so much for being with us. We are seeing oil prices up yet again, touching some of the highs that they reached 2 days ago, when or 2 sessions ago, when the conflict was much fresher in people's minds. What are we currently pricing in when you look at crude prices at $73?
So I think, thank you for having me, by the way. So I think right now we're really pricing in the risk of an elevated risk. If you look at what happened on Friday, the market obviously was shocked by the Israeli action. But then on Monday, we retreated a little bit as things seemed like they were not escalating as quickly or perhaps as dramatically as people feared. Historically, what we have seen is that in events like this, oil can go up from somewhere between 7 to 8% on average. That would mean a range of around $5 to $10 above where it was trading before the conflict escalated. So if this continues for a little bit longer, we can see maybe $80 oil, which would put us in about the $10 range. And then really it depends on the path of the conflict from here on out. You know, there's a lot of scenarios. I don't want to get into the doomsday scenarios, but then you could see oil higher. But what we are really focused on is the path that this conflict takes, and we don't want to call the end of the down cycle in oil from the supply and demand perspective, but we're waiting and watching and seeing how it plays out.
Nina, talk for a moment just about the shape of the oil curve here. I think at one point on Friday, backwardation to the degree of maybe $7, $8 between front and 12 months out. How do you interpret that as a message for what the longer-term trend in spot is?
Well, the longer-term trend in spot has been downward. There's been backwardation for most of this year. I think this is a spike in the short term. I think investors and markets are not prepared for a true escalation. You know, with the scenarios you talk about, closing the Straits of Hormuz or land war or U.S. involvement, things like that. I think people are putting a very low probability on those kind of events yet. So then you see the fundamentals take over. You still have OPEC Plus adding barrels. At least they've said they would do that. The U.S. is going to slow down. Our view is that it's not going to decline in production. It's just going to flatten out. You still have certain parts of the world that are producing more oil. So I think the market is used to, unfortunately, over the last 4 or 5 years, this little elevated risk on the front end of the curve, but they are really watching. I think our view is that Brent is somewhere in the $70 to $90 range, with 90 being times when things are a little bit hot out there, and 70 being when things are a little bit more calm.
On the sentiment front, last I checked, positioning is still very, very light. Do you think that contributes to, what could be a surprise to the consensus in higher prices?
Absolutely. So Going into this conflict, I think most investors were positioned for oil to have a downward move in the second half. You expected to see OPEC barrels hitting the market. Even though we're not calling for a recession at Mizuho, demand is robust, but it's not spectacular. Million barrels, maybe a little bit more than that. So the view was that the market would be oversupplied. You could see almost 1 million barrels of oversupply by the fourth quarter, depending on the OPEC path. So I think investors are largely positioned for a move down. They've stuck to quality. They've stuck to names that know how to ride out a recession or a downturn in oil. Natural gas has been the favorite play, as you know. So I think this could have the impact of shaking people loose, but it's too early. We're only in, I think, day 3 or trading day 3 of this conflict.
We've had a lot of volatility in the oil markets for a long time, but particularly over the past 5 years. What have we learned in terms of when oil prices get high enough, they become somewhat self-limiting in terms of just the supply-demand dynamic?
Absolutely. So there's no cure for higher oil prices than higher oil prices, right? So you could see demand destruction. You could start seeing...
At what level?
It really depends on the time it takes to get there. You know, if you get to 100 very quickly, you're not going to see a lot of demand destruction. I mean, people have already made plans to probably drive around in the summer and things like that. But over time, absolutely, if it stays at 100 for a while. The other impact is supply, right? The U.S. is slowing down, as I said earlier, the growth profile. But we have a lot of reserves. They could choose to at $100 oil, a lot of shale reserves could be very economic. We could incentivize exploration offshore. So depends on the time frame, how long it stays. If it's $100 for 3 months, I don't think it destroys demand or incentivizes supply. If it's there for a year, absolutely.
Nitin Kumar, thank you so much for being with us today. Nitin Kumar of Mizuho. Chris, do you change your driving plans depending on what you see in terms of the gas board?
I do not.
I will say though, it does affect though the psychology when you see that. I mean, it is a billboard for inflation. You know, it might as well just be say, you know, hey, this is what consumer prices are doing. Yeah. It does affect things.
Yeah, it certainly does. And I think maybe the one question here, kind of in context of our broader discussion about the administration, is when does now, if it's higher rates and it also becomes higher gas prices, when does that start to weigh on some of the agenda?
And that's the reason why this complicates what the Federal Reserve is dealing with in the 2-day meeting. Chris Ferrone of Strategas, a Baird company, thank you so much for spending the full hour with us. Coming up next, we've got Alicia Levine of BNY Wealth, former senior Trump trade advisor Kellyanne Shaw, the son of the last Shah of Iran, Reza Pahlavi, and Saab CEO Mikael Johansson, as we try to game out how CEOs are thinking about such an incredibly uncertain moment right now in markets, taking it in stride, although a bit off balance, just given the fact that there does seem to be some sort of escalation in the Middle East. Futures down across the board. Bond yields also down, prices up, with a bit of a bid into that haven trade, 4.42% on the 10-year. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I never doing that again.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Our call has been the Fed shouldn't cut.
I don't think that you can expect much from the Fed this week.
We're not in a weak economic backdrop. The Fed's going to have time to evaluate.
They will continue to sit on their hands. They'll continue to say we're being patient.
It's at least going to look like the FOMC is prioritizing inflation over the labor market.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Questions swirling about the U.S.'s involvement in the escalating Israel-Iran conflict. As President Trump heads back to D.C. a day early from G7, the Fed beginning its 2-day meeting in Washington, D.C., trying to assess all of these risks. And U.S. data on deck with May retail sales as we try to understand what the consumer is doing with all of this uncertainty. John is off this week. I'm so pleased to say that Danny Berger is with me for the next 2 hours. And Danny, it is just striking to see the market's getting whipsawed, at least on the margins, by this sort of tit for tat that we see on Truth Social, on Twitter, about what may or may not be happening.
Exactly. It's a market that without those various posts or various speeches coming in, it wants to rally. You really get that feeling. Yesterday, we were just 2% away from all-time highs, which I'm going to be honest, feels kind of crazy when we still have trade negotiations going on, the big, beautiful bill, and of course now Iran and Israel. Just the comments from President Trump, him leaving early, shows how dangerous it is to get complacent, that they can be pushed around really easily.
You know, if that hadn't happened, we'd be focused on retail sales. A lot of people saying that this actually is a key read on the U.S. consumer and just how resilient they are to some of this uncertainty. How do we sort of weigh this at a time where the Fed has to now look at the potential for oil prices to increase and potentially some disruption in the Middle East as yet an additional shock that they've got to take into consideration?
It is a Fed's own model that says for every $10 increase in oil, you see both a similar uptick in both inflation and a downtick in growth, something like 0.4%. It already adds, to your point, to calls for stagflation. So what is the Fed going to concentrate on? What are we going to get? To your point that you've been speaking about all this week, maybe it is nothing. Maybe their hands are tied with the blindfolds on.
Right, and though how they really see scenario analysis is going to be important. Coming up, we're going to be talking about that as we look at futures that are lower by about 6 or 7/10% throughout the morning. We do see that retracing just a touch. We are seeing a bid into bonds, yields lower by about 3 basis points on the 10-year, 4.42%. A bit of euro strength. We've been seeing it kind of hover around this range, 115.70 versus the dollar. Crude prices up once again, and this is important. as we do sort of wonder what exactly is going on. Is this a push for some sort of conciliatory measures, or is this some sort of escalation in the conflict? Coming up this hour, we've got Alicia Levine of BNY Wealth as stocks look for a second day of gains, maybe, although taking off some of that right now. Former NEC Deputy Director Kellyanne Shaw on the latest trade negotiations. And don't miss this, the son of the Shah of Iran, Reza Pahlavi, as President Trump calls to evacuate Tehran. We begin this hour with our top story, President Trump leaving the G7 summit early as the Middle East crisis escalates. Anne-Marie joining us from the G7 in Canada. Anne-Marie, what have we learned in the past couple of hours in terms of what President Trump will be doing and what the response has been in Washington, D.C. to this early departure?
Well, the president is now in Washington, D.C., and he said he was going to spend the morning in the Situation Room with his top national security team, foreign policy advisors. The president made it clear to reporters traveling back from Canada, from the G7 to Washington, D.C. overnight, that he wants a real end to what is going on, more than a ceasefire, something that is a real end. An end, a real end, not a ceasefire, an end. That was the quote he gave reporters. So what exactly does that mean? It's been kept very vague, but the president has made it clear Iran cannot have a nuclear weapon. So obviously there's growing speculation that the United States, which of course has a defensive posture in the region and has been aiding Israel when it comes to the defense of the Iranian missiles being sent over, the question becomes, will they join offensively? Experts have long talked about the fact that if he wanted to eradicate Iran's nuclear strategy, you'd have to go after Natanz and Fordow, two of these sites, and many just believe Israel does not have the capabilities to do so, and they could not do so without the U.S. help. That has been a growing question over the course of the last few days as these two countries have continued to strike each other, but so far the U.S. has not entered in an offensive way. The president, though, over the weekend, before he was at the G7, said it was, quote, possible. So this is what everyone is going to be watching today, with the region and Washington, D.C. on high alert.
Yeah, Anne-Marie, thank you so much. And certainly everyone in markets is watching this closely as well. On Wall Street, Alicia Levine of BNY Wealth writing, absent a sustained rise in energy prices, we do not see geopolitical risk affecting markets more than the immediate trade. Alicia joins us now. It's sort of the classic geopolitics by the rumor, right? It's sort of the idea of any kind of sell-off is a buying opportunity, considering how long this typically lasts. Does it feel like there could be something different this time?
So yes, there could always be something different, and these things can always spin, and it's a dangerous part of the world, and there's some nasty weapons there. And I would suggest, I think we were talking about all this was hitting at 9 o'clock last night, hard to go to sleep for an early morning show, and yet we woke up and nothing happened. Maybe it's clear that there's some strategy here as yet unknown. And look, in the end, we've done a study of all of geopolitical hot conflicts, crises, going back really to the 1950s. And what you see is that absent a sustained rise in energy prices, the immediate trade of risk off, markets down, really gets priced out of the market after 3 to 6 months. The only way it's really sustained as an investing issue is if you get real yields higher and energy prices sustainably higher. I would suggest that energy, in the low 70s is not there, and actually shockingly low. If I had given you a set of facts a few months ago, this is going to happen, where's energy? I don't think any of us would have settled on 72 for WTI.
Right, there was this very muted response in markets. And what didn't happen might have been more instructive than what did happen. You didn't get a sell-off in a risk in a massive way. You didn't get a bid into the dollar in the way that you'd expect, or into long-term bonds. How much is that instructive of the path ahead in terms of what does and does not work as a haven asset?
Well, I think that was the most surprising thing of all. It wasn't really that the S&P was indicated down 2% on the open on Friday. It was that there was no bid for bonds and no bid for the dollar, suggesting the dollar is actually probably going lower, because this is the setup where you would see a rush to safety, and it wasn't there. So that's really interesting as well. But also, it does go along with the thought that markets are actually doing what they did before, right? You don't see any real interesting trade here coming out of this. It's been 2 or 3 days. Let's not get complacent. We could have, interesting dynamics happening, but essentially it's the same trade. And to your point, we're sitting here at the S&P over 6,000. The headlines are terrible, okay? The pictures are worse, and yet the market wants to go up. And so I think this is where we are. Now, it can change, but again, stepping back, geopolitical risk is not an investable thesis unless you're a trader. And even the traders didn't really get what they needed out of this.
With stocks above 6,000, how much of that is conviction that we're okay, we're resilient, versus lack of any conviction? So you kind of just go with the same playbook that you've been talking about.
So I think there's a lot of lack of conviction. What we saw was that, retail coming in and buying the dip, because actually that has worked. For the last 5 times where the market has fallen 20% or more, going back to 2016, buying the dip was always the right move. I'd say there's a conviction that earnings have stopped moving lower. And if you look at the forward 12 months on the S&P earnings, they've inflected higher slightly, but they've stopped declining. And 2026 is stabilizing as well for earnings. So, in the end, markets multiple times earnings, and if your earnings have stabilized and moved higher, then the market's fine. Having said that, it's not an inexpensive market. We're looking at 22 times forward earnings. So we're back to where we were in January with a different set of risk and a different set of facts, which look worse. So we probably have some volatility over the summer, because summer's never a great time for risk assets. It just isn't. But ultimately, it's not mispriced here. Is what I'm trying. It's not mispriced. You can always, you could always get a sell up, but it's not mispriced.
But even with that return to January, it also feels what's faded to the wayside was this whole narrative of sell America, broaden out, go to Europe. There was the most recent fund manager survey from Bank of America that they reckon over the next 5 years, global stocks will beat U.S. stocks. Do you still lean into that trade, that it's time to move away from American equity?
I love that you asked this question, because our answer is an emphatic no. And in fact, we actually put out a piece about, we think the sell America and the American exceptionalism is dead trade is essentially very short-sighted. And it's a tactical trade for the year, because U.S. growth is slowing a little and Europe is growing a little bit more with the dollar weaker. Other markets look more attractive, particularly as you get that rotation out of the, so that makes sense. But to fade the U.S. market, and we say this in many different ways, but let's just say very clearly here, to fade U.S. markets is to fade the AI revolution. And that is the big picture. So the productivity of U.S. companies will move higher. The margins on U.S. companies will move higher. Don't see AI, aside from China, coming out from the rest of the world. And so you're in an ecosystem here that is going to be nurtured and funded by capital markets, by venture, by privates, and by public capital. And this is where you have to be. It is a long-term view. Yeah, I mean, look, in the end, we're all judged by how we do by the end of the year. So obviously, there's going to be trading around that. But ultimately, for a strategic view, you must be overweight the U.S. versus rest of the world. I love that everybody's so negative, because I like the contrarian trade. I just don't see it as reality. Think about Europe, 27 countries, collective action problem. How in the world are you going to make corporates more productive in that situation?
This is a very impassioned argument for U.S. equities. It is not an impassioned argument for either the dollar or for rates. And this raises this question of whether you're talking specifically about specific companies that have technological advancement that is appealing to people around the world, but not the United States per se, as we can see, with potentially a weaker dollar and potentially more of a yield premium on treasuries.
So I think the long end still presents a problem for investors, but again, that's also become something of a one-way trade. Obviously, the discussions in Washington have been disheartening to the bond market, but yet yields are not running away here on the 10-year. We're still in that range of 430 to 460. So despite the concern of long duration in a world where we're running $2 trillion deficits, it's not running away yet. Now, obviously, there's some term premium in what's going on with the deficit. It's going to have to be addressed. And ultimately, it is a conflict between growth in the economy and bringing down the deficit. Very hard for any politician to really make that decision. Ultimately, we think Washington will have to start addressing this in some form because this is impossible. So I do think the dollar goes a little bit weaker here, just because if you're moving out of U.S. assets, moving out of the U.S. Treasury market, dollar will go weaker as well. I don't think that's fully sustainable. I just don't. I think it's a one-way trade right now, and everybody's so negative. And we've been in markets long enough that we know when there's a one-way trade, it tends to go the other way.
And to Danny's point, the Bank of America Global Fund Manager Survey made the point that maybe the best contrarian trade is to go long the dollar. Alicia Levine of BNY Wealth is sticking with us right now. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anna and Yahaira.
Hi, Lisa. Turkish President Recep Tayyip Erdogan ordered officials to increase production of medium and long-range missiles in light of the current Israel-Iran conflict. Today marks the 5th day of fighting in the conflict, raising fears about the war spreading to neighboring countries in the Middle East. Meanwhile, Warner Brothers Discovery and CEO David Zaslav agreed on a redesigned compensation package to take effect when the company splits in two. The agreement will significantly reduce his annual salary after the split, when Zaslav will become CEO of the streaming and studios business. And American Express teased that updates are coming to its travel-focused Platinum credit cards later this year. It called it its largest investment ever, but did not provide specifics on the changes, which will apply to both U.S. consumer and business Platinum cards. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, the Senate's take on the tax bill.
There's room in the spending proposals for Senate review and Senate changes. But it's not like you're going to tear the whole house down and build a new house.
Former senior Trump trade advisor Kellyanne Shaw joining us next to continue the conversation on Trump's economic policy, both the prongs of course, what's going on in D.C. with the bill, as well as trade. This is Bloomberg Surveillance.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance. A bit of a risk-off tone returns to markets as they assess exactly why President Trump is returning to Washington, D.C. and what that means for the conflict in the Middle East. Coming off some of the earlier lows, S&P futures down now just 0.5%, continuing to retrace some of the losses as the morning grinds on. Yields lower about 3 basis points, 4.42%. Crude up almost 2%, $73 for traded on the NYMEX, with a question around whether you could see some sort of disruption to oil supplies. Under surveillance this morning, the Senate's take on the tax bill.
There's room in the spending proposals for Senate review and Senate changes. But it's not like you're going to tear the whole house down and build a new house. Mike Johnson and Leader Thune are working hand in glove with the Trump administration. I hope the Senate can make progress so that we can deliver that bill to President Trump before Independence Day in just a few days.
Here's the latest. Senate Republicans proposing cutting trillions of dollars in taxes for households and businesses. In their version of President Trump's signature bill, the plan would also scale back Medicaid benefits and add to U.S. deficits. Bloomberg's Tyler Kendall joins us now. And Tyler, it feels like a bit of a head-spinning moment where we're talking about the idea of the conflict in the Middle East and questions around trade. But before we get to trade, I am curious what we've learned in terms of the clash between the Senate's version of this bill and the House's.
Yeah, hey, Lisa. Well, there is a clash between the Senate and the House, and there's actually a clash within the Senate, not to mention that this current version is also going to put the White House in a politically fraught position, and that's because it does have more aggressive changes when it comes to Medicaid. There's going to be stricter work requirements according to this draft plan unveiled by the Senate. It also lowers the Medicaid provider tax, which essentially would amount to less federal matching funds, and Senate leaders say that this is necessary in order to offset some other priorities, including what would potentially be for certain clean energy funds, those tax credits being rolled back slower than originally imagined. That's going to upset the House. Not to mention, it also makes permanent some of those business tax incentives that we saw, such as the R&D deduction. This is something that the White House actually didn't want to see. U.S. officials tell us that President Trump liked the idea that these tax cuts were front-loaded and set to expire early because it would bring a spurt of investment when it comes to the near term. There are other things that we've been closely watching, of course. The Senate plan scales back Section 899, the so-called revenge tax. We know the House had wanted a more aggressive plan. It also lifts the debt ceiling by $5 trillion. That's an extra trillion that the House was not accounting for. But of course, the biggest sticking point still here between the House and the Senate, Lisa, is that there is a placeholder when it comes to SALT, essentially indicating to us that those negotiations are ongoing, even as those Republicans from those high tax states in the House say that that $40,000 cap that they agreed to is not up for negotiation.
Tyler Kendall, thank you so much. The tax bill is part of President Trump's three-legged policy stool. Another leg that could potentially offset some of the deficit concerns are the tariffs and the revenue that could be possibly brought into the United States. Former senior Trump trade advisor Kellyanne Shaw joining us now. Kellyanne, I'm curious what we've learned, in particular from the trade discussions over as part of the G7 meetings in Canada, particularly when it comes to the UK and the US. How much of a template is that?
Yeah, good morning, and thanks so much for having me. So the big announcement regarding trade at this year's G7 was, of course, that UK deal on auto parts, on auto imports, and then aerospace. And then the executive order that the White House issued last night to accompany the deal also teased out that there would be relief on steel and aluminum for the UK at some point in the future, but the details still forthcoming. So what this shows is the UK is still very much front of the queue ahead of any other government. The next closest we got was an announcement by Prime Minister of Canada that the U.S. and Canada would be negotiating a deal within the next 30 days, which is a bit longer than we were originally expecting, but at least it's an agreement to agree.
Kellyanne, we also saw no deals from the likes of Japan, for example, and I'm sure the Prime Minister there would have liked to have seen something. And also the ability to reach a deal was cut short with the president leaving back to Washington, D.C. With a new hot war for President Trump to deal with and to think about, does it show the limitations of deals being led by the president? Will this ultimately slow down the timeline?
Yeah, and I thought what was interesting about the early departure, and obviously there are things flaring up in the Middle East that required his attention, was that the two deals that I thought could come together this weekend that were left on the cutting room floor, in addition to Japan, would have been India and Mexico, a deal on steel and perhaps fentanyl. He was set to meet with both Modi and Sheinbaum today. Those meetings, of course, won't happen. But I do think what it shows is some competing priorities. But look, he's got an entire team who is dedicated to these trade negotiations. USTR, Ambassador Greer, Secretary Bessent, Howard Lutnick. They're not going to be as involved as some of the defense and national security advisors will be on this Iran-Israel conflict. So they are going to be focused exclusively on these trade talks. Now, of course, that doesn't mean that one doesn't influence the other, but there are separate lanes in his administration who can handle both.
Is it your assumption then that we do get those deals that you mentioned that we were close to by July 8th?
Yeah, that is my expectation. And we really don't know what's going to happen in July. We had Secretary Bessent during a hearing last week tease that for countries negotiating in good faith, they could see an extension of that period. But the president hasn't said one way or the other. And I think negotiators are going to seek to put pressure on a number of governments where things are close in order to try to get the deal. And we've heard directly from the administration that India is close. And my expectation is that Canada and Mexico are also very much top of the queue, if for no other reason than they're two of the U.S.'s most important trading partners, and we still do have sizable tariffs on both for goods that don't currently qualify for those USMCA deals. So that's going to be a big ticket item, not just for the U.S., but also for Canada and Mexico.
Kellyanne Shaw, former senior Trump trade advisor, thank you so much for being with us in the Insights on what's going on with trade. Alicia Levine of BNY Wealth still with us. Alicia, how closely are you following this? How much do you think that markets have gamed out the July 9th deadline for some of these trade discussions?
I think markets are exhausted from the trade issue and the deadlines. And I think the markets are pricing in that if they're not done, if there's no memorandum of understanding by July 9th, it's going to get postponed. I think that actually could be a risk to markets in the sense that the markets have sort of decided to move on to other issues than the particulars of what's happening with trade, because the administration has really highlighted that they're working towards a deal and the outcome is not going to be as bad as it was in early April. And so we're working towards lower tariffs, more clarity, something that companies can actually work with for investment. And once you have clarity, the market's fine. So I think the market has essentially put this to the side for now, and maybe that's the risk. Right. The risk is that the market's gone to sleep on this issue.
Well, it's gone to sleep on this issue, and it's gone to sleep to some degree on the budget issue. We were talking with Chris Verona, Strategas, earlier this morning, and he was saying that really the bill that's down in Washington, D.C. is the most important thing, since a lot of people have been gaming out some sort of tailwind to the U.S. economy from this bill. I mean, how much are you watching what's going on and the sausage getting made and people basically saying this is untenable and saying, wait a second, what do we really price in here?
So I think it gets done. It's one of those do or die bill. It's going to get done. I think it's going to be very noisy. Again, when you look at the summer and you look at markets, we had a remarkable recovery, with some of the fastest in history, really, from where we hit on April 8th. So I think the summer is typically not a great time for markets. August and September are sort of like, known to be rocky. And you have the perfect Washington issue to really cause it. I think the other thing we really want to focus on what's happening with the labor market. We have retail sales today. Retail sales have obviously come in better than expected, and part of the hard data holding up and really belying some of those negative sentiment data, consumer negative sentiment data reads that we had. I was like, well, consumers might be depressed, but they're shopping depressed. So when does that change on retail sales? Because consumption is 70% of GDP. So we're watching that. There's some signals in the labor market, I think, that have not been as positive. We have to look. New claims for 2 weeks in a row, over 240, continuing claims ticking up. We need to keep an eye on that. I think it sets up, we think the market finishes higher by the end of the year, but the summer could be an interesting time.
We get jobless claims tomorrow, not on Thursday because of the holiday on Thursday. Alicia Levine of BNY Wealth, thank you so much for being here.
Great to see you guys.
Great to see you. Coming up, the son of the last Shah of Iran will be joining us to talk about the situation in the Middle East. This is Bloomberg Surveillance.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Just a bit of a risk-off tone this morning, retracing some of the gains from yesterday. As people look to President Trump returning to D.C. amid an escalating conflict in the Middle East. Right now, equity is down about 0.5% in futures. S&P and the NASDAQ right now 2 hours away from the cash open. Here are your morning movers with Yahaira Anand.
Hi, Lisa. We start with a massive mover, and that is Verve Therapeutics, up 75% on a report by the Financial Times that Eli Lilly is in advanced talks to buy the gene editing startup for up to $1.3 billion. That would double Verve's market value and give Lilly access to its promising cholesterol treatment, which could pair up nicely with its obesity drugs. Next up, we have shares of Navitas Semiconductor. They are falling 2% after Deutsche Bank hit it with a downgrade, now rating it as a hold, saying its rally has gone too far. The stock has been on a tear, up 276% since it announced it was teaming up with NVIDIA on data center technology, but analysts say the hype may be getting ahead of the numbers, with revenue still expected to be small for the time being. And last up, we have Redwire shares. They're falling 13.5% now after the aerospace tech firm launched a $200 million share sale overnight at a steep markdown. Look at this. Shares were offered at a discount of up to about 18% of its closing price yesterday. This marks another discounted sale. Just earlier, I spoke about SoftBank also unloading T-Mobile shares at a discount, albeit smaller than this one. Lisa?
Thank you so much, Yahaira. On our radar this morning, the top story, President Trump leaving the G7 summit early as the crisis between Israel and Iran presses on. Trump saying the reason for his leaving has nothing to do with a ceasefire and calling for the evacuation of Iran's capital, which led to this risk-off move that hasn't really stuck to any, which is sort of surprising to some people.
No, it's really remarkable to see that this is a market that wants positive news to trade on, that individual catalysts can move it lower, but for the most part, it keeps treading water. But this also brings up other issues, not just for the conflict itself, but for the fact we didn't get more trade deals because President Trump early. All we got was the UK and US deal, which already in large part had been agreed upon. There are probably so many leaders there at the G7 disappointed that they couldn't get more face time with the president. So just add that to the list of reasons that perhaps markets are kind of whistling past a graveyard.
Yeah, and some people saying because in general, geopolitics are something that fade quickly from markets. President Trump dismissing reports that the White House is eyeing negotiations with Iranian leadership. Trump posting that if Iran wants to talk, they know how to reach him, and reiterating that Iran cannot have a nuclear weapon. So really kind of raising the ante at a time when it's unclear what the U.S. role would actually be. When we're gaming out the risks, Danny, I'm struck by this question of what is the greater potential catalyst for a risk-off move? Is it the closure of the Strait of Hormuz, or is it the United States going in and bombing Fordo, the underground nuclear site that ostensibly Israel would have a more difficult time reaching?
It underscores that in the fog of war, there's a lot that could go wrong and a lot that could impact markets. We've already seen a lot of the fuel ships, a lot of insurers saying it's not worth the risk. We've already seen a pullback in the Strait of Hormuz. And that would seem to indicate that perhaps oil prices can go higher, even without an outright closure at this moment. But it is a president that keeps going back and forth as to whether he really wants talks or whether he doesn't want talks. He also posted on Truth Social this morning that he hasn't reached out to Iran for peace talks and they know where to find him. So there's a lot of back and forth. It's not clear. The only certainty is uncertainty.
And it's not clear what Israel's ultimate goal is. Is it regime change, or is it just simply tempering the nuclear risk? We're going to be talking about that in just a moment. Meanwhile, the Senate proposing changes to President Trump's tax bill that would cut taxes for households and businesses, but would also slash Medicaid benefits and add to U.S. deficits. Absent from the bill is a deal on the state and local tax deduction, which includes the current $10,000 cap, and is a deal breaker for a number of members of the House who are Republicans, who do come from blue states, which raises the question of just how messy this process is going to get.
Mike Lawler called it dead on arrival. One of his other colleagues from New York also said, no way, never. It's not even just that. So it's SALT staying at $10,000. It's a lower phase out of the IRA solar tax credits. It also more cuts from Medicaid. There's so many hot button issues that the Senate has altered from the House, with the House who passed over the bill saying, don't make changes to this. They still have their self-imposed deadline of July 4th. There was an idea that this weekend they could get something to agree upon. There is still so much daylight between now, the Senate and the House versions. How does this deadline come up and how are they going to meet it? A lot of questions left on that.
Meanwhile, we are getting some news from the Israeli defense minister saying that Israel is not in talks with Iran and that Israel is planning to attack significant targets in Tehran today. Right now, this is our top story. President Donald Trump arriving in Washington after leaving the G7 summit in Canada early. Trump warning residents of Iran's capital, Tehran, to evacuate the city. Trump also reiterating on Truth Social, Iran cannot have a nuclear weapon. Joining us now is Reza Pahlavi, the son of the last Shah of Iran. Reza, thank you so much for being with us. I want to start with a question. Are you in active discussions in any way to return to Iran in a leadership role if there is some sort of regime change in Iran?
Good morning to you and to my fellow compatriots following this program and all of your audience. There is a campaign for liberation that we've been committed to all these years. The moment is approaching very fast. The regime is on the verge of collapse. We see elements within the regime already talking defections. They get in touch with us. We see a leader who is now hiding in a bunker like a rat, while many high elements are taking flight from Iran. I think all of this is conducive to something that may very soon happen. And finally, my fellow compatriots will be able to overcome. And of course, there's a plan not only for this phase of our struggle, which is liberation from this regime, but what happens right next, the transition to what we hope will culminate in a democratic outcome. I have stepped in to lead this campaign at the behest of my compatriots. I have a plan of action not only to manage this phase of transition, but also to plan for Iran's future recovery and prosperity,
Wait, Reza,
which at the end has to go hand in glove with our democratic ideas.
Just a question here. Who are the compatriots who've approached you to try to helm this leadership push?
Well, I think that you have people who have vested interest in preserving this regime because their whole survival depends on this regime all this time. Whereas the millions of my compatriots who were the first victim of this regime have paid all these 4 decades a very heavy price. We have seen many campaigns that people protested. The latest one was 2 years ago, the Women Life Freedom Movement. And finally, I think today, with this clear weakening of the regime, and as I said, being on the verge of collapse, finally, all these people who have risked their lives and honorably put their lives on the line and did die for the cause will be able to remembered as heroes of this conflict, because we'll be liberated sooner than everybody thinks. And my entire commitment has been from day one to support my compatriots in the struggle for liberation. And we believe that the end is very near for the regime, and our dreams of liberty will finally be realized very soon.
Reza, on the ground, what we've seen in Iran is those in Tehran, for example, trying to evacuate. Israel saying more recently that they would look at targeting places there. You've seen fear, you've seen strikes, and you've seen death. How complicated and how difficult is it to ask a populace to rise up and rally behind you when they're the very same ones that are under threat right now?
Look, I think many of my competitors are smart enough to understand that if right now, if until now, and in fact, many of your colleagues in the media have always asked me, how do you fight a regime that is so repressive, that is so ruthless, that executes, that threatens dissidents or activists at home? To which I said, well, obviously the playing field has to be more equalized. This is a case where for the first time in 40 years, we see this regime being declawed, literally declawed. But it is also important to have the support of the world community, because until now, many times my competitors have been thrown under the bus when they had an opportunity to be backed because of a policy of appeasement or containment. I think now the situation for the first time exists for the world to realize that it is no avail to expect this regime to change its attitude and behavior. Ali Khamenei is at war with the world, not the Iranian people. He is the main culprit for being here and having Iranians also have innocent victims and civilians die, to whom my heart goes out, of course. But I think right now we need to be focused on the goal and the aim. We have a tremendous opportunity to overcome this regime. I think the world would breathe a sigh of relief with this regime no longer be there.
Well,
we
Reza,
are carrying out our
if I
fight
can jump
as
in here,
Iranians.
because
We
you
hope
say
the world will support
the
us.
goal and the aim is a regime change. What we have heard from Israel is that their goal is to dismantle the nuclear forces from Iran. Is it your understanding that a regime change is also a goal from the Israelis, and have you been in contact with them?
I'm not asking any foreign governments to state a policy of regime change, although I think many of them do believe that ultimately that would be the best formula to get rid of so many problems at the same time, and not just the nuclear threat as a result of this regime track record of behavior in the region and beyond, fomenting terrorism, supporting their proxies like Hezbollah or Hamas in the region and so on. So by the disappearance of this regime, we're eliminating too many problems that this regime has caused in one shot. The first beneficiary of regime change are the Iranian people themselves. But we believe that our immediate neighborhood, the region, whether it is the Israelis, our Arab neighbors, and beyond that, the rest of the free world will understand that the Iranian people who, unlike this regime, want to be part of the civilized world, with the same values and principles of liberty and freedom and human rights, unlike this regime, would be certainly the element of change and, if you will, the alternatives to this regime. I think this is where the world needs to be focused now, beyond the immediate campaign that is a result of the stubbornness of Khamenei, who has dragged our country into it. But let's look at the positive aspect of, once we get rid of this regime, how we can envisage a future where we're back to an element of stability and regional peace, which is in everybody's interest. That's
Reza,
what we
just to build on what Danny was asking, have you been in contact with the Israeli leadership?
We are reaching out to everyone, including the Israeli side, to understand where it is that we stand, what is the expectation of the Iranian people in terms of world support. I think it's pretty much the same thing that many struggling nations under totalitarian regime were looking at any country that understand that they have to stand with the people of a country that is trying to liberate itself. And again, whether it's the Israeli government or the American government or any other government for that matter, the question is, whose side are you going to stand with today? The Iranian people, or continue to insist negotiating with a regime that is on the verge of collapse?
There's also a question of what this new leadership looks like. Reza, are you talking about reestablishing the monarchy when that was controversial and it might not have full support from all parties, particularly the more religious elements of the Iranian society?
Well, I have never advocated for one form of a regime or another. What I did and have advocated, and in fact is part of my transition plan, is a process that is totally democratic. That means that the Iranian people have to have the ability to ponder upon whatever a constitutional assembly will propose as a constitutional formula. A future constitution, the form that the regime can take, what it will mean, and unlike 1979, when people had no clue or idea what an Islamic Republic means, and by the time they figured it out, it was too late, this time in full transparency, they'll have the option to look at what's the best model that fits them, and let the ballot box decide in majority what the Iranian people will opt for. Will it be a republic? Will it be a constitutional monarchy? Or whatever it is. My objective is not to stand here as the result of that. And my responsibility right now, my only focus is to see this process through so we can ensure that ultimately we replace this dictatorship with a democratic, and let me underline, a secular democracy, where there's a clear separation of religion from state as a prerequisite.
To that point, past attempts to engineer regime shifts in the Middle East haven't often ended in liberal pro-Western governments. There are examples, many out there, Libya, Syria, Yemen, Somalia, all ending in things that look like fragmentation or current armed forces having the most power and being the ones that emerge in the chaos of a regime shift. What do you suggest that it is different this time?
I think Iranian society, not just for centuries of proving that they have, as a nation state, a concept of a nationhood, national identity, national pride and objective, a culture, a civilization, but also a polity, and a generation today very shrewd and very clever by knowing what it is that will be in their interest. They see the world and how it has evolved. They have seen successful campaign of liberation. They understand the key elements that sustains and preserves democratic order. And I believe today's Gen Z in Iran is more than ever equipped to understand not only the needs, but how and what it will take to implement that. Look, it's a collective project. Everybody have to roll up their sleeves and participate. The premise remains the same in the principles of liberty and human rights. But if each member of society is committed to see through it and actively engage in that process, that's where we can guarantee that it's going to be actually a result that will be positive. I have absolute faith and confidence in my compatriots and their wisdom and their know-how and their knowledge. They do need guidance, of course. They do need support, of course. They do need some level of leadership, of course. But at the end, they are the elements and instruments of change.
Yeah.
And we are working together very closely to see that through.
Reza Pahlavi, thank you so much for your time. Really appreciate you getting on with us this morning. Right now, let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Analysts over at Citi expect gold to sink back below $3,000 an ounce in the coming quarters. The team says the slump will be driven by weaker investment demand, improving global growth prospects, and future rate cuts by the Federal Reserve. Gold has soared almost 30% this year, setting a rate record back in April. Meanwhile, Meta is tapping Scale AI co-founder Alexander Wang to lead CEO Mark Zuckerberg's superintelligence group. Meta will also be investing around $14 billion in Scale AI. Known as a prolific networker and well-connected in the AI startup world, Wang's company also has large government contracts. Those ties could benefit Meta as it works to break into the defense tech sector. And Wall Street South is getting bigger by the day as financial power brokers migrate to Florida, drawn by the weather, of course, light regulation, and low taxes. Citadel CEO Ken Griffin spoke to our own Shonali Bassick for her new show, Bullish.
The optimism here is infectious. Is the American dream still alive? It's alive and kicking here in Miami because people here in Miami believe that tomorrow will be a better day. So it's really great to be here in a city that just exudes the belief that in America, anything can happen.
You can watch Bullish tonight on Bloomberg TV at 6 p.m. Eastern or stream it at 8 p.m. on Bloomberg Originals. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, Europe preparing to spend.
There's been a sort of criticism that Europe hasn't carried its fair share of the burden. They've said to European allies we need to do more on spend, on capability and cooperation.
We take you to the Paris Air Show. Saab CEO Mikael Johansson joins us next. This is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to Bloomberg Surveillance. Let's head straight back to the Paris Air Show. Bloomberg's Guy Johnson is joining us with a special guest. Guy.
Lisa, thank you very much indeed. I'm joined now by the Saab CEO, Michael Johansson. Thank you very much indeed for joining us. You're also the president of the European Security and Defence Association. You've got a broader remit, so we're going to talk about that in just a moment. Sweden is now a member of NATO. How big a difference has that made to Saab?
Well, first of all, I think the spending is another story. I mean, Sweden has aligned itself with the forecasted spending of 3.5% as quickly as possible until 2030, I think. So the demand is incredible, but I think it means a lot from a capability perspective as well. I mean, we've been sovereign, of course, so we still have to have a strong defense, but we also have to think about us where we are geographically and how we support the Finnish border towards Russia, how we handle the Arctic perspective in a different way in partnership with other countries that have an interest there. And the capability targets is adding a lot, of course, to the Swedish Defence Forces to think about, rather than just taking the national perspective. And then we have all the infrastructure. We've been a sort of a south-north country thinking about quickly getting to the northern part of Sweden from a defence perspective. Now we have to think sort of west to east, which is lacking infrastructure. So lots of things to the whole society.
In terms of what that means for your company, you are having to ramp up very quickly.
Yeah.
Is that possible? Is it possible to get from kind of a peacetime mentality workload to a war-footing workload? Kind of how far through that process are you? What needs to happen? Where are the bottlenecks? What are the challenges?
We're quite far through that. I would say we have in certain areas quadrupled output of what we did before the war broke out in Ukraine, to now having hundreds of thousands of ammunitions coming out of our factories, as an example. I do think we need to do more, and what we lack now is sort of understanding the aggregated demand, I would say, and what sort of target levels should we have to have a sustainable, high-level capability in terms of capacity, and that needs sort of NATO somehow telling us where to go and Europe telling us where to go. So I think we have a few steps still to take, but we have invested heavily in capacity now. And also, of course, new technology, embracing new technology to bring forward new capabilities.
Europe needs in so many ways to figure out how to work together better. And fighter jets, you make the Gripen fighter jet, is an example of that. This morning I was speaking to Eric Trappier, who runs Dassault. He makes the Rafale fighter, used to make the Mirage. We've got him working together with Airbus, maybe for not much longer. We don't know yet. We've got another group which is led by BAE with Leonardo and the Japanese in it. there needs to be a level of coordination that doesn't seem to be there at the moment. What's missing? Why can't we make this work? What do we need to do to get it to work? And what can Saab do to be part of that process as well?
Well, I think this is about national sovereignty and having what we call as industry as OEM capability. If you look at the Western world today, it's only 3 countries that would have that today. I would say it's us, Sweden. We build fighter jets and systems of systems. We have France capable of doing that through Dassault and so forth, and we have US. Now to sort of divide that somehow, but still keep the OEM capabilities in a few countries is the key to this, I think. You need to find your partnerships that doesn't let you get into the level of being a supplier rather than a partner.
Right.
You need to find both. MBDA is a good model of that. They've done that. They've done sort of a missile capability thing where some countries have enough OEM capability and sovereign capability to feel safe from a security supply perspective, still being a pan-European company. That we need to accomplish also in Europe if we would like to go that way. Now, I wouldn't say it's bad to have a couple of suppliers of fighter aircraft in Europe, so I don't know how much we need to consolidate. But in other areas, we definitely have to consolidate more.
Michael, great to see you. Thanks indeed for stopping by to see us. I think we're about to see a Rafale fighter jet taking off. It's about to get very noisy around here. So on that note...
I wish it was a Gripen.
I'm sure you do, definitely wish it was a Gripen. I'm sure it would be just as noisy, though.
It was. Thank you.
I'll throw it back to you guys in New York from the Paris Air Show.
Thank you so much. Bloomberg's Guy Johnson, wonderful work as always, and I was expecting to hear some jets taking off just then.
I know, it kind of doesn't feel right. You need the Paris Air Show and something... I'm glad it didn't, because that was a great interview, but it feels very apt for the Paris Air Show to be drowned out by noise.
Just taking a step back, and we are heading into an hour where we are going to get retail sales, and there is this question of how much it would take for U.S. economic data to take the front focus away from what's going on in the Middle East. It seems like there are a lot of questions, and that conversation that we just had with the son of the late Shah really, again, spotlighting a potential regime shift in Iran.
It's very true. And it is also something I spoke with Bob McNally of Rapidan about, that if you did get a regime shift and you did get a more friendly pro-Western government, it opens up this huge energy market. Just to put it on the energy side and market sides, obviously it has bigger consequences than just that. But a populace that is pro-friendly to the West, it would really, really change things. But history tells us regime shifts are messy, and it is never that straightforward.
As you asked, and it was a good point, the idea of how this has worked in the past has been inconsistent at best. Coming up next hour, as we turn our focus to the economic data, Nadia Lovell of UBS, Gil Luria of D.A. Davidson on the rally we've seen in tech shares, Pooja Sriram of Barclays, and Keher of J.P. Morgan Investment Management. This is Bloomberg Surveillance. Good morning.
Was it easy to get the pandas to come back to Washington, D.C.? Did the Chinese say, we have some extra pandas, we don't know what to do with them, we're going to give them to you?
Well, it was a little more difficult than that. It probably took us, it was about over the course of a year where we had conversations with our colleagues in China, and we were able to get pandas here very quickly. I think it's a testament to the relationship we've built over decades, to the conservation success that we've had, here with our pandas and our panda program. And so it was a lot of conversations, but I think we always knew in the end that we did want pandas at the National Zoo.
How many pandas are there in the entire world?
So this is incredible because this is all due to this panda program, and this is so important. So when we started with giant pandas 50 years ago, there were fewer than 1,000 pandas in the world, right? We're talking in the wild and zoos, fewer than 1,000. And decades later, there are close to 2,000 pandas in the wild now. Actually, I think a little over 1,800. There are over 700 pandas in breeding centers. So as part of this program, we have tripled the number of pandas on the planet.
But still a small number of pandas.
Because of this program, there are more pandas on the planet, more quality panda habitat in the wild, and pandas have gone from being endangered to being vulnerable.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO? It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
This is a year to adapt, and forecasts have been less relevant.
Let's not be too defensive. There's a real opportunity cost to being under risk.
You don't want to be short, but you do want to get a bit more defensive.
The pain trade overall still could be higher.
It's going to be potentially quite a volatile next year and a half.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. We're going to do something a little different. We're going to try to focus on the economic data for a hot second while keeping an eye, of course, on the Middle East. We are less than 30 minutes away from retail sales in America for the month of May as the Federal Reserve begins its two-day meeting in Washington, D.C. We're going to get to the Middle East in just a second, but first, Danny Berger, how much we're looking at the consumer at a time where that really ultimately remains the question. Can they keep spending amid all this uncertainty?
And will the market pay attention? I love the question you asked. What would it take for the economic data to break through? And let's be honest, even some of the stuff in the Middle East isn't breaking through to the markets. But there's a lot on the mind of consumers. The sentiment surveys have been volatile at best. You have something of a wealth effect with what stocks and equities have done this year. Can they hold up in this? Will you start to see the beginning impact of tariffs, of higher inflation, add whatever uncertainty is happening right now in the global economy to that too? Or are we just going to continue on and it's going to be more uncertainty and we won't know what to make of the data?
And to your point, I think it's a really solid one, this idea of how does the market take potentially weaker prints and do anything with it? Does it expedite the expected timeline for the Federal Reserve to cut rates, given the fact that you potentially are dealing with stagflationary shock? The price of oil very much in focus, rising again, yet again today. As we do look to a possible disruption in the Middle East, people talking about some sort of ongoing conflict between Iran and Israel that could lead to regime change or some other type of pretty significant disruption. How much does this make it more difficult for a Fed to figure out how to even message this?
And what would be the reaction of markets, even as they message it? Just look at the bond market today. Even with oil higher, you see yields coming in. You see a bid to bonds. Ian Lingan of BMO writing this morning that suggests that we aren't even moving in the direction of what the fiscal deficit does. That maybe it's already all priced in, by the way, another thing, just to consider what the market's doing. But maybe this market is back to caring about what the real economy does and the threat of reflation. So, hey, maybe retail sales does matter today.
Maybe people are just exhausted or uncomfortably numb right now in markets. We're tracing some of the losses from earlier in the session. Futures down less than 0.4% on the S&P 500, as Danny was just talking about. A bid into bonds, which is different than what you've seen over the past few sessions. sessions on the heels of some of the fighting, and you are seeing a bit of dollar weakness, although really it's basically range bound versus the euro, 115.63. Coming up, Nadia Lovell of UBS with stocks lower on continued fighting in the Middle East. Pooja Sriram of Barclays with that breaking retail sales data that we were just talking about, and Kay of JP Morgan as the Fed kicks off its two-day meeting. We begin with this top story. President Donald Trump arriving in Washington, leaving the G7 summit early as the Middle East crisis escalates. Anne-Marie joins us from the G7 meeting in Canada. Anne-Marie, do we have any additional information, either with respect to what President Trump will be doing, what his inclination is, whether it's to make peace or not, and just what kind of response there is in D.C.?
Well, the president is going to be spending a lot of his day in the Situation Room with his national security team. He kept it incredibly vague, but he did say that he is not in the mood right now for negotiating, and Iran should have struck a deal when they had a chance. Now, he's going back to Washington, D.C. at a time when there's growing speculation about the potential for the United States to get involved in this conflict, to join Israel, not just in a defensive posture, but in an offensive posture. The president, speaking to reporters yesterday, had this to say: I didn't say I was looking for a ceasefire. I'm looking for better than a ceasefire, an end, a real end, not a ceasefire, an end. And then he also took as well to Truth Social, talking about all that was going on, and also lambasting Emmanuel Macron, who he said got it wrong, telling reporters that potentially the president was looking for a deal. Trump did say, though, he may send his special envoy, Steve Witkoff, or the Vice President, J.D. Vance, to meet with the Iranians, but he said it depends on what happens today. And that is why all eyes are not just on Tehran and Jerusalem today, but on Washington, D.C.
Anne-Marie, thank you so much. Safe travels back to New York from Canada. Right now, we're focused on what the market's response has been. Nadia Lovell of UBS writes, the Israel-Iran conflict remains fluid, but we expect limited impact on markets if it remains contained. Nadia joins us now, and Nadia, it seems to be sort of the common thought here. As long as this remains contained, we can ignore it and keep on whistling our way. How do you even understand at what point you have to be paying more attention?
You know, I think if you just look at the historical playbook, I think that's why many market participants think that this will be limited if it remains contained. Because when you look at historically, if you look at the last dozen or so of geopolitical conflicts, a week later the market is flat, a year later it's up high single digits. But what could turn this is if the U.S. gets involved and that leads to a disruption in oil flows by, some sort of blockage of the Strait of Hormuz. Yes, Iran has threatened that in numerous occasions, but never has there been a full blockage. So that could lead to a spike in oil price if that happens. And so right now, the market seems to be looking through it. We think that the market will continue to look through it as long as the U.S. remains out of the conflict.
If you didn't want to look through it and you wanted to protect yourself against what the impact might be if there is escalation, how would you do it?
I think you've seen it already playing out in the marketplace, this flight to quality. The flight to quality now is really that safe haven asset, it's gold, right? We think that gold could get to 3,800 if you see a further escalation in this conflict. And also people are trading oil, right? Oil could spike up into the $100 range. That is not our base view. We continue to think that oil prices is more reasonable at $68. But if you lead to some sort of blockage that disrupts the flow of oil, then you could see that spike in oil prices. Right now, it feels like the market is pricing in, the sort of $75 to $80 range, which suggests that they're expecting some sort of disruption to Iranian oil and not a widespread disruption to the oil coming out of the Gulf.
You didn't say bonds as something that would protect you in this moment. You have seen the initial reaction was to sell bonds, maybe an inflationary concern. This morning we're buying them. How do you understand between the different drivers, between geopolitics, a bill, between trade discussions, the economy, what really is breaking through and driving the market narrative?
I think it's all of that, and the market is trying to muddle through this narrative. I mean, when do we shift back the attention to the big, beautiful bill and the increased deficits and what that will mean for longer-term interest rates? I think that's coming. Again, I think we have to get through this week and see what happens within the Middle East for the market to sort of shift its attention back towards that. So right now, we think that, in terms of bonds, not to say that bonds shouldn't be part of your portfolio, it is. is, but right now it doesn't feel like it's that part of that flight to quality trade that we have seen in the past.
I feel like we do this every week. I feel like every single week, let's get through this week, and then next week will be much more clear, and we'll have a greater sense, and we'll be able to focus on something simple. Hasn't worked out that way.
I don't think that's what, I'm not saying that. It's sort of checking off one problem and moving on to the next, right?
Okay, so then let's talk about the next problem, and that's going to be the actual U.S. economy, where there's been some interesting data, right? We've seen the ongoing continuing claims rise to the highest level going back to 2021. We're expecting a decline in headline retail sales month over month for the month of May. At what point does this become a headwind to some of the bullish calls for equities that are predicated on high valuations and continuing earnings growth?
Yeah, looking for 830 for retail sales. Now, again, this data could be somewhat tricky in the sense that there was a pull forward, as we know, particularly around autos, home furnishing, in the prior data ahead of the tariffs. So it isn't clear what the underlying trend should be. So some of the weakness could be argued away if you see weakness in retail sales having to do with that. I think what's most important is, yes, those initial jobless claims that keeps creeping up higher, and even the payroll numbers, right? If you really dissect that, like 139 sounds fine, but if you dissected sort of the downward revisions that we see in the pattern of 440 to 50K downward revisions, if you put that in and expect the same sort of downward revision, you might be under 100K in terms of payrolls. And so I think that's going to be important to watch, not only for, consumer spending, but also the Fed reaction function as it tries to balance that dual mandate, the potential for higher inflation coming through from tariffs and the potential for a weaker economy in terms of a slowdown in job creation.
It seems to be this moment that we're getting a push and pull from so many different factors, and you often get that sort of volatility, that oscillation, when you are on the verge of a regime shift. Does it feel like we are on the precipice of something really changing, of understanding maybe cracks in the economy, or something different just with all these disruptions that are happening?
I think, this is something that the market is struggling, and we're all struggling. I wouldn't say a regime shift. Its reality is when you go back to the fundamentals of the equity market, the underlying fundamentals still remain strong in the U.S. When you go back to sort of the tech and the AI story, the electrification story, all of that sits within the U.S. But when you think about what's already priced into this market, you have a market that's traded at 22 times forward PE. And when you look at the last few years, that's sort of like the upward bound in terms of hitting that resistance level for further multiple expansion. So it comes back again to the growth story near term over the next 6 months or so. We do expect a slowdown in growth. That is going to be a drag on earnings growth. We're looking for about 4% this year in earnings growth. And so right now we think that the market is fairly valued at, 6,000 on the S&P 500. But if you look into 2026 in sort of the middle of the year, we think you can get to 6,400 because we hope to have clarity. And I know hope is not, a strategy, but it does suggest like by the time we get to, September into December, that we will have further clarity on trade, further clarity on monetary policy, and the exact impact on the economy from tariffs.
In the meantime, we're all buffering and just trying to get to the weekend. Nadia Lovell of UBS, thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Senate Republicans have drafted a new version of President Trump's signature economic package. The bill raises the debt ceiling by $5 trillion and makes permanent 3 business tax breaks that were set to expire after 2029. The plan comes at the expense of curbing health coverage for some low-income Americans and makes no mention of a deal on the state and local tax deduction known as SALT. Meanwhile, Meta has tapped Scale AI co-founder Alexander Wang to lead CEO Mark Zuckerberg's superintelligence group. At the same time, Meta will be investing around $14 billion in Scale AI. Wang is known as a prolific networker and well-connected in the AI startup world. On top of that, his company has large government contracts, which could help Meta as it works to break into the defense tech sector. And the Oklahoma City Thunder are 1 win away from an NBA championship after beating the Indiana Pacers in Game 5. Thunder star Shai Gilgeous-Alexander and Jalen Williams combined for 71 points in the win, while Pacers star Tyrese Halliburton scored only 4 points. Game 6 is set for Thursday evening in Indianapolis. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Coming up next, the morning calls, plus Gil Luria of D.A. Davidson on the latest tailwinds for chips. This has been what's supporting the entire U.S. equity market, leading it higher. That's coming up next. This is Bloomberg Surveillance.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Welcome back to Bloomberg Surveillance. We're tracing some of the losses from earlier this morning. Futures down now less than 0.4% as people take a look at what the opportunities are and what the potential risks are for some sort of escalation in the Middle East. A bit of dollar weakness, but nothing really significant to discuss. 115.70 on euro dollar cross. You can see that bid continuing to gain steam into treasuries. 10-year yields 4.4%, down 4 basis points as crude up 2.2%. That point, Danny, you were making earlier, that if you were concerned about this being an inflationary type of shock with oil, kind of a gut check for that, given the risk on the risk-off feel actually giving a bid to the Treasury space.
It's really hard to understand what exactly is moving bonds because there's a lot that could. It could be inflation with oil in the Middle East. It could be the big, beautiful bill. It could be trade discussions. It could be the economy with what we get with retail sales. So you get this back and forth, but the net sum of it has been treasuries that have been in a really tight range as of late, especially since April when we saw a lot of volatility. So what is it going to take for them to break through? Lots of catalysts that could do just that.
And people saying that they've been in a range for about 2 years. So if you want to extend that range to a longer place, time now for the morning calls. First up, RBC maintaining its sector perform rating on Lennar, noting that better than expected gross margins overshadows a slight miss on orders, and those shares are up almost 2%, with a focus on the home builders later this morning. Some home builder data coming out at 10 a.m. Eastern today. Next up, Spotify raised to a street high price target of $900 by Pivotal Research, seeing opportunity in AI advertising, and those shares down just by about 1/3%. And finally, Bank of America raising its price target on Roku to $100, citing the platform's exclusive Amazon partnership. Those shares up about 2.5%. Let's stick with tech because this really has been the main driver, frankly, of a lot of the gains we've been seeing in markets. NVIDIA closing near a record high yesterday as it remains Wall Street's darling. Gil Luria of D.A. Davidson writing, the success of OpenAI, AI coding tools, and the proliferation of AI agents are driving a continued build-out of AI data centers. This has benefited mostly NVIDIA up to now, but investors are increasingly expecting Broadcom and AMD to participate. Joining us now, I'm so pleased to say, is Gil Luria of D.A. Davidson. Gil, I want to talk about just how much investors are picking up on this. Is this what we're seeing right now in markets where some of these names, that it's not just the Magnificent Seven, it's the FANG Plus, those 10 names that include Broadcom and AMD, that seem to be driving us forward at a time when people still very much believe in this AI trend?
Well, that's right. The AI trade peaked last year. It went away a little bit, and now it's back, and it's back for good reason. We are seeing the AI tools starting to work, starting to contribute, and we're getting a sense that the investment will continue. Maybe not at the exponential rates we've seen so far, but it will continue. And NVIDIA is still the main provider of these chips, but it is broadening, as we point out. Broadcom helps Amazon and Google make its own chips. Increasingly, those big customers, Microsoft, Amazon, Google, Meta, don't want to just rely on NVIDIA. So they're expanding their scope and including AMD. And then there's a whole range of upstarts that will come public soon. Cerebras, Grok. There's a small company called Blaze, BZAI, that makes chips that do AI at the edge. This trend is big and it's broadening. And until we have more of a sense of where it benefits in software, investors continue to gravitate to semis because they know AI has to use semis.
Gil, I'm struck by the idea of what happened during the dot-com bubble, and some of the big leaders during that time are not the leaders that we see today in terms of the internet space. How much disruption do you see over the next year of some of the giants, some of the Magnificent Seven, that might be rendered, I want to say obsolete, but a lot less relevant as a result of some of the really cutting-edge technology?
Well, as it happens, it is actually the largest companies that will benefit next. So Microsoft has already done phenomenally well and will continue to do so. Their Azure business is growing 35%. That's a $70 billion business growing 35% as they provide access to these GPUs to their customers. Amazon Web Services growing fast, Google Cloud growing fast. So it is actually the largest companies that are benefiting, but there will also be smaller software companies. Nebius is another provider, but your Snowflake, your Datadog, infrastructure software companies will also start benefiting. And at some point down the road, we'll see the applications that will become hits beyond coding and chat, which is what we're using AI for now. The applications will get a lot more broad, and then application software companies will benefit. That may not be the biggest companies, but right now, it is actually Microsoft, Amazon, and Google that are benefiting the most from providing access to AI services.
Well, a lot of that growth, just in terms of their AI offering and what they have under the hood, has been inorganic, Gil. And we had the most recent one with Scale AI, a huge investment, $14.3 billion from Meta in that deal. Do they have to spend those levels of money? Is this type of investment necessary in order for them not to get left behind?
It tells you how high the stakes are. So Mark Zuckerberg believes that having one of the dominant AI models is the most important thing right now. That's why he literally spent $14 billion to hire Alexander Wang, which is mind-boggling. It's mind-boggling. They're going out there with offers of 8 to 9 figures for AI researchers. And it's even more mind-boggling that some of those AI researchers at OpenAI and Anthropic are turning that offer down because they have so much equity in those franchises. Having said that, Mr. Zuckerberg is correct. Having the best AI model is very important. There will, at some point, only be 1 or 2 successful models that we use for broad purposes. There'll be a lot of small AI models that we use for specific purposes, but he sees it as a goal to have the best open source AI broad model. And since his previous effort with Llama 4 was a failure, he felt like he needs to rebuild that team from scratch so he can become competitive again with OpenAI, with Anthropic, with Google's lab. And that's why he's remaking that team at all cost right now.
Gil, is that somewhat, though, of an argument against the smaller players doing well in this environment, that you have these big behemoths that have the capital to hoover up smaller players and, by the way, have been rewarded by shareholders for doing so? Does that mean that we are trending towards an environment where the big are getting bigger because they are buying the smaller competition?
For now, yes. For now, you need this enormous infrastructure in order to be successful. Really, only these companies can be successful. At OpenAI and Anthropic, mostly because they're backed by Microsoft, Amazon, and Google. But that doesn't mean there won't be entrepreneurship here. There will be a lot of application companies that come out of here, because one of the things that's magical about AI is that one individual can now build an entire software stack. Using AI coding tools, you can build the website and everything behind it yourself at a fraction of the cost that it cost even 3 years ago, and at a small fraction of what it would have cost 10 or 20 years ago. So this will lead to a huge wave of entrepreneurial activity and startups around AI applications. But the core infrastructure, only the largest players can afford to play in that space.
Gil Luria of D.A. Davidson, thank you so much for that insight. And I did punch into ChatGPT just now. What should I pay attention to with retail sales data? And it's been having a really hard time bringing anything up. And luckily, we have a human, Michael McKee, who covers all of this, and you can actually tell us what we should be looking for. Michael McKee joining us ahead of that print that we get in just a couple minutes' time. What are you looking for, Mike?
It really should say on ChatGPT, listen to Michael McKee.
Actually, it might. It still hasn't come up, but carry on.
Well, the interesting thing last month was how widespread the declines were. They weren't huge, but they fell off in a lot of categories. This time we're looking for two separate areas to decline: energy prices, which is not a bad thing for the economy, and auto sales. And that should push down the overall retail sales number, according to the Bloomberg survey, by a fair amount, 0.6%. But the control group, which takes out gasoline and auto sales and also home improvement sales, is expected to rise, and it had fallen last month. So we'll look for some spending, some modest spending by consumers during the month of May. The real question is how much of a rebound do we get? And then we'll be asking, is it going to continue as people sit and wonder and worry about what's going to happen going forward?
Michael McKee, thank you so much. We'll be catching up with you in just a minute as we look to understand how much people are spending on hobbies like sporting goods and potentially musical instruments. I mean, these are the types of things that give you a sense of how much discretionary income people feel like they have right now.
Yeah, and how much of it is, oh, they're depressed. I think Alicia Levine said this earlier. They're depressed, but they're spending maybe to help alleviate some of that depression. But there are things you've noted, like initial jobless claims ticking up, just general volatility that can dampen sentiment when it comes to different conflict and when it comes to trade and potential inflation. How much does that really break through? You haven't seen it on the headline numbers yet. Could this retail sales number be the first little peek we get into that?
Yeah, right now, definitely markets taking it all in stride, seeing a retracement from some of the earlier sell-off that we saw in futures ahead of that retail sales data. Coming up, we will get that for you in just less than 5 minutes' time. We're also going to be speaking with Pooja Sriram of Barclays about that data and how this will affect the Fed's meeting, if at all, as they parse through not only what's going on in the economy, but also what's going on in the Middle East and with global trade. This is Bloomberg Surveillance.
The countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You said they ask interesting questions.
Bloomberg Television. Top experts, great questions. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
25 seconds until we get that key retail sales data for the month of May in the United States. Right now, you are seeing a bit of a risk-off feel across equity futures. S&P futures down 0.4%, a bid into the bond space. And interestingly, a strong bid into the 2-year in particular as we await this data. Down 4 basis points, 3.93%. Similar kind of move on the 10-year and the 30-year. Let's head over to Michael McKee, Bloomberg economics and policy correspondent, for that data. Mike.
Well, we have a significantly worse headline number than expected, down 0.9%. The revisions haven't come through yet, but the last month initial feed was 0.1% gain. Autos and gas were down 0.1%, so it is autos and gas that are pushing this lower. And then the control group comes in better than expected, up 0.4%. The expectation was for 0.3, and it had fallen 0.2 in the month of April. Import prices also they're flat on the month. Ex-petroleum, they're up 0.2%. Now, you can't read too much into that, because while some exporters from overseas might have lowered their prices to the U.S. To make up for tariffs, the tariffs are not applied until the products get here. So these are landing prices, and we won't see a huge amount of tariff effect in those. But the story at the moment, a 0.9 decline in headline retail sales, which is likely autos and gas. I'll check the categories, Lisa, and you can check the markets.
Yeah, the initial reaction, and Mike, thank you so much for that, was definitely a bid into the 2-year. You're seeing that fade just a touch. You're seeing initially a risk-off mood deepen in equity markets. What you are seeing is this feeling that this would give some further incentive to the Fed, or at least wouldn't necessarily restrict their ability to cut rates in the near future. 2-year yields, just taking a look at that, off some of the earlier knee-jerk reactions that you first saw, were down just about 3 basis points, 3.93%. A little bit of further dollar weakening versus the euro, but really not a massive move. Mike, you've had a couple of seconds to take a look. Is anything standing out to you in terms of what exactly among the indicators outside of oil and gas led to the decline in headline, but also the strength that we saw in the control group?
In general, there was a rebound in most categories that fall into the control group, but we do have some declines. The clothing and accessories group was up 0.8%, sporting goods up 1.3%, general merchandise stores up 0.1%, although department stores were down 0.4. Non-store retailers, of course, this is basically where you're going to pick up your Amazons and your Walmarts online, up 0.9%. The declines were pretty much as expected. Motor vehicle and parts dealers down 3.5%, building material dealers down 2.7%, and gasoline stations down 2%. So people did see some price declines in gasoline, and they did see, or they did decide they didn't want to buy more cars after loading up earlier in the year. And so the pattern is kind of what we expected. The one discretionary category we always talk about is food services and drinking places, down 0.9. So if you're looking for any sign of people's concern about what might happen to the economy, maybe they're pulling back a little bit there. That seems to be about our only real negative that wasn't expected at this point.
Michael McKee, thank you so much. Maybe they also were just having a dry May. Danny, what's your take on this? I mean, it seems like if you're looking for clarity, this ain't it.
It's the opposite of clarity. It's more uncertainty. It is a control group that did better. It is a headline that did worse. And by the way, you did see April revised down to a negative 0.1%. It was pretty much flat last time we saw it. So no drama at the moment, but that doesn't change anything. The fact that you didn't see any deterioration, unfortunately, doesn't change anything, because you could make the argument, yes, we're really resilient, things are holding up, or you can make the argument that everything was pulled forward, people are still shopping, and you're not seeing impacts of tariffs and uncertainty yet.
Well, Pooja Sriram of Barclays joins us now with her own argument. Pooja, how do you interpret this? Thank you so much for being here, given the fact that there's something for everyone, which is kind of the theme that we've seen in a lot of the economic data recently.
That's true. Well, so far, I sort of agree with what she said, in the sense that right now it just looks like everything seems to be good. So far, so good is how I would put it. But it's hard to say how things are going to pan out sort of going forward. A quick take on the retail sales from my end is that we had expected a slightly weaker control group. So the fact that it actually did better than we'd expected is, again, maybe, like she said, maybe a resilient consumer. Income fundamentals, wealth fundamentals for consumers have been looking good. It's something we've said on and off. But I do expect at some point a pullback and a moderation in consumer spending to materialize. Did it happen in this sprint? It didn't.
Maybe there's a correlation, though, between the decline that we've seen in oil and gas prices and the increase that we saw, the strength that we saw in the control group, because there's this theory that if you're not paying as much when you go to fill up the tank in your car, you have more to spend on other things. How much is that thesis threatened if oil prices start to spike at a time of conflict in the Middle East?
No, that's a valid point. The one thing that I would add is that, the spending on gasoline as a share of consumer spending isn't as high as what most would think. It's about 2 to 3% for the consumption basket. So you would need a pretty persistent and a pretty big rise in oil prices for consumers to actually start feeling threatened and for them to actually start pulling back. It's what we call like the discretionary income channel, because you have to spend on oil. We think demand is relatively inelastic for oil. And so when you have to spend more on oil, you're forced to sort of pull back elsewhere. So that is a risk, but we think it's developing. I wouldn't say that's a baseline right now.
When it comes to a consumer that you expect eventually to weaken, what is the trigger for it? Because we already see some underlying weakness in the labor market, a little bit in there, things like the unemployment, some of the weekly initial jobless claims ticking higher. Companies are not hiring right now. There seems to be a freeze. What needs to change for that actually to trickle down into some weakness for the consumer?
Well, I think two things. We need to see this consistent discipline, gradual slowing in the labor market for the consumer to start feeling a little worried. The other thing which we've been saying that should happen eventually is as the prices start increasing because of tariffs, there could be some pressure on the consumer purchasing power. When both of these things materialize together is a world in which we think the consumer would feel cautious about spending, and that's when we should hopefully start seeing the personal saving rate tick up, because you're trying to save up.
Just be clear, does it actually need to happen? Because you have seen the sentiment measures sour quite a bit to start this year. They've been bouncing around since then, and there's a whole host of reasons why maybe you shouldn't pay attention to them. But is the expectation for economic weakness or geopolitical strife, do any of those sentiment type issues weigh on the consumer, or do they keep spending through it until the actual prices, the actual data changes?
Well, it's hard to say, but I would think there has to be some amount of precaution that has to set in. The other thing that we've been saying is the price level is already so high across a whole host of commodities, goods, and this is an aftermath of the pandemic, that now any additional price increase, we think the consumer is likely to be sensitive to that.
Just to, if you're just joining us right now, just to reset, we did get retail sales that came in on the headline level weaker than expected, down 0.9% versus the expected 0.6%. That sounds negative. That sounds like a weakening. Oh no! And then you take a look at the control group that came in stronger than expected, up 0.4% from the 0.3% that people had been expecting. The revisions to the prior month, as Danny was talking about, also were revised to be less bad than they were initially. And it raises this question of what the response in markets is. The response is interesting, actually. What you're seeing is less of a bid to the 2-year yield and more of a bid to the 30-year yield, which signifies that maybe people see this, and I'm really taking liberties here, as an excuse for the Fed not to cut rates as quickly because of that strength in the control group that could lead to longer-term weakness. Pooja, how much are you looking at that type of scenario, that people say the longer the Fed is on hold, the more longer term we see potential for a decline in inflation expectations and more weakness?
Well, I think in the near term, it makes sense for them to be on hold, just because there's an obvious tension between what we think is going to happen to inflation and the fact that we're not seeing a very material slowing in the labor market. So I think in the near term, it makes sense that they're on hold. I don't quite buy the argument that it would necessarily lead to more weakness going forward. I think it is going to give them a window to come in and cut rates.
Okay, so this is the argument some people have made, and this is sort of the question that we've been bandying around all morning. Why wouldn't the Fed come out and aggressively be hawkish to try to tamp down inflation expectations? And then later this year, if things do weaken, they can say, okay, just kidding. We actually do want to cut rates. I mean, why is that not the playbook for the Federal Reserve?
Well, we think they might actually come out and look pretty hawkish in the June meeting, right? Our own forecast is for the June SEP is to look relatively hawkish. We think the median dot would show only one cut in 2025. And that makes sense. I think the signal that they would want to send out at this point in time is we are watching inflation expectations. We are cognizant that inflation could go higher. The labor market side of the mandate for the time being looks okay. And so, I think the message from them is we're in no rush to cut rates. And I think it's the flip side, right? Should things actually materially start to weaken, they could come in and cut rates.
It's interesting because Bloomberg Economics has the same outlook, Anna Wong and her team there, but they said Chair Powell isn't as hawkish as the rest of the committee. So if you get one dot on the dot plot of cuts, expect Chair Powell to come up and kind of downplay and say, oh, we have a range of outcomes. It doesn't matter, not least of which because he'll probably get political pressure coming from the White House should that be the outcome. Do you expect Chair Powell to also lean more hawkish in his communique to the press after the decision?
I think that's going to be a tough one. I think he's going to stick to the messages that he's always, been saying. We're in no rush to cut rates. We're going to wait and watch. We need to see how the data evolve. So all of that. I don't know if he's going to particularly be dovish, but I think he's going to stick to the message. The other thing I feel is, most people would also look at the SEPs quite closely, at least analysts like ourselves. And we're literally counting the number of dots everywhere. So we get a sense of, I guess, how the committee is leaning as well.
Counting dots, that's what we have to look forward to for tomorrow. Pooja Sriram with Barclays, thank you so much for being with us. Great to see you. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Recapping that latest data, U.S. retail sales fell by the most since the start of the year. May data suggesting new tariffs deterred customers from spending, especially on cars. The value of retail purchases not adjusted for inflation decreased 0.9% after a downwardly revised 0.1% decline in April. Meanwhile, Israel's defense minister says the country is not in talks with Iran and that it will attack significant targets in Tehran today. The conflict between the two countries is in its 5th day, while Chinese President Xi Jinping said he's ready to play a role in restoring peace in the Middle East. And when it comes to politics, Citadel founder Ken Griffin is making education his top priority.
I decided it was important to support politicians, both Republicans and Democrats, who put education as a very important part of their platform. And over the years, I've continued to support candidates on both sides of the aisle who really do lead with an education-first policy. I find in general, I tend to agree with more of the policies from the Republican Party, but it's important to recognize people in both parties that really do lead the charge fighting for the interests of children.
Ken Griffin sat down with our own Shonali Bassick for the premiere episode of her new show, Bullish. You can watch tonight at 6 p.m. Eastern on Bloomberg TV or stream it at 8 p.m. on Bloomberg Originals. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Thanks again for this morning. Really appreciate it. Up next, we'll be setting you up for the day ahead. Plus, Kay Hare of JP Morgan will be joining us as we parse through the reaction of bond markets and look ahead to what we can expect tomorrow from the Fed's rate decision. This is Bloomberg Surveillance.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appear, immediately I asked whole corporations study how will you bring generative AI to their job.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back to Bloomberg Surveillance. Right now, we can see a bit of a retracement from the initial reaction to retail sales. The knee-jerk response in two-year yields has been completely removed. Now we're down just slightly versus the 5 basis points initially. You're seeing stocks around that 0.4% decline, same as what we saw earlier. Less than an hour away from the cash open. Here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. We start with solar stocks plunging even more in the pre-market after Senate Republicans unveiled a bill that would end tax credits on solar and wind by 2028. That's years earlier than for other energy sources like nuclear. So you are seeing Sunrun down 37%, while Solar Edge and Enphase Tech Energy are also down. But I will say the bill could still change. Next up, we have Digital Turbine. This is an ad tech company. Shares are up 6.8% after it reported its first quarter of growth since 2023. The company also blowing past earnings estimates, showing signs of a potential turnaround for the company. And last up, we end with Lennar. Shares are up 1.5% as investors look past its miss on new home orders and focus on other areas like better than expected margins, not just in the past quarter, but also up ahead, which is interesting since it's had to lean on incentives to entice people to buy their homes. Lisa?
Thank you so much, Yahaira. Right now, counting you down to the opening bell, here is the trading diary for the week ahead. Today, the Federal Reserve kicking off its two-day meeting, which does end with a rate decision tomorrow. The G7 summit is underway in Canada, but without President Trump. He had an early departure. Wednesday, jobless claims plus a Fed rate decision and Chair Powell news conference. Thursday, U.S. markets are closed for the federal Juneteenth holiday, and we'll get another rate decision from the Bank of England. The Fed's two-day meeting kicking off today. Joining us now is Keher of JP Morgan, who sits on the desk along with Bob and Priya and Kelsey, and you're letting them have the store alone. Is it going to be rough?
I have complete confidence in those three.
Well, so right now we're looking.
Although, truth be told, I'd rather that they were here on Bloomberg and I were back minding the store.
Okay,
I confess
well,
that.
Kelsey was here yesterday, and we'll definitely have
You got Priya and Bob
coming
tomorrow.
up. So there we go. But I do wonder, when you take a look at all of the different storylines that we've been focusing on, which one kind of is the most important to focus on for the bond market at a time when potentially you could see an inflationary pressure from oil, but you do see signs that consumers aren't exactly stretched, but they are just showing some discretion to prices?
So I was sort of chuckling when I was listening to Pooja and you talking. You said, maybe I'm taking a liberty on the bond moves, a basis point here, a basis point there. And I think that's the answer to your question, Lisa, is that the narrative for us is yields are actually attractive. The U.S. economy is slowing. You saw it in the jobs data, cutting back, an average of 50,000 fewer jobs a month being created. You see a little bit of a decline in retail sales. You see consumer confidence coming up a little bit. There's a lot of cross currents here on the economic data, some strength, some weakness. Looks like overall GDP growth is slowing back towards 1.5% or something like that. There's so much obsession about every single data point, and yet yields are attractive, bonds are doing what they're supposed to be doing, and there's a role for them in portfolios.
So then let's talk about positioning, because ultimately, if it's not necessarily about the fundamentals at any given day that we then take liberties, which is what I just did, and interpret
you
that.
for the record.
No, it's true, but you're not wrong. Then let's talk about that. We've been talking about how crowded the short dollar trade is. Is there a similar type of crowded trade against treasuries that you see somehow reversing at a time where there is attractive yield?
No, I mean, you're right about crowded dollar, but I would also say dollar is essentially overvalued for several years. When you think about real exchange rates, you think about purchasing power parity. So it's not surprising that people move in and then things crack. In terms of the treasuries, I think the curve looks okay to us here. We think there might be some continued steepening. I think there's more attractive opportunities outside of treasuries. There's a lot of comments about the tightness of spreads. I'm not going to sit up here and say that high yield spreads are very cheap versus history, but yields are actually attractive. So whether you're looking at corporates, you see attractive yields. You look at asset-backed securities. You look at some single-family rental and collateralized mortgage-backed securities. There's a whole host of value in the bond market, and I think if you get the overarching theme that the U.S. economy is slowing, we don't see it hurtling toward a recession yet. Fed's probably on hold tomorrow. Look at retail sales, which you and Pooja just assessed very deeply. Yeah, headlines, it's a noisy number. It's 50 to the other. So I'm a little bit more in a let's not make too much ado about every single